Trading for a living. Wiley Finance Editions. Financial statement analysis. 1. Trading, the last frontier. You can be free. You can live and work anywhere in the world. You can be independent from routine and not answer to anybody. This is the life of a successful trader. Many aspire to this, but few succeed. An amateur looks at a quote screen and sees millions of dollars sparkle in front of his face. He reaches for the money and loses. He reaches again and loses more. Traders lose because the game is hard or out of ignorance or lack of discipline. If any of these ail you, I wrote this book for you. How I began to trade. In the summer of 1976, one drove from New York to California. I threw a few books on psychiatry. I was a first-year psychiatric resident, several histo, rise, and a paperback copy of Engel's How to Buy Stocks into the trunk of my old Dodge. Little did I know that a dog-eared paperback borrowed from a lawyer friend would in due time change the course of my life. That friend, incidentally, had a perfect reverse golden touch. Any investment he touched went underwater. But that's another story. I gulped down the Engel book in campgrounds across America, finishing it on a Pacific beach in La Jolla. I had known nothing about the stock market, and the idea of making money by thinking gripped me. I had grown up in the Soviet Union in the days when it was, in the words of a former U.S. president, an evil empire. I hated the Soviet system and wanted to get out, but immigration was forbidden. I entered college at 16, graduated medical school at 22, completed my residency, and then took a job. 1. 2. Introduction. As a ship's doctor. Now I could break free. I jumped the Soviet ship in Abidjan, Ivory Coast. I ran to the U.S. Embassy through the clogged, dusty streets of an African port city, chased by my ex-crewmates. The bureaucrats at the embassy bled, and almost handed me back to the Soviets. I resisted, and they put me in a safe house, and then on a plane to New York. I landed at Kennedy Airport in February 1974, arriving from Africa with summer clothes on my back and $25 in my pocket. I spoke some English, but did not know a soul in this country. I had no idea what stocks, bonds, futures, or options were, and sometimes got a queasy feeling just from looking at the American dollar bills in my wallet. In the old country, a handful of them could buy you 3 years in Siberia. Reading How to Buy Stocks opened a whole new world for me. Returning to New York, I bought my first stock. It was KinderCare. Ever since then, I have avidly studied the markets and invested in traded stocks, options, and now mostly futures. My professional career proceeded on a separate track. I completed a Resi Denke in psychiatry at a major university hospital, studied at the New York Psychoanalytic Institute, and served as book editor for the largest psychiatric newspaper in the United States. These days, I'm busy trading and go to my psychiatric office across the street from Carnegie Hall only a few after noons a week after the markets close. I love practicing psychiatry, but I spend most of my time in the markets. Learning to trade has been a long journey, with soaring highs and aching lows. In moving forward or in circles, I repeatedly knock my face against the wall and ram my trading account into the ground. Each time I returned to a hospital job, put a stake together, read, thought, did more test, ING, and then started trading again. My trading slowly improved, but the breakthrough came when I realized that the key to winning was inside my head and not inside a computer. Psychiatry gave me the insight into trading that I will share with you. Do you really want to succeed? For the past 17 years, I've had a friend whose wife is fat. She is an elegant dresser, and she's been on a diet for as long as I have known her. She says she wants to lose weight, and she does not eat cake or potatoes in front of 2. Psychology is the key. 3. People, but when I come into her kitchen, I often see her go at it with a big fork. She says she wants to be slim, but remains as fat today as the day we met. Why? The short-term pleasure of eating is stronger for her than the delayed plea. Sure, and health benefits of weight loss. My friend's wife reminds me of a great many traders who say they want to be successful, but keep making. Impulsive trades, going for the short-term thrills of gambling in the markets. People deceive themselves and play games with themselves. Lying to auth. Errors is bad enough, but lying to yourself is hopeless. Bookstores are full of good books on dieting, but the world is full of overweight people. This book will teach you how to analyze and trade the markets and how to deal with your own mind. I can give you the knowledge. Only you can supply the motivation. 2. Psychology is the key. You may base your trades on fundamental or technical analysis. You may trade because of hunches about economic and political trends, use inside information, or simply hope. Remember how you felt the last time you placed an order? Were you ANX, east to jump in, or afraid of losing? Did you procrastinate before picking up the phone? When you closed out a trade, did you feel elated or humiliated? The feelings of thousands of traders merge into huge psychological tides that move the markets, getting off the roller coaster. The majority of traders spend most of their time looking for good trades. Once they enter a trade, they lose control and either squirm from pain or grin from pleasure. They ride an emotional roller coaster and miss the essential element of winning, the management of their emotions. Their inability to manage themselves leads to poor money management of their accounts. If your mind is not in gear with the markets, or if you ignore changes in mass psychology of crowds, then you have no chance of making money. Trading. All winning professionals know the enormous importance of psychology in trading. All losing amateurs ignore it. Friends and clients who know that I am a psychiatrist often ask me. 4. Introduction. Whether this helps me as a trader. Good psychiatry and good trading have one important principle in common. Both focus on reality, on seeing the world the way it is. To live a healthy life, you have to live with your eyes open. To be a good trader, you need to trade with your eyes open, recognize real trends and turns, and not waste time or energy on regrets and wishful thinking. A man's game? Brokerage house records show that most traders are male. The files of my educational firm, Financial Trading Seminars Incorporated, confirm that approximately 95% of traders are men. For this reason, you'll find that I commonly use the masculine pronoun, he, in the anecdotes and cases throughout. This book, of course, no disrespect is intended to the many successful women traders. The percentage of women is higher among institutional traders, employees of banks, trading firms, and the like. In my experience, however, the few women who get involved in trading succeed more often than men. A woman needs exceptional drive to plunge into this male preserve. Trading is similar to such thrilling and dangerous sports as skydiving, rock climbing, and scuba diving. They also attract mostly men. Fewer than 1% of hang gliders are female. Men are drawn to risky sports in our increasingly regulated society. Dr. David Klein, a sociologist at the University of Michigan, was quoted in the New York Times as saying, "As work becomes more and more routinized, we turn to recreation for a sense of accomplishment. The safer and more time we make work, the more we will push people into recreations where individual distinction and discretion, adventure and excitement play a part. These sports provide intense pleasure but have a stigma of danger because many participants ignore the risks and take thoughtless chances." Dr. John Tung, an orthopedic surgeon in Oregon who studied accidents among hang gliders, found that the chance of death rises among more experienced pilots because they take greater risks. An athlete who wants to enjoy risky sports has to follow safety rules. When you reduce risks, you gain an added sense of accomplishment and control. The same goes for trading. You can succeed in trading only if you handle it as a serious intellectual pursuit. Emotional trading is lethal. To help ensure success, practice defensive money management. A good trader watches his capital as carefully as a professional scuba diver watches his air supply. 2. Psychology is the key. 5. How this book is organized. / Successful trading stands on three pillars: psychology, market analysis, and backslash trading systems and money management. This book will help you explore all three. The first chapter of this book shows you a new approach to managing your emotions as a trader. I discovered this method while practicing Psychia. Try. It has greatly improved my trading, and it can help you too. The second chapter describes the crowd psychology of markets. Mass behavior is more primitive than individual behavior. If you understand how crowds behave, then you can profit from their mood swings and avoid being swept up in their emotions. The third chapter of the book shows how chart patterns reveal crowd behavior. Classical technical analysis is applied social psychology like poll taking. Trend lines, gaps, and other chart patterns actually reflect crowd behavior. The fourth chapter teaches modern methods of computerized technical analysis. Indicators provide a deeper insight into mass psychology than class cycle technical analysis. Trend-following indicators help identify market trends, while oscillators show when trends are ready to reverse. Volume and open interest also reflect crowd behavior. The fifth chapter focuses on them as well as on the passage of time in the markets. Crowds have a very short attention span, and a trader who relates price changes to time gains a competitive advantage. The sixth chapter focuses on the best techniques of stock market analysts. They can be especially helpful for stock index futures and options traders. Sentiment indicators measuring the opinions of investors and traders are profiled in the seventh chapter. Crowds follow trends, and it often pays to join them when prices are moving. Sentiment indicators show when it is time to abandon the crowd before it misses an important reversal. The eighth chapter reveals two proprietary indicators. Elderray is a price-based indicator that measures the power of bulls and bears below the surface of the markets. Force Index measures prices and volume. It shows whether the dominant market group is becoming stronger or weaker. The ninth chapter presents several trading systems. The triple screen trading system is my own method. I have used it for years. This and other systems show you how to select trades and find entry and exit points. The 10th chapter focuses on money management. This essential aspect of successful trading is neglected by most amateurs. You can have a brilliant trading system, but if your money management is bad, then a short string of 6. Introduction. Losses will destroy your account. Trading without proper money management is like trying to cross a desert barefoot. You are about to spend many hours with this book. When you find ideas that seem valuable to you, test them in the one crucible that matters, your own experience. You can make this knowledge your own only by question. ING it. 3. The odds against you. Why do most traders lose and wash out of the markets? Emotional and thoughtless trading are two reasons, but there is another. Markets are actually set up so that most traders must lose money. The trading industry kills traders with commissions and slippage. Most amateurs cannot believe this, just as medieval peasants could not believe that. Tiny invisible germs could kill them. If you ignore slippage and deal with a broker who charges high commissions, you're acting like a peasant who drinks from a communal pool during a cholera epidemic. You pay commissions for entering and exiting trades. Slippage is the difference between the price at which you place your order and the price at which it gets filled. When you place a limit order, it is filled at your price or not at all. When you feel eager to enter or exit the market and give a market order, it is often filled at a worse price than prevailed when you placed it. The trading industry keeps draining huge amounts of money from the markets. Exchanges, regulators, brokers, and advisors live off the markets, while generations of traders keep washing out. Markets need a fresh supply of losers, just as builders of the ancient pyramids of Egypt needed a fresh supply of slaves. Losers bring money into the markets, which is necessary for the prosperity of the trading industry. A minus-sum game. Brokers, exchanges, and advisors run marketing campaigns to attract more losers to the markets. Some mention that futures trading is a zero-sum game. They count on the fact that most people feel smarter than average and expect to win in a zero-sum game. Winners in a zero-sum game make as much as losers lose. If you and I bet 3, the odds against you 7, $10 on the direction of the next 100-point move in the Dow, one of us will collect $10 and the other will lose $10. The person who is smarter should win this game over a period of time. People buy the trading industry's propaganda about the zero-sum game. Take the bait and open trading accounts. They do not realize that trading is a minus-sum game. Winners receive less than what losers lose because the industry drains money from the market. For example, roulette in a casino is a minus-sum game because the casino sweeps away 3% to 6% of all bets. This makes roulette unwinnable in the long run. You and I can get into in a minus-sum game if we make the same $10 bet on the next 100-point move in the Dow but deal through brokers. When we settle, the loser is out $13 and the winner collects only $7, while 2 brokers smile all the way to the bank. Commissions and slippage are to traders what death and taxes are to all of us. They take some fun out of life and ultimately bring it to an end. A trader must support his broker and the machinery of exchanges before he collects a dime. Being simply better than average is not good enough. You have to be head and shoulders above the crowd to win a minus-sum game. Commissions. You can expect to pay a round-trip commission of anywhere from $12 to $100 for every futures contract you trade. Big traders who deal with discount houses pay less. Small traders who deal with full-service brokers pay more. Amateurs ignore commissions while dreaming of fat profits. Brokers argue that commissions are tiny relative to the value of underlying contracts. To understand the role of commissions, you need to compare them to your margin, not to the value of the contract. For example, you may pay $30 to trade a single contract of corn, 5,000 bushels, worth approximately $10,000. A broker will say that the $30 commission is less than 1% of contract value. In reality, you have to deposit about $600 to trade a contract of COM. A $30 commission represents 5% of margin. This means you have to make 5% on the capital committed to the trade simply to break even. If you trade COM 4 times a year, you will have to make a 20% annual profit to avoid losing money. Very few people can do this. Many money managers would give their eye teeth for 20% annual returns. A small commission is not a nuisance. It is a major barrier to success. 8. Introduction. Many amateurs generate 50% and more of their account size in COM commissions per year if they last that long. Even discounted commissions raise a tall barrier to successful trading. I have heard brokers chuckle as they goes, psyched about clients who beat their brains out just to stay even with the game. Shop for the lowest possible commissions. Do not be shy about bargaining for lower rates. I have heard many brokers complain about a shortage of customers, but not many customers complain about the shortage of brokers. Tell your broker it is in his best interest to charge you low commissions because you will survive and remain a client for a long time. Design a trad ING system that will trade less often. Slippage. Slippage takes either piranha-sized or shark-sized bites out of your account. Whenever you enter and exit the markets, slippage means having your orders filled at a different price than that which existed when you placed an order. It is like paying 30 cents for an apple in a grocery store, even though the posted price is 29 cents. There are 3 kinds of slippage: common, volatility-based, and criminal. Common slippage is due to a spread between buying and selling prices. Floor traders maintain 2 prices in the market: the bid and the ask. For example, your broker may quote you 390.45 for June S&P 500. If you want to buy a contract at the market, you'll have to pay at least 390.50. If you want to sell at the market, you will receive 390.40 or less. Since each point is worth $5, the 10-point spread between bid and ask transfers $50 from your pocket to floor traders. They charge you for the privilege of ing or exiting a trade. The spread between bid and ask is legal. It tends to be narrow and big, LIQ. UID markets, such as the S&P 500 in bonds, and much wider in thinly traded markets such as orange juice and cocoa. The exchanges claim that the spread is the price you pay for liquidity, being able to trade whenever you wish. Electronic trading promises to cut slippage. Slippage rises with market volatility. Floor traders can get away with more in fast-moving markets. When a market begins to run, slippage goes through the roof. When the S&P 500 rallies or drops, you can get hit with a 20 to 30 point slippage and sometimes 100 points or more. The third kind of slippage is caused by criminal activities of floor traders. 3. The odds against you 9. They have many ways of stealing money from customers. Some put their bad trades into your account and keep good trades for themselves. This kind of activity and other criminal games were recently described in a book, Brokers, Bagmen and Moles, by David Gracing and Lori Morse. When 100 men spend day after day standing shoulder to shoulder in a small pit, they develop a camaraderie, an us against them mentality. Floor traders have a nickname for outsiders which shows that they consider us less than human. They call us paper, as in, is paper coming in today? That is why you have to take steps to protect yourself. To reduce slippage, trade liquid markets and avoid thin and fast-moving markets. Go long or short when a market is quiet. Use limit orders. Buy or sell a specified price. Keep a record of prices at the time when you place your order and have your broker fight the floor on your behalf when necessary. Total damage. Slippage and commissions make trading similar to swimming in a shark-infested lagoon. Let us compare an example from a broker's sales pitch to what happens in the real world. The party line goes like this. A contract of gold futures covers 100 ounces of gold. 5 individuals buy a contract each from someone who sells 5 contracts short. Gold falls $4 and the buyers bail out, losing $4 per ounce or $400 per contract. The intelligent trader who sold 5 contracts short covers his position and makes $400 per contract for a total of $2,000. In the real world, however, each loser has lost more than $400. He paid at least a $25 round-trip commission and was probably hit with $20 slippage, coming and going. As a result, each loser lost $465 per contract, and as a group, they lost $2,325. The winner, who sold 5 contracts short, probably paid a $15 round-trip commission and was hit with $10 slippage coming and going, reducing his gain by $35 per contract or $175 for 5 contracts. He pocketed only $1,825. The winner thought he made $2,000, but he received only $1,825. The losers thought they lost $2,000, but in fact they lost $2,325. In total, fully $500, $2,325 to $1,825 was siphoned from the table. The lion's share was pocketed by floor traders and brokers who took a much bigger cut than any casino or a racetrack would dare. 10. Introduction. Other expenses also drain traders' money. The cost of computers and data, fees for advisory services, and books, including the one you are reading. Now, all come out of your trading funds. Look for a broker with the cheapest commissions and watch him like a hawk. Design a trading system that gives signals relatively infrequently and allows you to enter markets during quiet times. Individual psychology. For why trade? Trading appears deceptively easy. When a beginner wins, he feels brilliant and invincible. Then he takes wild risks and loses everything. People trade for many reasons, some rational and many irrational. Trading offers an opportunity to make a lot of money in a hurry. Money symbolizes freedom to many people, even though they often do not know what to do with their freedom. If you know how to trade, you can make your own hours, live, and work wherever you please and never answer to a boss. Trading is a fascinating, intellectual pursuit. Chess, poker, and a crossword rolled in one. Trading attracts people who love puzzles and brain teasers. Trading attracts risk takers and repels those who avoid risk. An average person gets up in the morning, goes to work, has a lunch break, returns home, has a beer and dinner, watches TV, and goes to sleep. If he makes a few extra dollars, he puts them into his savings account. A trader keeps odd hours and puts his capital at risk. Many traders are loners who abandon the certainty of the present and take a leap into the unknown. Self-fulfillment. Most people have an innate drive to achieve their personal best, to develop their abilities to the fullest. This drive, along with the pleasure of the game and the lure of money, propels traders to challenge the markets. 11. 12. Individual psychology. Good traders tend to be hardworking and shrewd men. They are open to new ideas. The goal of a good trader, paradoxically, is not to make money. His goal is to trade well. If he trades right, money follows almost as an afterthought. Successful traders keep honing their skills, trying to reach their personal best is more important to them than making money. A successful New York trader said to me, "If I become 0.5% smarter each year, I'll be a genius by the time I die." His drive to improve himself is the hallmark of a successful trader. A professional trader from Texas invited me to his office and said, "If you sit across the table from me while I day trade, you won't be able to tell whether I am $2,000 ahead or $2,000 behind on that day." He has risen to a level where winning does not elate him and losing does not deflate him. He is so focused on trading right and improving his skills that money no longer influences his emotions. The trouble with self-fulfillment is that many people have a self-destruct type streak. Accident-prone drivers keep destroying their cars, and self-destructive traders keep destroying their accounts. See Section 7. Markets offer unlimited opportunities for self-sabotage as well as for self-fulfillment. Acting out your internal conflicts in a marketplace is a very expensive proposition. Traders who are not at peace with themselves often try to fulfill their contradictory wishes in the market. If you do not know where you are going, you will wind up somewhere you never wanted to be. 5. Fantasy versus reality. If you hear from a friend with little farming experience that he plans to feed himself with food grown on a quarter-acre plot, you will expect him to go hungry. We all know that one can squeeze only so much blood from a turnip. The one field in which grown-ups let their fantasies soar is trading. Just the other day, a friend told me that he expected to support himself trading his $6,000 account. When I tried to show him the futility of his plan, he quickly changed our topic of conversation. He is a bright analyst, but he refuses to see that his intensive farming plan is suicidal. In his desperate effort to succeed, he must take on large positions, and the slightest wiggle of the market is sure to put him out of business. A successful trader is a realist. He knows his abilities and limitations. He sees what is happening in the markets and knows how to react to them. 5. Fantasy versus reality. 13. Analyzes the markets without cutting corners, observes his own reactions, and makes realistic plans. A professional trader cannot afford illusions. Once an amateur takes a few hits and gets a few margin calls, he becomes fearful instead of cocky and starts developing strange ideas about the markets. Losers buy, sell, or miss trades thanks to their fantastic ideas. They act like children who are afraid to pass a cemetery or look under their bed at night because they are afraid of ghosts. The unstructured environment of the market makes it as easy to develop fantasies. Most people who have grown up in Western civilization have several similar fantasies. They're so widespread that when I studied at the New York Psychoanalytic Institute, there was a course called Universal Fantasies. For example, most people have a fantasy in childhood that they were adopted rather than born to their parents. A fantasy seems to explain the unfriendly and impersonal world. It consoles a child but prevents him from seeing reality. Our fantasies influence our behavior, even if we are not consciously aware of them. In talking to hundreds of traders, I keep hearing them express several universal fantasies. They distort reality and stand in the way of trading success. A successful trader must identify his fantasies and get rid of them. The brain myth. Losers who suffer from the brain myth will tell you, I lost because I didn't know trading secrets. Many losers have a fantasy that's successful. Traders have some secret knowledge. This fantasy helps support a lively market in advisory services and ready-made trading systems. A demoralized trader often whips out his checkbook and goes shopping for trading secrets. He may send money to a charlatan for a $3,000 can't miss back-tested computerized trading system. When that self-destructs, he sends another check for a scientific manual that explains how he can stop being a loser and become a true insider and a winner by contemplating the moon, Saturn, or even Uranus. The losers do not know that trading is intellectually fairly simple. It is less demanding than taking out an appendix, building a bridge, or trying case in court. Good traders are often shrewd, but few of them are intellectuals. Many have not been to college, and some have even dropped out of high school. Intelligent and hardworking people who have succeeded in their careers often feel drawn to trading. The average client of a brokerage firm is 50. The autopilot myth. Imagine that a stranger walks into your driveway and tries to sell you an automatic system for driving your car. Just pay a few $100s for a computer chip, install it in your car, and stop wasting energy on driving, he says. You could take a nap in the driver's seat while the easy swing system whisks you to work. You would probably laugh the salesman out of your driveway. But would you laugh if he tried to sell you an automatic trading system? Traders who believe in the autopilot myth think that the pursuit of wealth can be automated. Some try to develop an automatic trading system, while others buy one from the experts. Men who have spent years honing their skills as lawyers, doctors, or businessmen plunk down thousands of dollars for canned competence. They are driven by greed, laziness, and mathematical literacy. Systems used to be written on sheets of paper, but now they usually come on copy-protected diskettes. Some are primitive, others are elaborate, with built-in optimization and money management rules. Many traders spend thousands of dollars searching for magic that will turn a few pages of computer code into an endless stream of money. People who pay for automatic trading systems are like medieval knights who paid alchemists for the secret of turning base metals into gold. 16. Individual psychology. Complex human activities do not lend themselves to automation. Computerized learning systems have not replaced teachers, and programs for doing taxes have not created unemployment among accountants. Most human activities call for an exercise of judgment. Machines and systems can help but not replace humans. So many system buyers have been burned that they have formed an organization, Club 3000, named after the price of many systems. If you could buy a successful automatic trading system, you could move to Tahiti and spend the rest of your life in leisure, supported by a stream of checks from your broker. So far, the only people who have made money from trading systems are the system sellers. They form a small but colorful cottage industry. If their systems worked, why would they sell them? They could move to Tahiti themselves and cash checks from their brokers. Meanwhile, every system seller has a line. Some say they like programming better than trading. Others claim that they sell their systems only to raise trading capital. Markets always change and defeat automatic trading systems. Yesterday's rigid rules work poorly today and will probably stop working tomorrow. A competent trader can adjust his methods when he detects trouble. An automatic system is less adaptable and self-destructs. Airlines pay high salaries to pilots despite having autopilots. They do it because humans can handle unforeseen events. When a roof blows off an airliner over the Pacific, or when a plane runs out of gas over the Canadian wilderness. Only a human can handle such a crisis. These emergencies have been reported in the press, and in each of them, experienced pilots managed to land their airliners by improvising. No autopilot can do that. Betting your money on an automatic system is like betting your life on an autopilot. The first unexpected event will destroy your account. There are good trading systems out there, but they have to be monitored and adjusted using individual judgment. You have to stay on the ball. You cannot abdicate your responsibility for your success to a trading system. Traders who have the autopilot fantasy try to repeat what they felt as infants. Their mothers used to fulfill their needs for food, warmth, and calm. Ford. Now they try to recreate the experience of passively lying on their backs and having profits flow to them like an endless stream of free, warm milk. The market is not your mother. It consists of tough men and women who look for ways to take money away from you instead of pouring milk into your mouth. 6. Market Gurus 17. The personality cult. Most people give lip service to their wish for freedom and independence. When they come under pressure, they change their tune and start looking for strong leadership. Traders in distress often seek directions from assorted gurus. When I was growing up in the former Soviet Union, children were taught that Stalin was our great leader. Later, we found out what a monster he had been, but while he was alive, most people enjoyed following the leader. He freed them from the need to think for themselves. Little Stalins were installed in every area of society, in economics, biology, architecture, and so on. When I came to the United States and began to trade, I was amazed to see how many traders were looking for a guru. They are little Stalin in the market, the fantasy that someone else can make. You Rich deserves its own discussion later in this chapter. Trade with your eyes open. Every winner needs to master 3 essential components of trading: the sound, individual psychology, a logical trading system, and a good money management plan. These essentials are like 3 legs of a stool. Remove one, and the stool will fall together with the person who sits on it. Losers try to build a stool with only 1 leg, or 2 at the most. They usually focus exclusively on trading systems. Your trades must be based on clearly defined rules. You have to analyze your feelings as you trade to make sure that your decisions are intellectually sound. You have to structure your money management so that no string of losses can kick you out of the game. 6. Market Gurus asterisk. Gurus have been with us ever since the public entered markets. In 1841, the classic book on market manias, Extraordinary Popular Delusions, and the Madness of Crowds was published in England. It is still in print today. Its author, Charles Mackay, described the Dutch tulip mania, the South Seas bubble in England, and other mass manias. Human nature changes slowly. This section originally appeared as an article, Market Gurus, in the September 1990 issue of Futures and Options World. London, UK, copyright 1990 by Alexander Elder. 18. Individual psychology. And today, new mass manias, including guru manias, continue to sweep the markets. Guru manias spring up faster now than they did centuries ago, thanks to modern telecommunications. Even educated and intelligent investors and traders follow market gurus, like the devotees of the false messiahs in the Middle Ages. There are 3 types of gurus in the financial markets: market cycle gurus, magic method gurus, and dead gurus. Some gurus call important market turns. Others promote unique methods, new highways to riches. Still, others have escaped criticism and invited cult following through the simple mechanism of departing this world. Market cycle gurus. For many decades, the U.S. stock market has generally followed a 4-year cycle. Significant bear market lows occurred in 1962, 1966, 1970, 1974, 1978, and 1982. The broad stock market has normally spent 2.5 or 3 years going up and 1 or 1.5 years going down. A new market cycle guru emerges in almost every major stock market. Cycle once every 4 years. A guru's fame tends to last for 2 to 3 years. The reigning period of each guru coincides with a major bull market in the United States. A market cycle guru forecasts all major rallies and declines. Each correct forecast increases his fame and prompts even more people to buy or sell. When he issues his next forecast, as more and more people take notice of the guru, his advice becomes a self-fulfilling prophecy. When you recognize a hot new guru, it pays to follow his advice. There are thousands of analysts, some of whom are certain to be on a hot streak at any given time. Most analysts become hot at some point in their careers for the same reason a broken clock shows the right time twice a day. Those who have tasted the joy of being on a hot streak sometimes feel crushed when it ends and they wash out of the market. But there are enough old foxes who enjoy their occasional hot streaks, yet continue working as usual after their hot streak ends. The success of a market cycle guru depends on more than short-term luck. He has a pet theory about the market. That theory, cycles, volume, Elliott wave, whatever, is usually developed several years prior to reaching star. DOM. At first, the market refuses to follow an aspiring guru's pet theory. Then, 6. Market Gurus 19. The market changes and for several years comes in gear with theory. That is, when a star of the market, guru, rises high and bright above the marketplace. Compare this to what happens to fashion models as public tastes change. One year, blondes are popular, another year, redheads. Suddenly, last year's blonde star is no longer wanted for the front cover of a major women's mag. Azine. Everybody wants a dark model or a woman with a birthmark on her face. A model does not change, public tastes do. Gurus always come from the fringes of market analysis. They are never establishment analysts. Institutional employees play it safe and never achieve spectacular results because each uses similar methods. A market cycle guru is an outsider with a unique theory. A guru usually earns a living publishing a newsletter and can grow rich selling his advice. Subscriptions can soar from a few hundred annually to tens of thousands. A recent market cycle guru was reported to have hired 3 people just to open the envelopes with money pouring into his firm. At investment conferences, a guru is surrounded by a mob of admirers. If you ever find yourself in such a crowd, notice that a guru is seldom asked questions about his theory. His admirers are content to drink in the sound of his voice. They brag to their friends about having met him. A gum remains famous for as long as the market behaves according to his theory, usually for less than the duration of one 4-year market cycle. At some point, the market changes and starts marching to a different tune. A gum continues to use old methods that worked spectacularly well in the past and rapidly loses his following. When the gum's forecasts stop working, public admiration turns to hatred. It is impossible for a discredited market cycle gum to return to stardom. The reigning gum in the early 1970s was Edson Gould. He based his forecasts on policy changes of the Federal Reserve, as reflected in the discount rate. His famous MLE of 3 steps and a stumble stated that if the Federal Reserve raised the discount rate 3 times, that showed tightening and led to a bear market. Lowering the discount rate in 3 steps revealed a loosen ing of the monetary policy and led to a bull market. Gould also developed an original charting technique called speed lines, shallow trend lines whose angles depended on the velocity of a trend and the depth of market reactions. Gould became very hot during the bear market of 1973 to 1974. He vaulted to prominence after correctly calling the December 1974 bottom, when the Dow Jones Industrials fell to near 500. The market rocketed higher. Gould presciently identified its important turning points using speed lines, and his fame grew. But soon the United States was flooded with liquidity, inflation, 20 individual psychology intensified, and Gould's methods developed in a different monetary environment. Men stopped working. By 1976, he had lost most of his following, and few people today even remember his name. The new market cycle guru emerged in 1978. Joseph Granville stated that changes in stock market volume preceded changes in prices. He expressed it colorfully. Volume is the steam that makes the choo-choo go. Granville developed his theory while working for a major Wall Street brokerage firm. He wrote in his autobiography that the idea came to him while sitting on a toilet contemplating the design of floor tiles. Granville took his idea from the bathroom to the chart room, but the market refused to follow his forecasts. He went broke, got divorced, and slept on the floor of his friend's office. By the late 1970s, the market started to follow Granville's scripts as never before or since, and people began to take notice. Granville toured the United States speaking to overflow crowds. He arrived on stage in a carriage, issued forecasts, and chided bag holders who would not recognize his theory. He played piano, sang, and, on occasion, even dropped his pants to make a point. His forecasts were spectacularly wrecked. He drew attention to himself and became widely quoted in the mass media. Granville became big enough to move the stock market. When he announced that he was bearish, the Dow dropped over 40 points in a day, a huge decline by the standards of that time. Granville became intoxicated with his success. The market surged higher in 1982, but he remained very bearish and kept advising his dwindling band of followers to continue to sell short. The market rocketed higher into 1983. Granville finally gave up and recommended buying when the Dow doubled in value. He continued to publish a market newsletter, a shadow of his former successful self. A new guru entered the spotlight in 1984. Robert Prechter has made a name for himself as an Elliott wave theorist. Elliott was an impecunious accountant who developed his market theory in the 1930s. He believed that the stock market rallied in 5 waves and fell in 3 waves, which in turn could be subdivided into lesser waves. Like other market cycle gurus before him, Prechter had been writing an advisory letter for many years with modest success. When the bull market penetrated the 1,000 level on the Dow, people began to pay attention to the young analyst who kept calling for the Dow to reach 3,000. The bull market went from strength to strength, and Prechter's fame grew by leaps and bounds. In the roaring bull market of the 1980s, Prechter's fame swept outside the narrow world of investment newsletters and conferences. Prechter appeared on national television and was interviewed by popular magazines. In October 6, Market Gurus 21, 1987, he appeared to vacillate, first issuing a sell signal, then telling his fall lowers to get ready to buy. As the Dow crashed 500 points, mass adulation of Prechter gave way to scorn and hatred. Some blamed him for the decline. Others were angry that the market never reached his stated target of 3,000. Prechter's advisory business shrank, and he largely retired from it. All market cycle gurus have several traits in common. They become active in the forecasting business several years prior to reaching stardom. Each has a unique theory, a few followers, and some credibility conferred by sheer survival in the advisory business. The fact that each guru's theory did not work for a number of years is ignored by his followers. When the theory becomes correct, the mass media take notice. When a theory stops working, mass adulation of a guru turns to hatred. When you recognize that a successful new guru is emerging, it is profitable to jump on his bandwagon. It is even more important to recognize when a guru has reached his peak. All gurus crash, and by definition, they crash from the height of their fame. When a guru becomes accepted by the mass media, it is a sign that he has reached his crest. The mainstream media is wary of outsiders. When several mass magazines devote space to a hot market guru, you know that his end is near. Another warning sign that a market guru has reached his peak occurs when he is interviewed by Barron's, America's largest business weekly. Every January, Barron's invites a panel of prominent analysts to dispense wisdom and issue forecasts for the year ahead. The panel is usually made up of safe analysts who focus on price/earnings ratios, emerging growth, industries, and so on. It is highly atypical of Barron's to invite a hot guru with an offbeat theory to its January panel. A guru gets invited only when the public clamors for him, and to exclude him would diminish the prestige of the magazine. Both Granville and Prechter were invited to the January panel when each man was at the crest of his fame. Each guru fell within a few months of appearing on that panel. The next time a market guru is on Barron's January panel, do not renew your subscription to his newsletter. Mass psychology being what it is, new gurus will certainly emerge. An old cycle guru never fully comes back. Once he stumbles, the adulation turns to derision and hatred. An expensive vase, once shattered, can never be fully restored. Magic method gurus. Market cycle gurus are creatures of the stock market, but method gurus are more prominent in the derivative markets, especially in the futures markets. 22. Individual psychology. A method guru erupts on the financial scene after discovering a new analytic or trading method. Traders always look for an edge, an advantage over fellow traders. Like knights shopping for swords, they are willing to pay handsomely for their trading tools. No price is too high if it lets them tap into a money pipeline. A magic method gum sells a new set of keys to market profits. As soon as enough people become familiar with a new method and test in the markets, it inevitably deteriorates and starts losing popularity. Markets are forever changing, and the methods that worked yesterday are not likely to work today and even less likely to work a year from now. In the early 1970s, Chicago market letter writer Jake Bernstein became hot by using market cycles to call tops and bottoms. His methods worked well, and his fame spread. Bernstein charged high fees for his newsletters, ran conferences, managed funds, and produced an endless flow of books. As usual, the markets changed, becoming less and less cyclical in the 1980s. Peter Steidelmayer was another method gum whose star rose high above Chicago. He urged his followers to discard old trading methods in favor of his market profile. That method promised to reveal the secrets of supply and demand and give TME believers an ability to buy at the bottoms and sell at the tops. Steidelmayer teamed up with entrepreneur Kevin Coy, and their FRE Quint seminars attracted upward of 50 people who paid $1,600 for a 4-day class. There appear to be no conspicuous examples of success among market profile devotees, and the founders had a nasty falling out. Steidelmayer got a job with a brokerage firm, and both he and Coy continued to give occasional seminars. Oddly enough, even in this era of fast global links, reputations change slowly. A guru whose image has been destroyed in his own country can make money peddling his theory overseas. That point has been made to me by a gum who compared his continued popularity in Asia to what happens to faded American singers and movie stars. They are unable to attract an audience in the United States, but they can still make a living singing abroad. Dead gurus. The third type of market gum is a dead gum. His books are reissued. His market courses are scrutinized by new generations of eager traders. And 6. Market Gurus 23. Legend of the dear departed analyst's prowess and personal wealth grows posthumously. The dead guru is no longer among us and cannot capitalize on his fame. Other promoters profit from his reputation and from expired copy. Writes, one dear departed guru is Aaron Elliott, but the best example of such a legend is W.D. Gann. Various opportunists sell Gann courses and Gann software. They claim that Gann was one of the best traders who ever lived, that he left a $50 million estate, and so on. I interviewed W.D. Gann's son, an analyst for a Boston bank. He told me that his famous father could not support his family by trading, but earned his living by writing and selling instructional courses. When W.D. Gann died in the 1950s, his estate, including his house, was valued at slightly over $100,000. The legend of W.D. Gann, the giant of trad, ing, is perpetuated by those who sell courses and other paraphernalia to gullible customers, the followers of gurus. The personalities of market gurus differ. Some are dead, but those who are alive range from serious academic types to great showmen. A guru has to produce original research for several years, then get lucky when the market turns his way. To read about the scandals that surrounded many gurus, try Winner Takes. All by William Gallagher and the Dow Jones Guide to Trading Systems by Bruce Babcock. The purpose of this section is simply analysis of the guru phenomenon. When we pay a guru, we expect to get back more than we spend. We act like a man who bets a few dollars against a 3-card monte dealer on a street corner. He hopes to win more than he put down on an overturned crate. Only the ignorant or greedy take the bait. Some people turn to gums in search of a strong leader. They look for a parent-like omniscient provider. As a friend once said, they walk with their umbilical cords in hand, looking for a place to plug them in. A smart motor provides such a receptacle for a fee. The public wants gurus, and new gurus will come. As an intelligent trader, you must realize that in the long run, no guru is going to make you rich. You have to work on that yourself. 24. Individual psychology. 7. Self-destructiveness. Trading is a very hard game. A trader who wants to be successful in the long run has to be very serious about what he does. He cannot afford to be naive or to trade because of some hidden psychological agenda. Unfortunately, trading often appeals to impulsive people, to gamblers, and to those who feel that the world owes them a living. If you trade for the excitement, you are liable to take trades with bad odds and accept unnecessary risks. The markets are unforgiving, and emotional trading always results in losses. Gambling. Gambling means betting on games of chance or skill. It exists in all societies, and most people have gambled at some point in their lives. Freud believed that gambling was universally attractive because it was a substitute for masturbation, the repetitive and exciting activity of the hands, the irresistible urge, the resolutions to stop, the intoxicating quality of plea. Sure, and the feelings of guilt link gambling and masturbation. Dr. Ralph Greenson, a prominent California psychoanalyst, has divided gamblers into 3 groups. The normal person who gambles for diversion and who can stop when he wishes, the professional gambler who selects gambling as his means of earning a livelihood, and the neurotic gambler who gambles because he is driven by unconscious needs and is unable to stop. A neurotic gambler either feels lucky or wants to test his luck. Winning gives him a sense of power. He feels pleased, like a baby feeding at a breast. A neurotic gambler always loses because he tries to recreate that omnipotent feeling of bliss instead of concentrating on a realistic, long-term game plan. Dr. Sheila Bloom, director of the compulsive gambling program at South Oaks Hospital in New York, calls gambling an addiction without a drug. Most gamblers are men who gamble for the action. Women tend to gamble as a means of escape. Losers usually hide their losses and try to look and act like winners, but they are plagued by self-doubt. Trading stocks, futures, and options gives a gambler a high, but it does appear more respectable than betting on the ponies. Moreover, gambling in the financial markets has an aura of sophistication and offers a better intellectual diversion than playing numbers with a bookie. 7. Self-destructiveness. 25. Gamblers feel happy when trades go in their favor. They feel terribly low when they lose. They differ from successful professionals who focus on long-term plans and do not get particularly upset or excited in the process of trading. Brokers are well aware that many of their clients are gamblers. They often try to avoid leaving messages for traders with their wives, even when they call to confirm a trade. Amateurs are not the only ones involved in gambling. Quite a bit of it goes on among professionals. Sonny Kleinfield describes in his book, The Traders, the endemic betting on sports events on the floors of financial exchanges. The key sign of gambling is the inability to resist the urge to bet. If you feel that you're trading too much and the results are poor, stop trading for a month. This will give you a chance to reevaluate your trading. If the urge to trade is so strong that you cannot stay away from the action for a month, then it is time to visit your local chapter of Gamblers Anonymous or start using the principles of Alcoholics Anonymous, outlined later in this chapter. Self-sabotage. After practicing psychiatry for many years, I became convinced that most failures in life are due to self-sabotage. We fail in our professional, personal, and business affairs not because of stupidity or incompetence, but to fulfill an unconscious wish to fail. A brilliant and witty friend of mine has a lifelong history of demolishing his success. As a young man, he was a successful industrial salesman and was sacked. He entered training as a broker and rose near the top of his firm, but was sued. He became a well-known trader, but busted out while disentangling himself from previous disasters. He blamed all his failures on envious bosses, incompetent regulators, and an unsupportive wife. Finally, he hit bottom. He had no job and no money. He borrowed a quote terminal from another busted-out trader and raised capital from a few people who had heard that he had traded well in the past. He knew how to trade and made money for his pool. As the word spread, more people brought in money. My friend was on a roll. At that point, he went on a speaking tour of Asia, but continued to trade from the road. He took a side trip into a country famous for its prostitutes, leaving a very large open position with no protect. Time stop. By the time he returned to civilization, the markets had staged a major move and his pool was wiped out. Did he try to figure out his problem? Did he try to change? No. He blamed his broker. 26. Individual psychology. It hurts to look within yourself for the cause of your failure. When traders get in trouble, they tend to blame others, bad luck, or anything else. A prominent trader came to me for a consultation. His equity was being demolished by a rally in the US dollar, in which he was heavily short. He had grown up fighting a nasty and arrogant father. He had made a name for himself by betting large positions on reversals of established trends. This trader kept adding to his short position because he could not admit that the market, which represented his father, was bigger and stronger than he was. These are just two examples of how people act out self-destructive tendencies. We sabotage ourselves by acting like impulsive children rather than intelligent adults. We cling to our self-defeating patterns even though they can be treated. Failure is a curable disease. The mental baggage from childhood can prevent you from succeeding in the markets. You have to find your weaknesses in order to change. Keep a trading diary. Write down your reasons for entering and exiting every trade. Look for repetitive patterns of success and failure. The demolition derby. Almost every profession and business provides a safety net for its members. Your bosses, colleagues, and clients can warn you when you behave dangerously or self-destructively. There is no such support in trading, which makes it more dangerous than most human endeavors. The markets offer many opportunities to self-destruct without a safety net. All members of society make small allowances to protect one another from the consequences of our mistakes. When you drive, you try to avoid hitting other cars, and they try to avoid hitting you. If someone swings open the door of a parked car, you swerve. If someone cuts in front of you on a highway, you may curse, but you will slow down. You avoid collisions because they are too costly for both parties. Markets operate without normal human helpfulness. Every trader tries to hit others. Every trader gets hit by others. The trading highway is littered with wrecks. Trading is the most dangerous human endeavor, short of war. Buying at the high point of the day is like swinging your car door open into the traffic. When your buy order reaches the floor, traders rush to sell too. You to rip your door off along with your arm. Other traders want you to fail because they get the money you lose. 8. Trading Psychology 27. Controlling self-destructiveness. Most people go through life making the same mistakes at 60 that they made at 20. Others structure their lives to succeed in one area while ing out internal conflicts in another. Very few people grow out of their problems. You need to be aware of your tendency to sabotage yourself. Stop blaming your losses on bad luck or on others and take responsibility for the results. Start keeping a diary, a record of all your trades with reasons for entering and exiting them. Look for repetitive patterns of success and failure. Those who do not learn from the past are condemned to repeat it. You need a psychological safety net the way mountain climbers need their survival gear. I found the principles of Alcoholics Anonymous outlined later in this chapter to be of great help. Strict money management rules also pro. Vita safety net. If you seek therapy for your trading problems, choose a competent therapist who knows what trading is about. You are ultimately responsible for your own therapy and must monitor its progress. I usually tell my patients that if a month goes by without clear signs of improvement, then therapy is in trouble. When therapy shows no progress for 2 months, it is time to seek a consultation with another therapist. 8. Trading Psychology. Your feelings have an immediate impact on your account equity. You may have a brilliant trading system, but if you feel frightened, arrogant, or upset, your account is sure to suffer. When you recognize that a gambler's high or fear is clouding your mind, stop trading. Your success or failure as a trader depends on controlling your emotions. When you trade, you compete against the sharpest minds in the world. The field on which you compete has been slanted to ensure your failure. If you allow your emotions to interfere with your trading, the battle is over. You are responsible for every trade that you make. A trade begins when you decide to enter the market and ends only when you decide to take yourself out. Having a good trading system is not enough. Most traders with good systems wash out of the markets because psychologically they are not prepared to win. 28. Individual Psychology. Bending the rules. Markets offer enormous temptations, like walking through a gold vault or through a harem. Markets evoke powerful greed for more gains and a great fear of losing what we've got. Those feelings cloud our perceptions of opportunities and dangers. Most amateurs feel like geniuses after a winning streak. It is exciting to believe that you're so good you can bend your own rules and succeed. That's when traders deviate from their rules and go into a self-destruct mode. Traders gain some knowledge. They win, their emotions kick in, and they self-destruct. Most traders promptly give their killings back to the markets. The markets are full of rags to rags stories. The hallmark of a successful trader is his ability to accumulate equity. You need to make trading as objective as possible. Keep a diary of all your trades with before and after charts. Keep a spreadsheet listing all your trades, including commissions and slippage, and maintain very strict money management rules. You may have to devote as much energy to analyzing yourself as you do to analyzing the markets. When I was learning how to trade, I read every book on trading psychology I could find. Many writers offered sensible advice. Some stressed discus. Pline, you cannot let the market sway you. Do not make decisions during trading hours. Plan a trade and trade a plan. Others stressed flexibility. Do not enter the market with any preconceived notions. Change your plans when markets change. Some experts suggested isolation, no business news, no Wall Street Journal, no listening to other traders, just you and the markets. Others advise being open-minded, keeping in touch with other traders, and soaking up fresh ideas. Each piece of advice seemed to make sense but contradicted other equally sensible advice. I kept reading, trading, and focusing on system development. I also continued to practice psychiatry. I never thought the two fields were Next, until I had a sudden insight. The idea that changed how I trade came from psychiatry. The insight that changed my trading. Like most psychiatrists, I always had some patients with alcohol problems. I also serve as a consultant to a major drug rehabilitation program. It did not. 9. Trading lessons from AA 29. Take me long to realize that alcoholics and addicts were more likely to recover in self-help groups than in classical psychiatric settings. Psychotherapy, medications, and expensive hospitals and clinics can sober up a drunk, but seldom succeed in keeping him sober. Most addicts quickly relapse. They have a much better chance to recover if they become active in Alcoholics Anonymous, AA, or other self-help groups. Once I realized that AA members were likely to stay sober and rebuild their lives, I became a big fan of Alcoholics Anonymous. I began sending patients with drinking problems to AA and related groups, such as ACOA, Adult Children of Alcoholics. Now, if an alcoholic comes to me for treatment, I insist that he also go to AA. I tell him that to do otherwise would mean wasting our time and his money. One night, many years ago, I stopped by a friend's office on the way to a party at our department of psychiatry. We had 2 hours before the party, and my friend, who was a recovering alcoholic, said, "Do you want to take in a movie or go to an AA meeting?" I had sent many patients to AA, but had never been to a meeting since I have never had a drinking problem. I jumped at a chance to attend an AA meeting. It was a new experience. The meeting was held at a local YMCA. A dozen men and a few women sat on folding chairs in a plain room. The meeting lasted an hour. I was amazed by what I heard. These people seemed to talk about my trading. They talked about alcohol, but as long as I substituted the word loss for alcohol, most of what they said applied to me. My account equity was still swinging up and down in those days. I left that YMCA room knowing that I had to handle my losses the way AA handles alcoholism. 9. Trading lessons from AA. Almost any drunk can stay sober for a few days. Soon the urge to drink overwhelms him again, and he returns to the bottle. He cannot resist his urge because he continues to feel and think like an alcoholic. Sobriety begins and ends inside a person's mind. Alcoholics Anonymous, AA, has a system for changing the way people think and feel about drinking. AA members use a 12-step program for changing their minds. These 12 steps, described in the book 12 Steps, and 12 Traditions, refer to 12 stages of personal growth. Recovering. Alcoholics attend meetings where they share their experiences with others. 30. Individual psychology. Recovering alcoholics, supporting each other in their sobriety. Any member can get a sponsor, another AA member whom he can call for support when he feels the urge to drink. AA was founded in the 1930s by 2 alcoholics, a doctor and a traveling salesman. They began meeting and helping each other stay sober. They developed a system that worked so well, others began to join them. AA has only one goal: to help its members stay sober. It has no fundraising, takes no political positions, and runs no promotional campaigns. AA keeps grow. Thanks only to word of mouth. It owes its success only to its effectiveness. The 12-step program of AA is so effective that people with other problems now use it. There are 12-step groups for children of alcoholics, SMOC, heirs, gamblers, and others. I have become convinced that traders can stop loss money in the markets if they apply the key principles of Alcoholics Anonymous to their trading. Denial. A social drinker enjoys a cocktail or a glass of wine or beer, but stops when he feels he's had enough. An alcoholic's chemistry is different. Once an alcoholic takes a drink, he feels an urge to drink more until he gets drunk. A drunk often says that he needs to cut down on alcohol, but he cannot admit that his drinking is out of control. Most drunks deny that they are alcoholics. Try telling an alcoholic relative, friend, or employee that his drinking is out of control and damaging his life, and you will run into a wall of denial. An alcoholic often says, "My boss fired me because I was hung over and came in late. My wife took the kids and left cause she had no sense to begin with. My landlord is trying to kick me out of the apartment because I'm a little behind on the rent. I'm going to have to cut down on my drinking and everything will be all right. This man has lost his family and his job. He is about to lose the roof over his head. His life is spinning out of control, but he keeps saying that he can cut down on his drinking. This is denial. Alcoholics deny their problems while their lives are falling apart. Most of them nurse the fantasy of being able to control their drinking. As long as an alcoholic believes that he can control his drinking, he is headed downhill. Nothing will ever change, even if he gets a new job, a new wife, and a new landlord. 9. Trading lessons from AA 31. Alcoholics deny that alcohol controls their lives. When they talk of drinking, they talk about managing the unmanageable. They are like a driver whose car spins out of control on a mountain road. When the car careens down a cliff, it is too late to promise to drive carefully. An alcoholic's life careens out of control while he denies he's an alcoholic. There is a stark parallel between an alcoholic and a trader whose account is being demolished by losses. He keeps changing trading tactics, acting like an alcoholic who tries to solve his problem by switching from hard liquor to beer. A loser denies that he has lost control over his course in the market. Rock bottom. A drunk can begin his journey to recovery only after he admits that he is an alcoholic. He must see that alcohol controls his life and not the other way around. Most drunks cannot accept this painful truth. They can face it only after they hit rock bottom. Some alcoholics hit rock bottom when they develop a life-threatening illness. Others hit rock bottom after being rejected by their family or losing a job. An alcoholic needs to sink to a point so low, so deep down in the gutter, so unbearably painful that it finally penetrates his denial. The pain of hitting rock bottom feels intolerable. It makes an alcoholic see how deeply he has sunk. This pain penetrates his denial. He sees a stark and simple choice: either turn his life around or die. Only then is an alcoholic ready to begin his journey to recovery. Profits make traders feel powerful and give them an emotional high. They try to get high again, put on reckless trades, and give back their profits. Most traders cannot stand the pain of a string of severe losses. They die as traders after hitting rock bottom and wash out of the markets. The few survivors realize that the main trouble is not with their methods. The trouble is with their thinking. They can change and become successful traders. The first step: an alcoholic who wants to recover has to go through 12 steps, 12 stages of personal growth. He needs to change how he thinks and feels, how he relates to himself and others. The first step of AA is the hardest. The first step an alcoholic has to take is to admit that he is powerless over 32 individual psychology. Alcohol. He must admit that his life has become unmanageable, that alcohol is stronger than he is. Most alcoholics cannot take that step, drop out, and go on to destroy their lives. If alcohol is stronger than you, then you can never touch it again, not a sip. For as long as you live, you have to give up drinking forever. Most drunks do. No one give up that pleasure. They destroy their lives rather than take the first step of AA. Only the pain of hitting rock bottom can supply the motivation to take that first step, one day at a time. You have probably seen bumper stickers on cars that say "one day at a time" or "easy does it." Those are AA slogans, and people who drive those cars are probably recovering alcoholics. Planning for life without alcohol can seem overwhelming. That's why AA encourages its members to live sober one day at a time. The goal of every AA member is to stay sober today and go to bed sober tonight. Gradually, days become weeks, then months, then years. AA meetings and other activities help each recovering alcoholic stay sober one day at a time. Recovering alcoholics receive and give others invaluable support and fellowship at these meetings. They are held at all hours, all over the world. Traders have much to learn from those meetings. An AA meeting. One of the best things that a trader can do is go to an AA meeting. IS. Highly recommend it to a trader on a losing streak. Call Alcoholics Anonymous and ask about the next open meeting or beginner's meeting in your area. A meeting lasts about an hour. You can sit in the back of the room and lease. 10. Carefully. There is no pressure to speak and nobody asks for your last name. Each meeting begins with a long-term member getting up and speaking about his or her personal struggle for recovery from alcoholism. Several other members share their experiences. There is a collection to cover. Expenses, most people give $1. All you have to do is listen carefully. 10. Losers Anonymous 33. And every time you hear the word alcohol, substitute the word loss for it. You will feel as if the people in the meeting are talking about your trading. 10. Losers Anonymous. A social drinker enjoys an occasional drink, but an alcoholic craves alcohol. He denies that alcohol controls and destroys his life until he reaches a personal crisis. It may be a life-threatening illness, unemployment, desertion by a family member, or another unbearably painful event. AA calls it hitting rock bottom. The pain of hitting rock bottom punctures an alcoholic's denial. He sees a stark choice to drown or to turn and swim up for air. His first step to recovery is to admit that he is powerless over alcohol. A recovering alcoholic can never drink again. Loss is to a loser what alcohol is to an alcoholic. A small loss is like a sin. GLE drink. A big loss is like a bender. A series of losses is like an alcoholic binge. A loser keeps switching between different markets, gums, and trading systems. His equity shrinks while he is trying to recreate the pleasurable sensation of winning. Losing traders think and act like alcoholics, except that their speech is not slurred. The two groups are so much alike that you can predict what a loser will do by using alcoholics as a model. Alcoholism is a curable disease, and so is losing. Losers can change if they start using the principles of Alcoholics Anonymous. The urge to trade. Successful traders treat drawdowns the way social drinkers treat alcohol. They have a little and stop. If they take several losses in a row, they take that as a signal that something is wrong. It is time to stop and rethink their analysis or methods. Losers cannot stop. They keep trading because they are addicted to the excitement of the game and keep hoping for a big win. One prominent trading advisor wrote that the pleasure of trading was higher than that of sex or flying jet aircraft. Just as an alcoholic proceeds from social drinking to drunkenness, losers take bigger and bigger risks. They cross the line between taking a business risk and gambling. Many losers do not even know that line exists. 34. Individual psychology. Losers feel the urge to trade, just as alcoholics feel the urge to drink. They make impulsive trades, go on trading binges, and try to trade their way out of a hole. Losers bleed money from their accounts. Most of them bust out, but some turn to managing other people's money after they lose their own. Still others sell advisory services like bummed-out drunks who wash glasses in a bar. Most losers hide their losses from themselves and from everyone else. They keep shuffling money, keep poor records, and throw away brokerage slips. A loser is like an alcoholic who does not want to know how many ounces of liquor he drank into the hole. A loser never knows why he loses. If he knew, he would have done something about it and become a winner. He keeps trading in a fog. A loser tries to manage his trading the way an alcoholic tries to manage his drinking. Losers try to trade their way out of a hole. They switch trading systems, buy new software, or take tips from a new guru. They act out a rescue fantasy, a charming belief in Santa Claus. Their desperate belief in Magic Solu. Tie-ins helps many advisors sell their services to the public. When losses mount and equity shrinks, a loser acts like an alcoholic, threatened with an eviction or firing. A loser grows desperate and converts outright positions into spreads, doubles up on losing positions, reverses, and trades in the opposite direction, and so on. Losers get as much good from these maneuvers as an alcoholic who switches from hard liquor to wine. A losing trader careens out of control, trying to manage the unmanaged. Able. Alcoholics die prematurely, and most traders bust out of the markets and never come back. New trading methods, hot tips, and improved software cannot help you until you learn to handle yourself. You have to change how you think in order to stop losing and begin your recovery as a trader. Losers get DMNK on losses. They're addicted to losses. Traders prefer prof. But even losses provide plenty of excitement. The pleasure of trading is very high. Few losers are actively trying to lose, but then few alcoholics are consciously trying to end up in the gutter. A loser keeps getting high from trading while his equity shrinks. Trying to tell him that he is a loser is like trying to take a bottle away from a drunk. A loser has to hit rock bottom before he can begin to recover. 10. Losers Anonymous 35. Rock bottom. Hitting rock bottom feels horrible. It is painful and humiliating. You hit it. When you lose money, you cannot afford to lose. You hit it when you gamble away your savings. You hit it after you tell your friends how smart you are and later have to ask them for a loan. You hit rock bottom when the market comes roaring at you and yells, "You fool." Some people hit rock bottom after only a few weeks of trading. Others keep adding money to their account to postpone the day of reckoning. It hurts to see a loser in the mirror. We spend our lifetimes building up self-esteem. Most of us have a high opinion of ourselves. It hurts a smart and successful person to hit rock bottom. Tom, your first impulse may be to hide, but remember you are not alone. Almost every trader has been there. Most people who hit rock bottom die as traders. They slink away from the market and never look back. Brokerage records indicate that 90 out of 100 people trading today will probably be gone from the markets a year from now. They will hit rock bottom, crumble, and leave. They will try to forget trading as they would a bad dream. Some losers will lick their wounds and wait until the pain fades away. Then they will return to trading, having learned little. They will be fearful, and their fear will further impair their trading. Very few traders will begin the process of change and growth. For these rare individuals, the pain of hitting rock bottom will interrupt the vicious cycle of getting high from winning and then losing everything and crashing. When you admit that you have a personal problem that causes you to lose, you can begin building a new trading life. You can start developing the discus plan of a winner. The first step, an alcoholic needs to admit that he cannot control his drinking. A trader needs to admit that he cannot control his losses. He needs to admit that he has a psychological problem with the losses and that he is destroying his trading account. The first step of an AA member is to say, "I am an alcoholic. I am powerless over alcohol." As a trader, you have to take your first step and say, "I am a loser. I am powerless over losses." 36. Individual psychology. A trader can recover using the principles of Alcoholics Anonymous. Recovering alcoholics struggle to stay sober one day at a time. Now you have to struggle to trade without losses one day at a time. You may say this is impossible. What if you buy and the market immediately ticks down? What if you sell short at the bottom tick and the market rallies? Even the best traders lose money on some trades. The answer is to draw a line between a businessman's risk and a loss. A trader must take a businessman's risk, but he may never take a loss greater than his predetermined risk. A storekeeper takes a risk every time he stocks new merchandise. If it does not sell, he will lose money. An intelligent businessman takes only risks. That will not put him out of business, even if he makes several mistakes in a row. Stocking 2 crates of merchandise may be a sensible business risk, but stocking a full trailer is probably a gamble. As a trader, you are in the business of trading. You need to define your businessman's risk, the maximum amount of money you will risk on any single trade. There is no standard dollar amount, just as there is no standard business. An acceptable businessman's risk depends, first of all, on the size of your trading account. It also depends on your trading method and pain toll. Irance. The concept of a businessman's risk will change the way you manage your money. See Chapter 10, Risk Management. A sensible trader never risks more than 2% of account equity on any trade. For example, if you have $30,000 in your account, you may not risk more than $600 per trade. And if you have $10,000, you may not risk more than $200. If your account is small, limit yourself to trading less expensive markets or mini contracts. If you see an attractive trade, but your stop would have to be placed where more than 2% of equity would be at risk, pass that trade. Avoid risk. ING more than 2% on a trade the way a recovering alcoholic avoids bars. If you're not sure how much to risk, err on the side of caution. If you blame excess commissions on a broker and slippage on a floor trader, you give up control of your trading life. Try to reduce both, but take responsibility for them. If you lose even $1 more than your business man's risk, including commissions and slippage, you're a loser. Do you keep good trading records? Poor record keeping is a sure sign of a gambler and a loser. Good businessmen keep good records. Your trading records must show the date and price of every entry and exit, slippage, missions, stops, all adjustments of stops, reasons for entering, objectives for. 10. Losers Anonymous 37. Exiting, maximum paper profit, maximum paper loss after a stop was hit, and any other necessary data. If you bail out of a trade within your businessman's risk, it is normal boosie. Ness. There is no bargaining, no waiting for another tick, no hoping for a change. Losing $1 more than your established businessman's risk is like getting drunk, getting into a brawl, getting sick to your stomach on your way home, and waking up in the gutter with a headache. You would never want that to happen. A meeting for one. When you go to an AA meeting, you will see people who have not had a drink in years stand up and say, "Hello, my name is so-and-so, and I am an alcoholic." Why do they call themselves alcoholics after years of sobriety? Because if they think they have beaten alcoholism, they will start drinking again. If a person stops thinking he is an alcoholic, he is free to take a drink, then another, and will probably end up in the gutter again. A person who wants to stay sober must remember that he is an alcoholic for the rest of his life. Traders would benefit from our own self-help organization. I call it Losers Anonymous. Why not Traders Anonymous? Because a harsh name helps to focus attention on our self-destructive tendencies. After all, Alcoholics Anonymous do not call themselves Drinkers Anonymous. As long as you call yourself a loser, you focus on avoiding losses. Several traders have argued against what they thought was the negative thinking of Losers Anonymous. A retired woman from Texas, a highly successful trader, described her approach to me. She is very religious and thinks it would not please the Lord for her to lose money. She cuts her losses very fast because of that. I thought that our methods were similar. The goal is to cut losses due to some objective, external rule. Trading within a businessman's risk is like living without alcohol. A trader has to admit that he is a loser, just as a drunk has to admit that he is an alcoholic. Then he can begin his journey to recovery. This is why every morning before trading, I sit in front of the quote screen in my office and say, "Good morning, my name is Alex, and I am a loser. I have it in me to do serious financial damage to my account." This is like an AA meeting. It keeps my mind focused on the first principles. Even if I take 38 individual psychology, thousands of dollars out of the market today, tomorrow I will say, "Good morning, my name is Alex, and I am a loser." A friend of mine joked, when I sit in front of my quote machine in the morning, I say, "My name is John, and I'm going to rip your throat out." His thinking generates tension. Losers Anonymous. Thinking generates serenity. A trader who feels serene and relaxed can focus on looking for the best and safest trades. A trader who is tense is like a driver who freezes at the wheel. When a sober man and a drunk enter a race, you know who is more likely to win. A drunk may win once in a while thanks to luck, but the sober man is the one to bet on. You want to be the sober man in the race. 11. Winners and losers. We come to the market from different walks of life and bring with us the mental baggage of our upbringing and prior experiences. Most of us find that when we act in the market the way we do in our everyday life, we lose money. Your success or failure in the market depends on your thoughts and feel. Ings. It depends on your attitudes toward gain and risk, fear and greed, and on how you handle the excitement of trading and risk. Most of all, your success or failure depends on your ability to use your intellect rather than act out your emotions. A trader who feels overjoyed when he wins and depressed when he loses cannot accumulate equity because he is controlled by his emotions. If you let the market make you feel high or low, you will lose money. To be a winner in the market, you must know yourself and act coolly and responsibly. The pain of losing scares people into looking for magic meth. ODs. At the same time, they discard much of what is useful in their professional or business backgrounds. Like an ocean. The market is like an ocean. It moves up and down regardless of what you want. You may feel joy when you buy a stock and it explodes in a rally. You may feel drenched with fear when you go short, but the market rises and your equity melts with every uptick. These feelings have nothing to do with the market. They exist only inside you. 11. Winners and losers. 39. The market does not know you exist. You can do nothing to influence it. You can only control your behavior. The ocean does not care about your welfare, but it has no wish to hurt you either. You may feel joy on a sunny day when a gentle wind pushes your sailboat where you want it to go. You may feel panic on a stormy day when the ocean pushes your boat toward the rocks. Your feelings about the ocean exist only in your mind. They threaten your survival when you let your feelings rather than intellect control your behavior. A sailor cannot control the ocean, but he can control himself. He studies currents and weather patterns. He learns safe sailing techniques and gains experience. He knows when to sail and when to stay in harbor. A successful sailor uses his intelligence. An ocean can be useful. You can fish in it and use its surface to get to other islands. An ocean can be dangerous. You can drown in it. The more rational your approach, the more likely you are to get what you want. When you act out your emotions, you cannot focus on the reality of the ocean. A trader has to study trends and reversals in the market the way a sailor studies the ocean. He must trade on a small scale while learning to handle himself in the market. You can never control the market, but you can learn to control yourself. A beginner who has a string of profitable trades often feels he can walk on water. He starts taking wild risks and blows up his account. On the other hand, an amateur who takes several losses in a row often feels so demoralized that he cannot place an order even when his system gives him a strong signal to buy or sell. If trading makes you feel elated or frightened, you cannot fully use your intellect. When joy sweeps you off your feet, you will make irrational trades and lose. When fear grips you, you'll miss profitable trades. A professional trader uses his head and stays calm. Only amateurs become excited or depressed because of their trades. Emotional reactions are a luxury that you cannot afford in the markets. Emotional trading. Most people crave excitement and entertainment. Singers, actors, and professional athletes command much higher incomes in our society than do such mundane workmen as physicians, pilots, or college professors. People love to have their nerves tickled. They buy lottery tickets, fly to Las Vegas, and slow down to gawk at road accidents. 40. Individual psychology. Trading is a heady experience and can be very addictive. Losers who drop money in the markets receive a tremendous entertainment value. The market is among the most entertaining places on the face of the earth. It is a spectator sport and a participant sport rolled into one. Imagine going to a major league ball game in which you are not confined to the bleachers. For a few $100s, you can ran onto the field and join the game. If you hit the ball right, You will get paid like a professional. You would probably think twice before running onto the field the first few times. This cautious attitude is responsible for the well-known beginners. Luck. Once a beginner hits the ball well a few times and collects his pay, he is likely to get the idea that he is better than the pros and could make a good living at it. Greedy amateurs start running out onto the field too often, even when there are no good playing opportunities. Before they know what hit them, a short string of losses destroys their careers. Emotional decisions are lethal in the markets. You can see a good model of emotional trading by going to racetrack, turning around, and watching the humans instead of the horses. Gamblers stomp their feet, jump up and down, and yell at horses and jockeys. Thousands of people act out their emo. Tie-ins. Winners embrace, and losers tear up their tickets in disgust. The joy, the pain, and the intensity of wishful thinking are caricatures of what happens in the markets. A cool handicapper who tries to make a living at the track does not get excited, yell, or bet the bulk of his roll on any race. Casinos love drunk patrons. They pour gamblers free drinks because drunks are more emotional and gamble more. Casinos try to throw out intel. Legend card counters. There is less free liquor on Wall Street than in a casino. But at least here they do not throw you out of the game for being a good trader. In charge of your life. When a monkey hurts its foot on a tree stump, he flies into a rage and kicks the piece of wood. You laugh at a monkey, but do you laugh at yourself when you act like him? If the market drops while you are long, you may double up on your losing trade or else go short, trying to get even. You act emotionally instead of using your intellect. What is the difference between a trader trying to get back at the market and a monkey kicking a tree stump? Acting out of anger, fear, or elation destroys your chance of 11. Winners and losers 41. Success. You have to analyze your behavior in the market instead of acting out your feelings. We get angry at the market. We become afraid of it. We develop silly superstitions. All the while, the market keeps cycling through its rallies and declines like an ocean going through its storms and calm periods. Mark Douglas writes in The Disciplined Trader that in the market, there is no beginning, middle, or end, only what you create in your own mind. Rarely do any of us grow up learning to operate in an arena that allows for complete freedom of creative expression with no external structure to restrict it in any way. We try to cajole or manipulate the market, acting like the ancient emperor Xerxes, who ordered his soldiers to horsewhip the sea for sinking his fleet. Most of us are not aware how manipulative we are, how we buy gain, how we act out our feelings in the market. Most of us consider ourselves the center of the universe and expect every person or group to be either good or bad to us. This does not work in a market, which is completely impersonal. Leston Havens, a Harvard University psychiatrist, writes, cannibalism and slavery are probably the oldest manifestations of human predation and submission. Although both are now discouraged, their continued existence in psychological forms demonstrates that civilization has achieved great success in moving from the concrete and physical to the abstract and psychological, while persisting in the same purposes. Parents threaten their children, bullies hit them, teachers try to bend their will in school. Little wonder that most of us grow up either hiding in a shell or learning how to manipulate others in self-defense. Acting independently does not go to a meeting of Alcoholics Anonymous to learn how to avoid losses or develop your own method for cutting out impulsive trades. 7. Winners think, feel, and act differently than losers. You must look within yourself, strip away your illusions, and change your old ways of being, thinking, and acting. Change is hard, but if you want to be a professional trader, you have to work on changing your personality. 2. Mass psychology. 12. What is price? Wall Street is named after a wall that kept farm animals from wandering away from a settlement at the tip of Manhattan. The farming legacy lives. On in the language of traders. For animals are mentioned especially often on Wall Street, bulls and bears, hogs and sheep. Traders say, bulls make money, bears make money, but hogs get slaughtered. A bull fights by striking up with his horns. A bull is a buyer, a person, who bets on a rally and profits from a rise in prices. A bear fights by striking down with his paws. A bear is a seller, a person who bets on a decline and profits from a fall in prices. Hogs are greedy. They get slaughtered when they trade to satisfy their greed. Some hogs buy or sell positions that are too large for them and get destroyed by a small adverse move. Other hogs overstay their positions. They keep waiting for profits to get bigger, even after the trend reverses. Sheep are passive and fearful followers of trends, tips, and gurus. They sometimes put on a bull's horns or a bear skin and try to swagger. You recognize them by their pitiful bleating when the market becomes volatile. Whenever the market is open, bulls are buying, bears are selling, hogs and sheep get trampled underfoot, and the undecided traders wait on the side lines. Quote machines all over the world show a steady stream of quotes. The latest prices for any trading vehicle. Thousands of eyes are focused on each price quote as people make trading decisions. 44 Mass psychology. Arguing about price. When I ask traders at a seminar, what is price? Some answer, price is a perceived value. Others say, price is what a person at one particular point in time is willing to pay another person for a commodity. Someone says, price is what the last person paid for it. That's the price right now. Another suggests, no, it's what the next person will pay. Traders who cannot give a clear definition of price do not know what they are analyzing. Your success or failure as a trader depends on handling prices, and you had better know what they mean. Some attendees at the seminars I give become agitated as they search for an answer to a seemingly obvious question. Arguments fly back and forth, as in this discussion. I you the worst case example. In a 1929 crash, Singer stock was selling for $100, and all of a sudden there's no bid, no bid, no bid, and somebody comes fourth dash, I gotta sell, what am I bid? And one of the floor clerks said $1, and he got it. He got the stock. Price is what the greater fool is ready to pay. Take the 87 market. All of that 500-point decline, stocks weren't worth any less after the decline than before. So it was the difference in the perception and the willingness of the next person to pay for it. You might carry that one step further. What you're paying for is absolutely worthless. It is just a piece of paper. The only value that it does have is the intrinsic dividend value compared to government paper at that time. It still has the value of whatever anybody will pay you. If no one wants to pay you for it, it has no value. It'll pay you for a yield. What if you trade soybeans? You can eat them. How about a stock that has no yield, but doesn't have assets? The company that issued the stock has value, cash flow. I give you one share of IBM. If no one wants to buy it, you can light a cigarette with it. 12. What is price? 45. There's no such thing that no one wants to buy IBM. There's always a bid and an ask. Take a look at United Airlines. One day, the paper says it's $300, and the next day, it's $150. There's no change in the airline. They're still making the same cash flow. They've still got the same book value and the same assets. What's the difference? The price of stock has very little to do with the company it represents. The price of IBM stock has very little to do with IBM. As I visualize it, the price of stock is connected by a mile-long rubber band to IBM in it. Could be wildly higher and wildly lower. IBM just keeps chugging along, and it's a very, very remote connection. Price is the intersection of supply and demand curves. Each serious trader must know the meaning of price. You need to know what you analyze before you go out and start buying and selling stocks, futures, or options. Resolving conflict. There are three groups of traders in the market: buyers, sellers, and undecided traders. Ask is what a seller asks for his merchandise. Bid is what a buyer offers for that merchandise. Buyers and sellers are always in conflict. Buyers want to pay as little as possible, and sellers want to charge as much as possible. If members of both groups insist on having their way, no trade can take place. No trade means no price, only wishful quotes of buy. Heirs and sellers. A seller has a choice: to wait until prices rise or to accept a lower offer for his merchandise. A buyer also has a choice: to wait until prices come down or to offer to pay more to the sellers. A trade occurs when there is a momentary meeting of two minds. An eager bull agrees to a seller's terms and pays up, or an eager bear agrees to a buyer's terms and sells a little cheaper. The presence of undecided traders puts pressure on both bulls and bears. When a buyer and a seller bargain in private, they may haggle at a 46 mass psychology. Les jours de pace. The two must move much faster when they bargain at the exchange. They know that they are surrounded by a crowd of other traders who may butt in on their deal at any moment. The buyer knows that if he thinks for too long, another trader can step in and snap away his bargain. A seller knows that if he tries to hold out for a higher price, another trader may step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more anxious to accommodate their opponents. A trade occurs when there is a meeting of two minds, a consensus of value. Each tick on your quote screen represents a deal between a buyer and a seller. Buyers are buying because they expect prices to rise. Sellers are sell, ing, because they expect prices to fall. Buyers and sellers trade while surrounded by crowds of undecided traders. They may become buyers or sellers as prices change or as time passes. Buying by bulls pushes markets up. Selling by bears pushes markets down, and undecided traders make everything happen faster by creating a sense of urgency in buyers and sellers. Traders come to the markets from all over the world, in person, via computers, or through their brokers. Everybody has a chance to buy and to sell. Each price is a momentary consensus of value of all market participants, expressed in action. Price is a psychological event, a momentary balance of opinion between bulls and bears. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. Behavior patterns. Huge crowds converge on stock, commodity, and option exchanges, either in person or represented by their brokers. Big money and little money, smart money and dumb money, institutional money and private money, all meet on the exchange floor. Each price represents a momentary consensus of value between buyers, sellers, and undecided traders at the moment of transaction. There is a crowd of traders behind every pattern in the chart book. Crowd consensus changes from moment to moment. Sometimes it gets established in a very low-key environment, and at other times the environ. 13. What is the market? 47. Mint turns wild. Prices move in small increments during quiet times. When a crowd becomes either spooked or elated, prices begin to jump. Imagine bidding for a life preserver aboard a sinking ship. That's how. Prices leap when masses of traders become emotional about trend. An astute trader tries to enter the market during quiet times and take profits during wild times. Technical analysts study swings of mass psychology in the financial markets. Each trading session is a battle between bulls, who make money when prices rise, and bears, who profit when prices fall. The goal of technical analysis is to discover the balance of power between bulls and bears and bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, a wise trader stands aside. He lets bullies fight with each other and puts on a trade only when he is reasonably sure who is likely to win. Prices, volume, and open interest reflect crowd behavior. So do the indicators that are based on them. This makes technical analysis similar to poll tack. Ingenieur Both combine science and art. They are scientific to the extent that we use statistical methods and computers. They are artistic to the extent that we use personal judgment to interpret our findings. 13. What is the market? What is the reality behind market symbols, prices, numbers, and graphs? When you check prices in your newspaper, watch quotes on your screen, or plot an indicator on your chart, what exactly are you looking at? What is the market that you want to analyze and trade? Amateurs act as if the market is a giant happening, a ball game in which they can join the professionals and make money. Traders from a scientific or engineering background often treat the market as a physical event. They apply to it the principles of signal processing, noise reduction, and similar ideas. By contrast, all professional traders know full well what the market is. It is a huge mass of people. Every trader tries to take money away from other traders by outguessing them on the probable direction of the market. The members of the market crowd live on different continents. They are united by modem telecommunity, cations in the pursuit of profit at each other's expense. The market is a huge crowd of people. Each member of the crowd tries to take money away from 48 mass psychology, other members by outsmarting them. The market is a uniquely harsh environment because everyone is against you and you are against everyone. Not only is the market harsh, you have to pay high prices for entering and exiting it. You have to jump over two high barriers, commissions and slip page before you can collect a dime. The moment you place an order, you owe your broker a commission. You are behind the game before you begin. Then floor traders try to hit you with slippage when your order arrives on the floor. They try to take another bite out of your account when you exit your trade. In trading, you compete against some of the brightest minds in the world while fending off the piranhas of commissions and slippage. Worldwide crowds. In the old days, markets were small and many traders knew one another. The New York Stock Exchange was formed in 1792 as a club of 24 brokers. On sunny days, they used to trade under a cottonwood tree, and on rainy days in Frances Tavern. The first thing brokers did after they organized the New York Stock Exchange was to stick the public with fixed commissions. That lasted for the next 180 years. Today, only floor traders meet face-to-face. Most of us are linked to the market electronically. Members of the financial crowd watch the same quotes on their terminals, read the same articles in the financial media, and get similar sales pitches from brokers. These links unite us as members of the market crowd, even if we are thousands of miles away from the exchange. Thanks to modem telecommunications, the world is becoming smaller, and the markets are growing. The euphoria of London flows to New York, and the gloom of Tokyo infects Hong Kong. When you analyze the market, you are analyzing crowd behavior. Crowds behave alike in different cultures on all continents. Social psychologists have uncovered several laws that govern crowd behavior. A trader needs to understand how market crowds influence his mind. Groups, not individuals. Most people feel a strong urge to join the crowd and to act like everybody else. This primitive urge clouds your judgment when you put on a trade. 13. What is the market? 49. Successful trader must think independently. He needs to be strong enough to analyze the market alone and to carry out his trading decisions. If 8 or 10 people place their hands on your head and push you down, your knees will buckle, no matter how strong you are. The crowd may be stupid, but is stronger than you. Crowds have the power to create trends. Never buck a trend. If a trend is up, you should only buy or stand aside. Never sell short because the prices are too high. Never argue with the crowd. You do not have to run with the crowd, but you should never run against it. Respect the strength of the crowd, but do not fear it. Crowds are powerful, but primitive. Their behavior simple and repetitive. A trader who thinks for himself can take money from crowd members. The source of money. When you try to make money trading, do you ever stop to wonder where your expected profits will come from? Is there money in the markets because of higher company earnings or lower interest rates or a good soybean crop? The only reason there is money in the markets is that other traders put it there. The money you want to make belongs to other people who have no intention of giving it to you. Trading means trying to rob other people while they're trying to rob you. It is a hard business. Winning is especially difficult because brokers and floor traders skim money from losers and winners alike. Tim Slater compared trading to a medieval battle. A man used to go on a battlefield with his sword and try to kill his opponent who was trying to kill him at the same time. The winner took the loser's weapons, his chattels, and his wife, and sold his children into slavery. Now we trade on the exchanges instead of doing battle in an open field. When you take money away from a man, it is not that different from drawing his blood. He may lose his house, his chattels, and his wife, and his children may suffer. An optimistic friend of mine once snickered that there are plenty of poorly prepared people on the battlefield. 90 to 95% of the brokers don't know the first thing about research. They don't know what they're doing. We have the knowledge, and some poor people who do not have it are just giving the money away to charity. This theory sounds good, but it is wrong. There is no easy money in the market. There are plenty of dumb sheep waiting to be fleeced or slaughtered. The 50 mass psychology. Sheep are easy, but if you want a piece of their meat, you've got to fight some very dangerous competitors. There are mean professionals, American gunslingers, English knights, German lanzknechts, Japanese samurai, and other warriors, all going after the same hapless sheep. Trading means battling crowds of hostile people while paying for the privilege of entering the battle and leaving it, whether dead, wounded, or alive. Inside information. There's at least one group of people who consistently get information before other traders. Records show that corporate insiders consistently make profits. In the stock market, those records reflect legitimate trades that have been reported by insiders to the Securities and Exchange Commission. They represent the tip of the iceberg, but there is a great deal of illegitimate insider trading in the stock market. People who trade on inside information are stealing money from the rest of us. The insider trials of the 1980s have landed some of the more notorious insiders in jail: Dennis Levine, Ivan Boesky, and others. For a while, hardly a week went by without an arrest, indictment, conviction, or consent decree. The Yuppie Five, Michael Milken, even a psychiatrist in Connecticut, who traded after learning about a pending takeover from a patient. The defendants of the 1980s insider trials were caught because they became greedy and careless and ran into a federal prosecutor in New York with major political ambitions. The tip of the iceberg has been shaved down, but its bulk continues to float. Do not ask whose ship it will hit. It is your trading account. Trying to reduce insider trading is like trying to get rid of rats on a farm. Pesticides keep them under control, but do not root them out. A retired chief executive of a publicly traded firm explained to me that a smart man does not trade on inside information, but gives it to his golfing buddies at a try club. Later, they give him inside information on their companies, and both profit without being detected. The insider network is safe as long as it's MEM. Bears follow the same code of conduct and do not become too greedy. Insider trading is legal in the futures markets. Technical analysis helps you detect insider buying and selling. Charts reflect all trades by all market participants, even by the insiders. They leave their tracks on the charts, just like everyone else, and it is your job as a technical analyst to follow them too. The bank. 14. The trading scene. 51. 14. The trading scene. Humans have traded since the dawn of history. It was safer to trade with your neighbors than to raid them. As society developed, money became the medium of exchange. Stock and commodity markets are among the hallmarks of an advanced society. One of the first economic developments in Eastern Europe following the collapse of communism was the establishment of stock and commodity exchanges. It took Marco Polo, a medieval Italian traveler, 15 years to get from Italy to China. Now, when a European trader wants to buy gold in Hong Kong, can get his order filled in a minute. Today, stock, futures, and options markets span the globe. In India alone, there are 14 stock exchanges. There are over 65 futures and options exchanges in the world, as Barbara Diamond and Mark Collar write in there. Book 24-hour trading, they make markets in nearly 400 contracts, from gold to greasy wool, from Australian All Ordinaries Index to dried silk. Cocoons. All exchanges must meet three criteria, first developed in the ago, ras of ancient Greece and the medieval fairs of Western Europe, and a stab. List location, rules for grading merchandise, and defined contract terms. Individual traders. Private traders usually come to the market after a successful career in Boosie, Ness, or in the professions. An average private futures trader in the United States is a 50-year-old, married, college-educated man. Many futures traders own their own businesses, and many have postgraduate degrees. The two largest occupational groups among futures traders are farmers and engineers. Most people trade for partly rational, partly irrational reasons. Rational reasons include the desire to earn a large return on capital. Irrational reasons include gambling and a search for excitement. Most traders are not aware of their irrational motives. Learning to trade takes hard work, time, energy, and money. Few individuals rise to the level of professionals who can support themselves by trading. Professionals are extremely serious about what they do. They satisfy their irrational goals outside the markets, while amateurs act them out in the marketplace. The major economic role of a trader is to support his broker to help him pay his mortgage and keep his children in private schools. In addition, the 52 mass psychology role of a speculator is to help companies raise capital in the stock market and to assume a price risk in the commodities markets, allowing producers to focus on production. These lofty economic goals are far from a speculator's mind when he gives an order to his broker. Institutional traders. Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend calls some of his best ideas from these reports the substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. It is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they want his orders. When you trade from your house, you're never the first to hear the news, he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before. They exploded. He had gotten a telex from an agent in the area of the fire, well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. See Section 40. Recently, I visited an acquaintance at a multinational oil company. After passing through security that was tighter. 14. The trading scene. 53. Then at Kennedy International Airport, I walked through glass-enclosed COR. Riders, clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, yes. I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating. Based on inside information, employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk. Most individuals do not have the discipline to stop trading when they get on a losing streak, but institutions impose discipline on traders. A trader is given two limits: how much he may risk on a single trade and the maximum amount he may lose in a month. These limits work as stop-loss orders on a trader. With all these advantages, how can an individual trader compete against institutions and win? First, many institutional trading departments are poorly run. Second, the Achilles heel of most institutions is that they often have to trade, while an individual trader is free to trade or stay out of the market. Banks have to be active in the bond market, and food processing companies have to be active in the grain market at almost any price. An individual trader is free to wait for the best trading opportunities. Most private traders fritter away this advantage by overtrading. An individual who wants to succeed against the giants must develop patience and eliminate greed. Remember, your goal is to trade well, not to trade often. Successful institutional traders receive raises and bonuses. Even a high bonus can feel puny to someone who earns many millions of dollars for his firm. Successful institutional traders often talk of quitting and going to trade for themselves. Only a handful of them manage to make the transition. Most traders who leave institutions get caught up in the emotions of fear, greed, elation, and panic when they start risking their own money. They seldom do well trading for their own account. Another sign that psychology is at the root of trading: success or failure. The sword makers, medieval knights, shopped for the sharpest swords, and modern traders shop for the best trading tools. The growing access to data, computers, and software creates a more level playing field for traders. Prices of hardware fall almost monthly, and software keeps getting better. It is easy for even a 54 mass psychology computer literate trader to hire a consultant and set up a system. See Section 24. A computer allows you to speed up your research and follow up on more leads. It is not a substitute for making trading decisions. A computer helps you analyze more markets in greater depth, but the ultimate responsibility for every trade rests with you. There are three types of trading software: toolboxes, black boxes, and gray boxes. A toolbox allows you to display data, draw charts, plot indica, tours, and even test your trading system. Toolboxes for options traders include option valuation models. It is as easy to adapt a good toolbox to your needs as it is to adjust your car seat. What goes inside a black box is secret. You feed it data, and it tells you when to buy and sell. It is like magic, a way to make money without think. Ingenieur. Black boxes usually come with excellent historical track records. This is only natural because they were created to fit old data. Markets keep chong, and black boxes keep blowing up, but new generations of losers keep buying new black boxes. Gray boxes straddle the fence between toolboxes and black boxes. These packages are usually put out by prominent market personalities. They disclose the general logic of their system and allow you to adjust some of their parameters. Advisors. Advisory newsletters are colorful splashes on the trading scene. Freedom of the press allows anyone to put a typewriter on his kitchen table, buy a few stamps, and start sending out a financial advisory letter. Their track records are largely an exercise in futility because hardly anybody ever takes every bit of advice in any newsletter. Some newsletters provide useful ideas and point readers in the direction of trading opportunities. A few offer educational value. Mostly they sell out. Insider's an illusion of being an insider, of knowing what happens or is about to happen in the markets. Newsletters are good entertainment. Your subscription rents you a pen pal who sends amusing and interesting letters and never asks you to write back, except for a check at renewal time. Services that rate newsletters are for-profit affairs run by small business. Men whose well-being depends on the well-being of the advisory industry. 14. The trading scene. 55. Rating services may occasionally tut-tut an advisor, but they dedicate most of their energy to loud cheerleading. I used to write an advisory newsletter, worked hard, did not fudge results, and received good ratings. I saw from the inside a tremendous potential for fudging results. This is a well-kept secret of the advisory industry. When I was getting into letter writing, one of the most prominent advisors told me that I should spend less time on research and more on marketing. The first principle of letter writing is, if you have to make forecasts, make a lot of them. Whenever a forecast turns out right, double the volume of promotional mail. Trading contests. Trading contests are run by small firms or individuals. Contestants pay organizers to monitor their results and publicize the names of winners. Trading contests have two flaws, one mild and another possibly criminal. This is a scandal waiting to be explored by investigative journalists. All contests hide information about losers and tell you only about winners. Each dog has its day in the sun, and most losers have at least one good quarter. If you keep entering contests and taking wild chances, eventually, you will have a winning quarter, reap the publicity, and attract money man. Mon client. Many advisors enter trading contests with a small stake, which they chalk off to marketing expense. If they get lucky, they receive valuable publicity, while their losses are hidden. Nobody hears about a contestant who destroys his account. I know several traders who are so bad they could not trade. Candy with a child. They are chronic losers, but all of them appeared on the list of winners of a major contest with great percentage gain. All traders are in effect betting on the future mood of the crowd. That crowd keeps swinging from indifference to optimism or pessimism, and from hope to fear. Most people do not follow their own trading plans because they let the crowd influence their feelings, thoughts, and actions. Bulls and bears battle in the market, and the value of your investment sinks or soars, depending on the actions of total strangers. You cannot control the markets. You can only decide whether and when to enter or exit trades. Most traders feel jittery when we enter a trade. Their judgment becomes clouded by emotions after they join the market crowd. These crowd-induced emotions make traders deviate from their trading plans and lose money. Experts on crowds. Charles Mackay, a Scottish barrister, wrote his classic book, Extraordinary Popular Delusions and the Madness of Crowds, in 1841. He describes several mass manias, including the tulip mania in Holland in 1634 and the South Seas investment bubble in England in 1720. The tulip craze began as a bull market in tulip bulbs. The long bull market convinced the prosperous Dutch that tulips would continue to appreciate. Many of them abandoned their businesses to grow tulips, trade them, or 15. The market crowd in U57 become tulip brokers. Banks accepted tulips as collateral and speculators profited. Finally, that mania collapsed in waves of panic selling, leaving many people destitute and the nation shocked. Mackay sighed, "Men go mad in crowds, and they come back to their senses slowly and one by one." In 1897, Gustave Le Bon, a French philosopher and politician, wrote The Crowd, one of the best books on mass psychology. A trader who reads it today can see his reflection in a century-old miner. Le Bon wrote that when people gather in a crowd, whoever be the individuals that compose it, however like or unlike be their mode of life, their occupations, their character, or their intelligence, the fact that they have been transformed into a crowd puts them in possession of a sort of collective mind, which makes them feel, think, and act in a manner quite different from that, in which each individual of them would feel, think, and act where he am a state of isolation. People change when they join crowds. They become more credulous and impulsive, anxiously search for a leader and react to emotions instead of using their intellect. An individual who becomes involved in a group becomes less capable of thinking for himself. The experiments of American social psychologists in the 1950s have proven that people think differently in groups than they do alone. For example, an individual can easily tell which of the two lines on a piece of paper is longer. He loses that ability when he is put into a group whose other bears deliberately give wrong answers. Intelligent, college-educated people believe a group of strangers more than they believe their own eyes. Group members believe others, and particularly group leaders, more than they believe themselves. Theodore Adorno and other sociologists showed in their two-volume study, The American Soldier, that the single best predictor of an individual's effectiveness in combat was his relationship with his sergeant. A soldier who trusts his leader will literally follow him to his death. A trader who believes he is following a trend may hold a losing position until his equity is wiped out. Sigmund Freud explained that groups are held together by the loyalty of members to the leader. Our feelings toward group leaders stem from our childhood feelings toward our fathers, a mixture of trust, awe, fear, the desire for approval, and potential rebellion. When we join groups, our ing on issues involving that group regresses to the level of a child. A leader, less group, cannot hold itself together and falls apart. This explains buying and selling panics. When traders suddenly feel that the trend they have been following has abandoned them, they dump their positions in a panic. 58. Mass psychology. Group members may catch a few trends, but they get killed when trends reverse. When you join a group, you act like a child following a parent. Markets do not care about your well-being. Successful traders are independent thinkers. Why join? People have been joining crowds for safety since the beginning of time. If a group of hunters took on a saber-toothed tiger, most of them were likely to survive. A lone hunter had a slim chance of coming out alive from such an encounter. Loners got killed more often and left fewer offspring. Group members were more likely to survive, and a tendency to join groups appears to have been bred into humans. Our society glorifies freedom and free will, but we carry many primitive impulses beneath the thin veneer of civilization. We want to join groups for safety and be led by strong leaders. The greater the uncertainty, the stronger our wish to join and to follow. No saber-toothed tigers roam the canyons of Wall Street, but you probably fear for your financial survival. Your fear swells up because you cannot control changes in prices. The value of your position rises and falls because of buying and selling by total strangers. This uncertainty makes most traders look for a leader who will tell them what to do. You may have rationally decided to go long or short, but the moment you put on a trade, the crowd starts sucking you in. You need to pay attention to several signs that indicate when you start turning into a sweaty crowd BER instead of an intelligent trader. You start losing your independence when you watch prices like a hawk and feel elated if they go your way or depressed if they go against you. You are in trouble when you start trusting gums more than yourself and impulsively add to losing positions or reverse them. You lose your independence when you do not follow your own trading plan. When you notice what is happening, try to come back to your senses. If you cannot regain your calm posture, exit your trade. Crowd mentality. People become primitive and action-oriented when they join crowds. Crowds feel simple but strong emotions such as terror, elation, alarm, and joy. Crowds swing from fear to glee, from panic to mirth. A scientist can be 15, the market crowd, and you 59. Cool and rational in his lab, but make harebrained trades after being swept up in the mass hysteria of the market. A group can suck you in, whether you trade from a crowded brokerage office or from a remote mountaintop. When you let others influence your trading decisions, you lose your chance. of success. Group loyalty is essential for the survival of a military unit. Joining a union can help you keep a job even if your performance is not very good. But no group can protect you in the market. The crowd is bigger and stronger than you. No matter how smart you are, you cannot argue with the crowd. You have only one choice: to join the crowd or to act independently. Many traders are puzzled why markets always seem to reverse immediately after they dump their losing position. This happens because crowd members are gripped by the same fear, and everybody dumps at the same time. Once the fit of selling has ended, the market has nowhere to go but up. Optimism returns to the marketplace, and the crowd feels greedy and goes on a new buying binge. Crowds are primitive, and your trading strategies should be simple. You do not have to be a rocket scientist to design a winning trading method. If the trade goes against you, cut your losses and ran. It never pays to argue with the crowd. Simply use your judgment to decide when to join and when to leave. Your human nature prepares you to give up your independence under stress. When you put on a trade, you feel the desire to imitate others and overlook objective trading signals. This is why you need to develop and follow low trading systems and money management rules. They represent your rational individual decisions made before you enter a trade and become a crowd member who leads. You may feel intense joy when prices move in your favor. You may feel angry, depressed, and fearful when prices go against you, and you may annex. Easily wait to see what the market will do to you next. Traders join crowds when they feel stressed or threatened. Battered by emotions, they lose their independence and begin imitating other group members, especially the group. I see Edgar. When children feel frightened, they want to be told what to do and look up to their parents. They transfer that attitude to teachers, doctors, ministers. 60 mass psychology. Bosses and assorted experts. Traders turn to gurus, trading system vendors, newspaper columnists, and other market leaders. But, as Tony Plummer-Brill brilliantly pointed out in his book, Forecasting Financial Markets, the main leader of the market is price. Price is the leader of the market crowd. Traders all over the world follow the market's upticks and downticks. Price seems to say to traders, follow me, and I will show you the way to riches. Most traders consider themselves independent. Few of us realize how strongly we focus on the behavior of our group leader. A trend that goes in your favor symbolizes a strong, bountiful parent call. ING you to share a meal or risk being left out. A trend that goes against you symbolizes an angry, punishing parent. When you are gripped by these feelings, it is easy to overlook objective signals that tell you to exit. You may feel defiant or bargain or beg forgiveness while avoiding the rational act of accepting your loss and getting out of a losing position. Independence. You need to base your trades on a carefully prepared trading plan and not jump in response to price changes. It pays to write down your plan. You need to know exactly under what conditions you will enter and exit a trade. Do not make decisions on the spur of the moment when you are vulnerable to being sucked into the crowd. You can succeed in trading only when you think and act as an individual. The weakest part of any trading system is the trader himself. Traders fail when they trade without a plan or deviate from their plans. Plans are created by zoning individuals. Impulsive trades are made by sweaty group members. You have to observe yourself and notice changes in your mental state as you trade. Write down your reasons for entering a trade and the rules for getting out of it, including money management rules. You must not change your plan while you have an open position. Sirens were sea creatures of Greek myths who sang so beautifully that sailors jumped overboard and drowned. When Odysseus wanted to hear the siren songs, he ordered his men to tie him to the mast and to put wax in their own ears. Odysseus heard the siren song, but survived because he could not jump. You ensure your survival as a trader when on a clear day. You tie yourself to the mast of a trading plan and money management miles. 16. Psychology of Trends 61. 16. Psychology of Trends. Each price is the momentary consensus of value of all market participants. It shows their latest vote on the value of a trading vehicle. Any trader can put in his 2 cents worth by giving an order to buy or to sell, or by refusing to trade at the current level. Each bar on a chart reflects the battle between bulls and bears. When bulls feel strongly bullish, they buy more eagerly and push markets up. When bears feel strongly bearish, they sell more actively and push markets down. Each price reflects action or lack of action by all traders in the market. Charts are a window into mass psychology. When you analyze charts, you analyze the behavior of traders. Technical indicators help make this analysis more objective. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. Strong feelings. Ask most traders why prices went up, and you're likely to get a stock. Answer: more buyers than sellers. This is not true. The number of trading instruments, such as stocks or futures, bought and sold in any market is always equal. If you want to buy a contract of Swiss francs, someone has to sell it to you. If you want to sell short a contract of the S&P 500, someone has to buy it from you. The number of stocks bought and sold is equal in the stock market. Furthermore, the number of long and short positions in the futures markets is always equal. Prices move up or down because of changes in the intensity of greed and fear among buyers or sellers. When the trend is up, bulls feel optimistic and do not mind paying a little extra. They buy high because they expect prices to rise even higher. Bears feel tense in an uptrend and they agree to sell only at a higher price. When greedy and optimistic bulls meet fearful and defensive bears, the market rallies. The stronger their feelings, the sharper the rally. The rally ends only when many bulls lose their enthusiasm. When prices slide, bears feel optimistic and do not quibble about selling short at lower prices. Bulls are fearful and agree to buy only at a discount. 62. Mass psychology. As long as bears feel like winners, they continue to sell at lower prices, and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Rallies and declines. Few traders act as purely rational human beings. There's a great deal of emotional activity in the markets. Most market participants act on the principle of monkey see, monkey do. The waves of fear and greed sweep up bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, they don't mind shorting on the way down. Fearful buyers agree to buy only below the market. As long as short sellers are willing to meet those demands and sell at a bid, the decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They're so eager to get out that they hit the bids under the market. Markets can fall very fast when hit by panic selling. Trend leaders. Loyalty is the glue that holds groups together. Freud showed that group Members relate to their leader the way children relate to a father. Group 16. Psychology of Trends 63. Members expect leaders to inspire and reward them when they are good, but to punish them when they are bad. Who leads market trends? When individuals try to control a market, they usually end up badly. For example, the bull market in silver in the 1980s was led by the Hunt brothers of Texas and their Arab associates. The Hun ended up in a bankruptcy court. They had no money left even for a limousine and had to ride the subway to the courthouse. Market gurus sometimes lead trends, but they never last beyond one market cycle. See Section 6. Tony Plummer, a British trader, has presented a revolutionary idea in his book, Forecasting Financial Markets, The Truth Behind Tech, and Calais. He showed that price itself functions as the leader of the market crowd. Most traders focus their attention on price. Winners feel rewarded when price moves in their favor, and losers feel punished when price moves against them. Crowd members remain blissful, unaware that when they focus on price, they create their own leader. Traders who feel mesmerized by price swings create their own idols. When the trend is up, bulls feel rewarded by a bountiful parent. The long an uptrend lasts, the more confident they feel. When a child's behavior is rewarded, he continues to do what he did. When bulls make money, they add to long positions and new bulls enter the market. Bears feel our pawn ish for selling short. Many of them cover shorts, go long, and join the bulls. Buying by happy bulls and covering by fearful bears pushes up trends. Higher. Buyers feel rewarded while sellers feel punished. Both feel emotion. Ally involved, but few traders realize that they are creating the uptrend. Eventually price shock occurs. A major sale hits the market and there are not enough buyers to absorb it. The uptrend takes a dive. Bulls feel treated like children whose father hit them with a strap during a meal, but bears feel encouraged. Bete. A price shock plants the seeds of an uptrend reversal, even if the market recovers and reaches a new high. Bulls feel more skittish and bears become bolder. This lack of cohesion in the dominant group and optimism among its opponents makes the uptrend ready to reverse several Techem degree RS. Identify tops by tracing a pattern called bearish divergence. See Section 28. It occurs when prices reach a new high, but the indicator reaches a lower high than it did on a previous rally. Bearish divergences mark the best shorting. Degree P, ride trend is down. Bears feel like good children, praised, and 62 mass psychology. As long as bears feel like winners, they continue to sell at lower prices, and the downtrend continues. It ends when bears start feeling cautious and refuse to sell at lower prices. Rallies and declines. Few traders act as purely rational human beings. There's a great deal of emotional activity in the markets. Most market participants act on the PLE of monkey see, monkey do. The waves of fear and greed sweep up. Bulls and bears. Markets rise because of greed among buyers and fear among short sellers. Bulls normally like to buy on the cheap. When they turn very bullish, they become more concerned with not missing the rally than with getting a cheap price. A rally continues as long as bulls are greedy enough to meet sellers' demands. The sharpness of a rally depends on how traders feel. If buyers feel just a little stronger than sellers, the market rises slowly. When they feel much stronger than sellers, the market rises fast. It is the job of a technical analyst to find when buyers are strong and when they start running out of steam. Short sellers feel trapped by rising markets as their profits melt and turn into losses. When short sellers rush to cover, a rally becomes nearly vertical. Fear is a stronger emotion than greed, and rallies driven by short covering are especially sharp. Markets fall because of greed among bears and fear among bulls. Normally, bears prefer to sell short on rallies, but if they expect to make a lot of money on a decline, They don't mind shorting on the way down. Fearful. Buyers agree to buy only below the market, as long as short sellers are will. ING to meet those demands and sell at a bid. The decline continues. As bulls' profits melt and turn into losses, they panic and sell at almost any price. They're so eager to get out that they hit the bids under the mar. Get. Markets can fall very fast when hit by panic selling. Trend leaders. Loyalty is the glue that holds groups together. Freud showed that group. Members relate to their leader the way children relate to a father. Group 16. Psychology of Trends 63. Members expect leaders to inspire and reward them when they are good, but to punish them when they are bad. Who leads market trends? When individuals try to control a market, they usually end up badly. For example, the bull market in silver in the 1980s was led by the Hunt brothers of Texas and their Arab associates. The Hunts ended up in a bankruptcy court. They had no money left even for a limousine and had to ride the subway to the courthouse. Market gurus sometimes lead trends, but they never last beyond one market cycle. See Section 6. Tony Plummer, a British trader, has presented a revolutionary idea in his book, Forecasting Financial Markets: The Truth Behind Technical Analysis. He showed that price itself functions as the leader of the market crowd. Most traders focus their attention on price. Winners feel rewarded when price moves in their favor, and losers feel punished when price moves against them. Crowd members remain blissfully unaware that when they focus on price, they create their own leader. Traders who feel mesmerized by price swings create their own idols. When the trend is up, bulls feel rewarded by a bountiful parent. The longer an uptrend lasts, the more confident they feel. When a child's behavior is rewarded, he continues to do what he did. When bulls make money, they add to long positions and new bulls enter the market. Bears feel they are being punished for selling short. Many of them cover shorts, go long, and join the bulls. Buying by happy bulls and covering by fearful bears pushes up trends higher. Buyers feel rewarded while sellers feel punished. Both feel emotion, ally involved, but few traders realize that they are creating the uptrend, create ING their own leader. Eventually, a price shock occurs. A major sale hits the market, and there are not enough buyers to absorb it. The uptrend takes a dive. Bulls feel mistreated, like children whose father hit them with a strap during a meal, but bears feel encouraged. A price shock plants the seeds of an uptrend reversal. Even if the market recovers and reaches a new high, bulls feel more skittish and bears become bolder. This lack of cohesion in the dominant group and optimism among its opponents makes the uptrend ready to reverse. Several technical indicators. Identify tops by tracing a pattern called bearish divergence. See Section 28. It occurs when prices reach a new high, but the indicator reaches a lower high than it did on a previous rally. Bearish divergences mark the best shorting opportunities. When the trend is down, bears feel like good children, praised, and 64 mass psychology, rewarded for being smart. They feel increasingly confident, add to their posy. Tie-ins, and the downtrend continues. New bears come into the market. Most people admire winners, and the financial media keep interviewing bears in bear markets. Bulls lose money in downtrends, and that makes them feel bad. Bulls dump their positions, and many switch sides to join bears. Their selling pushes markets lower. After a while, bears grow confident and bulls feel demoralized. Suddenly, a price shock occurs. A cluster of buy orders soaks up all available sell orders and lifts the market. Now bears feel like children whose father has lashed out at them in the midst of a happy meal. A price shock plants the seeds of a downtrend's eventual reversal because bears become more fearful and bulls grow bolder. When a child begins to doubt that Santa Claus exists, he seldom believes in Santa again. Even if bears recover and prices fall to a new low, several technical indicators identify their weakness by tracing a pattern called a bullish divergence. It occurs when prices fall to a new low, but an indicator traces a more shallow bottom than during the previous decline. Bullish divergences identify the best buy. Engineer opportunities. Social psychology. An individual has a free will, and his behavior is hard to predict. Group. Behavior is more primitive and easier to follow. When you analyze markets, you analyze group behavior. You need to identify the direction in which groups run and their changes. Groups suck us in and cloud our judgment. The problem for most analysts is that they get caught in the mentality of the groups they analyze. The longer a rally continues, the more technicians get caught up in bullish sentiment, ignore the danger signs, and miss the reversal. The longer a decline goes on, the more technicians get caught up in bearish gloom and ignore bullish signs. This is why it helps to have a written plan for analyzing the markets. We have to decide in advance what indicators we will watch and how we will interpret them. Floor traders use several tools for tracking the quality and intensity of a crowd's feelings. They watch the crowd's ability to break through recent support and resistance levels. They keep an eye on the flow of paper, cuz tomer orders that come to the floor in response to price changes. Floor 17. Managing versus forecasting B. Traders listen to the changes in pitch and volume of the roar on the exchange floor. If you trade away from the floor, you need other tools for analyzing crowd behavior. Your charts and indicators reflect mass psychology in action. A technical analyst is an applied social psychologist, often armed with a computer. 17. Managing versus forecasting. I once ran into a very fat surgeon at a seminar. He told me that he had lost $250,000 in 3 years trading stocks and options. When I asked him how he made his trading decisions, he sheepishly pointed to his amplitude. He gambled on hunches and used his professional income to support his habit. There are two alternatives to gut feel. One is fundamental analysis. The other is technical analysis. Major bull and bear markets result from fundamental changes in supply and demand. Fundamental analysts follow crop reports, study the actions of the Federal Reserve, track industry utilization rates, and so on. Even if you know those factors, you can lose money trading if you're out of touch with intermediate and short-term trends. They depend on the crowd's emotions. Technical analysts believe that prices reflect everything known about the market, including all fundamental factors. Each price represents the constant SUS of value of all market participants, large commercial interests and small speculators, fundamental researchers, technicians, and gamblers. Technical analysis is a study of mass psychology. It is partly a science and partly an art. Technicians use many scientific methods, including mathematics, concepts of game theory, probabilities, and so on. Many technicians use computers to track sophisticated indicators. Technical analysis is also an art. The bars on a chart coalesce into patterns and formations. When prices and indicators move, they produce a sense of flow and rhythm, a feeling of tension and beauty that helps you sense what is happening and how to trade. Individual behavior is complex, diverse, and difficult to predict. Group behavior is primitive. Technicians study the behavior patterns of market. Crowds, they trade when they recognize a pattern that preceded past market moves. 66. Mass psychology. Poll taking. Political poll taking is a good model of technical analysis. Technicians and poll takers try to read the mass mind. Poll takers do it for political gain, technicians for financial gain. Politicians want to know their chances of being elected or re-elected. They make promises to constituents and then ask poll takers about their odds of winning. Poll takers use scientific methods, statistics, sampling procedures, and so on. They also need a flair for interviewing and phrasing questions. They have to be plugged into the emotional undercurrents of their party. Politik. ING is a combination of science and art. If a poll taker says he is a scientist, Ask him why every major political poll taker in the United States is affiliated with either the Democratic or Republican Party. True science knows no party. A market technician must rise above party affiliation. Be neither a bull nor a bear, but only seek the truth. A biased bull looks at a chart and says, "Where can I buy?" A biased bear looks at the same chart and tries to find where he could go short. A top-flight analyst is free of bullish or bearish bias. There's a trick to help you detect your bias. If you want to buy, turn your chart upside down and see whether it looks like a sell. If it still looks like a buy after you flip it, then you have to work on getting a bullish bias out of your system. If both charts look like a sell, then you have to work on twigging a bearish bias. A crystal ball. Most traders take price swings personally. They feel very proud when they make money and love to talk about their profits. When a trade goes against them, they feel like punished children and try to keep their losses secret. You can read people who sell advisory services or raise money know that good calls attract paying customers, while bad calls are quickly forgotten. My phone rang while I was writing this chap. Dear, one of the famous gums, currently down on his luck, told me that he identified a once-in-a-lifetime buying opportunity in a certain agricultural market. He asked me to raise money for him and promised to multiply it a hundredfold in 6 months. I did not know how many fools he hooked, but dramatic forecasts have always been good for fleecing the public. Use your common sense when you analyze markets. When some new development puzzles you, compare it to life outside the markets. For example, PLE indicators may give you buy signals in 2 markets. Should you buy the market that declined a lot before the buy signal or the one that declined a little? Compare this to what happens to a man after a fall. If he falls down a flight of stairs, he may dust himself off and ran up again. But if he falls out of a 3rd-story window, he's not going to ran anytime soon. He needs 68 mass psychology. Time to recover. Prices seldom rally very hard immediately after a bad decline. Successful trading stands on 3 pillars. You need to analyze the ball. Ants of power between bulls and bears. You need to practice good money management. You need personal discipline to follow your trading plan and avoid getting high in the markets. Classical chart analysis. 18. Charting. Chartists study market action, trying to identify recurrent price patterns. Their goal is to profit from trading when patterns recur. Most chartists work with bar graphs showing high, low, and closing prices and volume. Some also watch opening prices and open interest. Point and figure chartists track only price changes and ignore time, volume, and open interest. Classical charting requires only a pencil and paper. It appeals to visually oriented people. Those who plot data by hand often develop a physical feel for prices. Computers speed charting at a cost of losing some of that feel. The biggest problem in charting is wishful thinking. Convince themselves that a pattern is bullish or bearish depending on whether they want to buy or to sell. Early in this century, Hermann Rorschach, a Swiss psychiatrist, designed a test for exploring a person's mind. He dropped ink on 10 sheets of paper and folded each in half, creating a symmetrical ink blot. Most people who peer at these sheets describe what they see, parts of the anatomy, animals, buildings, and so on. In reality, there are only ink blots. Each person sees what's on his mind. Most traders use charts as a giant Rorschach test. They project their hopes, fears, and fantasies onto the charts. Brief history. The first chartists in the United States appeared at the turn of the century. They included Charles Dow, the author of a famous stock market theory, and 70 classical chart analysis. William Hamilton, who succeeded Dow as the editor of the Wall Street Journal. Dow's famous maxim was the averages discount everything. He meant that changes in the Dow Jones Industrial and Rail averages reflected all knowledge and hopes about the economy and the stock market. Dow never wrote a book, only the Wall Street Journal editorials. Hamilton took over the job after Dow died and struck a blow for charting. When he wrote The Turn of the Tide, an editorial following the 1929 crash, Hamilton laid out the principles of Dow theory in his book, The Stock Market Barometer. Robert Rhea, a newsletter publisher, brought the theory to its pinnacle in his 1932 book, The Dow Theory. The decade of the 1930s was the golden age of charting. Many innovators found themselves with time on their hands after the crash of 1929. Schebaker, Rhea, Elliott, Wyckoff, Gann, and others published their research during that decade. Their work went in two distinct directions. Some, such as Wyckoff and Schebaker, saw charts as a graphic record of supply and demand in the markets. Others, such as Elliott and Gann, searched for a perfect order in the markets, a fascinating but futile undertaking. See Section 6. In 1948, Edwards, who was a son-in-law of Schebaker and McGee published Technical Analysis of Stock Trends. They popularized such concepts as triangles, rectangles, head and shoulders, and other chart formations, as well as support and resistance and trend lines. Other chartists have applied these concepts to commodities. Markets have changed a great deal since the days of Edwards and McGee. In the 1940s, daily volume of an active stock on the New York Stock Exchange was only several hundred shares, while in the 1990s it often exceeds 1 million. The balance of power in the stock market has shifted in favor of bulls. Early chartists wrote that stock market tops were sharp and fast, while bottoms took a long time to develop. That was TME in their deflationary era, but the opposite has been true since the 1950s. Now bottoms tend to form quickly, while tops tend to take longer. The meaning of a bar chart. Chart patterns reflect the tides of greed and fear among traders. This book focuses on daily charts, but you can apply many of its principles to other data. The rules for reading weekly, daily, hourly, or intraday charts are very similar. Each price is a momentary consensus of value of all market participants. 18. Charting 71. S&P 500. Max power of bulls, high. Amateurs, open. Professionals, 12. Max power of bears, low. Hug. Figure 18. 1. The meaning of a bar chart. Opening prices are set by amateurs, whose orders accumulate overnight and hit the market in the morning. Closing prices are largely set by market professionals who trade throughout the day. Note how often open, ING, and closing prices are at opposite ends of a bar. The high of each bar marks the maximum power of bulls during that bar. The low of each bar marks the maximum power of bears during that bar. Slippage tends to be less when you enter or exit positions during short bars, expressed in action. Each price bar provides several pieces of information about the balance of power between bulls and bears. Figure 18. 1. The opening price of a daily or a weekly bar usually reflects the AMA Tour's opinion of value. They read morning papers, find out what happened the day before, and call their brokers with orders before going to work. Amateurs are especially active early in the day and early in the week. Traders who research the relationship between opening and closing prices for several decades found that opening prices most often occur near the high or the low of the daily bars. Buying or selling by amateurs early in the day creates an emotional extreme from which prices recoil later in the day. In bull markets, prices often make their low for the week on Monday, or 393.88, 390.00, 387.08, 384.08, 381.88, 378.00, 375.80, 372.80. 72. Classical chart analysis. Tuesday on profit taking by amateurs, then rally to a new high on Thursday or Friday. In bear markets, the high for the week is often set on Monday or Tuesday, with a new low toward the end of the week on Thursday or Friday. The closing prices of daily and weekly bars tend to reflect the actions of professional traders. They watch the markets throughout the day, respond to changes, and become especially active near the close. Many of them take profits at that time to avoid carrying trades overnight. Professionals, as a group, usually trade against the amateurs. They tend to buy lower openings, sell short higher openings, and unwind their positions as the day goes on. Traders need to pay attention to the relationship between opening and closing prices. If prices closed higher than they opened, then market professionals were probably more bullish than amateurs. If prices closed lower than they opened, then market professionals were probably more bearish than amateurs. It pays to trade with the professionals and against the amateurs. The high of each bar represents the maximum power of bulls during that bar. Bulls make money when prices go up. Their buying pushes prices higher, and every uptick adds to their profits. Finally, bulls reach a point where they cannot lift prices not even by one more tick. The high of a daily bar represents the maximum power of bulls during the day, and the high of a weekly bar marks the maximum power of bulls during the week. The high of a 5-minute bar reflects the maximum power of bulls during that 5-minute period. The highest point of a bar represents the maximum power of bulls during that bar. The low of each bar represents the maximum power of bears during that bar. Bears make money when prices go down. They keep selling short there. Selling pushes prices lower, and every downtick adds to their profits. At some point, they run out of either capital or enthusiasm, and prices stop falling. The low of each bar shows the maximum power of bears during that bar. The low of a daily bar marks the maximum power of bears during that day, and the low of a weekly bar identifies the maximum power of bears ing that week. The closing tick of each bar reveals the outcome of a battle between bulls and bears during that bar. If prices close near the high of the daily bar, it shows that bulls won the day's battle. If prices close near the low of the day, it shows that bears won the day. Closing prices on daily charts of the futures markets are especially important. The amount of money in your account depends on them because your account equity is marked to market each night. The distance between the high and the low of any bar reveals the intent. 18. Charting 73. Sighting of conflict between bulls and bears. An average bar marks a relatively cool market. A bar that is only half as long as average reveals a sleepy, dysenteric market. A bar that is 2 times taller than average shows a boiling market where bulls and bears battle all over the field. Slippage, see section 3, is usually lower in quiet markets. It pays to enter your trades during short or normal bars. Tall bars are good for taking profits. Trying to put on a position when the market is running is like jumping on a moving train. It is better to wait for the next one. Japanese candlesticks. Japanese rice traders began using candlestick charts some 2 centuries before the first chartists appeared in America. Instead of bars, these charts have rows of candles with wicks at both ends. The body of each candle represents the distance between the opening and closing prices. If the closing price is higher than the opening, the body is white. If the closing price is lower, the body is black. The tip of the upper wick represents the high of the day, and the bottom of the lower wick represents the low of the day. The Japanese consider highs and lows relatively unimportant, according to Steve Nyssen, author of Japanese Candlestick Charting Technique. They focus on the relationship between opening and closing prices and on patterns that include several candles. The main advantage of a candlestick chart is its focus on the struggle between amateurs who control openings and professionals who control closings. Unfortunately, most candlestick chartists fail to use many tools of Western analysts. They ignore volume and have no trend lines or technical indicators. These gaps are being filled by modem American analysts such as Greg Morris, whose Candle Power software combines Western technical indicators with classical candlestick patterns. Market profile. This charting technique for tracking accumulation and distribution during each trading session was developed by J. Peter Steidelmayer. Market profile requires access to real-time data, a constant flow of quotes throughout the day. It assigns one letter of the alphabet to each half hour of trading. Each price level reached during that half hour is marked with its own letter. As prices change, more and more letters fill the screen, creating a bell. 74 classical chart analysis. Shape curve. When prices erupt in a trend, market profile reflects that by becoming elongated. Market profile is sometimes combined with liquidity. Data bank. It tracks intraday volume of trading by several groups: floor traders, hedgers, and off-the-floor traders. Efficient markets, random walk, and nature's law. Efficient market theory is an academic notion that nobody can outperform the market because any price at any given moment incorporates all available information. Warren Buffett, one of the most successful investors of our century, commented, "I think it's fascinating how the ruling orthodoxy can cause a lot of people to think the earth is flat. Investing in a market where people believe in efficiency is like playing bridge with someone who's been told it doesn't do any good to look at the cards." The logical flaw of efficient market theory is that it equates knowledge with action. People may have knowledge, but the emotional pull of the crowd often leads them to trade irrationally. A good analyst can detect repetitive patterns of crowd behavior on his charts and exploit them. Random walk theorists claim that market prices change at random. Of course, there's a fair amount of randomness or noise in the markets, just as there is randomness in any other crowd milling around. An intelligent observer can identify repetitive behavior patterns of a crowd and make believe bets on their continuation or reversal. People have memories. They remember past prices, and their memories influence their buying and selling decisions. Memories help create support under the market and resistance above it. Random walkers deny that memo. Rise of the past influence our behavior in the present. As Milton Friedman has pointed out, prices carry information about the availability of supply and the intensity of demand. Market participants use that information to make their buying and selling decisions. For example, consumers buy more merchandise when it is on sale and less when prices are high. Financial traders are just as capable of logical behavior as homemakers. In a supermarket, when prices are low, bargain hunters step in. A shortage can lead to a buying panic, but high prices choke off demand. Nature's law is the rallying cry of a clutch of mystics who oppose random walkers in the financial markets. Mystics claim that there is a perfect order in the markets, which they say move like clockwork in response to immutable natural laws. R.N. Eliot even titled his last book Nature's Law. 19. Support and resistance. 75. The perfect order. Crowd gravitates to astrology and looks for links between prices and the movements of the planets. Most mystics try to hide their astrological bent, but it is easy to draw them out of a shell. Next time someone talks to you about natural order in the markets, ask him about astrology. He will probably jump at the chance to come out of the closet and talk about the stars. Those who believe in perfect order in the markets accept that tops and bottoms can be predicted far into the future. Amateurs love forecasts, and mysticism provides a great marketing gimmick. It helps sell courses, trading systems, and newsletters. Mystics, random walk academics, and efficient market theorists have one trait in common. They are equally divorced from the reality of the markets. Extremists argue with one another, but they think alike. 19. Support and resistance. A ball hits the floor and bounces. It drops after it hits the ceiling. Support and resistance are like a floor and a ceiling, with prices sandwiched between them. Understanding support and resistance is essential for understanding price trends and chart patterns. Rating their strength helps you decide whether the trend is likely to continue or to reverse. Support is a price level where buying is strong enough to interrupt or reverse a downtrend. When a downtrend hits support, it bounces like a diver who hits the bottom and pushes away from it. Support is represented on a chart by a horizontal or near horizontal line connecting several bottoms. Figure 19.1. Resistance is a price level where selling is strong enough to interrupt or reverse an uptrend. When an uptrend hits resistance, it stops or tumbles down like a man who hits his head on a branch while climbing a tree. Resistance is represented on a chart by a horizontal or near horizontal line connecting several tops. It is better to draw support and resistance lines across the edges of kanjis, tie-in areas instead of extreme prices. The edges show where masses of traders have changed their minds, while the extreme points reflect only panic among the weakest traders. Minor support or resistance causes trends to pause, while major support or resistance causes them to reverse. Traders buy at support and sell at resistance, making their effectiveness a self-fulfilling prophecy. 76. Classical chart analysis. 196, 192, 187, 183, 178, 174, 169, 165, 168, 156. Figure 19.1. Support and resistance. Draw horizontal lines through the upper and lower edges of congestion areas. The bottom line marks the level at which buyers over. Power sellers. The upper line identifies resistance, where sellers over. Power buyers. Areas of support and resistance often switch their roles. Note how the level of support in March became the line of resistance in May. The strength of these barriers increases each time prices touch them and bounce away. Beware of false breakouts from support and resistance. The letter F marks false breakouts on this chart. Amateurs tend to follow breakouts, while professionals tend to trade against them. At the right edge of the chart, prices are hitting strong resistance. This is the time to look for a shorting opportunity with a protective stop slightly above the line of resistance. Memories, pain, and regret. Support and resistance exist because people have memories. Our memories prompt us to buy and sell at certain levels. Buying and selling by crowds of traders creates support and resistance. If traders remember that prices have recently stopped falling and turned up from a certain level, they're likely to buy when prices approach that. 19. Support and resistance. 77. Level again. If traders remember that an uptrend has recently reversed after rising to a certain peak, they tend to sell and go short when prices approach that level again. For example, all major rallies in the stock market from 1966 until 1982 ended whenever the Dow Jones Industrial Average rallied to 950 or 1050. The resistance was so strong that traders named it a graveyard in the sky. Once the bulls rammed the market through that level, it became a major support area. Support and resistance exist because masses of traders feel pain and regret. Traders who hold losing positions feel intense pain. Losers are determined to get out as soon as the market gives them another chance. Traders who miss an opportunity feel regret and also wait for the market to give them a second chance. Feelings of pain and regret are mild in trading ranges, where swings are small and losers do not get hurt too badly. Breakouts from trading ranges create intense pain and regret. When a market stays flat for a while, traders get used to buying at the lower edge of the range and shorting at the upper edge. In uptrends, bears who sold short feel pain and bulls feel regret that they did not buy more. Both feel determined to buy if the market gives them a second chance. The pain of bears and regret of bulls make them ready to buy, creating support. During reactions in an uptrend, resistance is an area where bulls feel pain, bears feel regret, and both are ready to sell. When prices break down from a trading range, bulls who bought feel pain, feel trapped, and wait for a rally to let them get out even. Bears regret that they have not shorted more and wait for a rally to give them a second chance to sell short. Bull's pain and bear's regret create resis. Tansei ceiling above the market in downtrends. The strength of support and resistance depends on the strength of feelings among masses of traders. Strength of support and resistance. A congestion area that has been hit by several trends is like a cratered battle field. Its defenders have plenty of cover, and an attacking force is likely to slow down. The longer prices stay in a congestion zone, the stronger the emotional commitment of bulls and bears to that area. When prices approach that zone from above, it serves as support. When prices rally into it from below, it acts as resistance. A congestion area can reverse its role and serve as either support or resistance. Classical chart analysis. The strength of every support or resistance zone depends on three factors: its length, its height, and the volume of trading that has taken place in it. You can visualize these factors as the length, the width, and the depth of a con. Gestion zone. The longer a support or resistance area, its length of time or the number of hits it took, the stronger it is. Support and resistance, like good wine, become better with age. A 2-week trading range provides only minimal support or resistance. A 2-month range gives people time to become used to it and creates intermediate support or resistance, while a 2-year range becomes accepted as a standard of value and offers major support or resistance. As support and resistance levels grow old, they gradually become weaker. Losers keep washing out of the markets, replaced by newcomers who do not have the same emotional commitment to old price levels. People who lost money only recently remember full well what happened to them. They are probably still in the market, feeling pain and regret, trying to get even. People who made bad decisions several years ago are probably out of the markets, and their memories matter less. The strength of support and resistance increases each time that area is hit. When traders see that prices have reversed at a certain level, they tend to bet on a reversal the next time prices reach that level. The taller the support and resistance zone, the stronger it is. A congestion zone is like a tall fence around a property. A congestion zone whose height equals 1% of current market value, 4 points in the case of the S&P 500 at 400, provides only minor support or resistance. A congestion zone that is 3% tall provides intermediate support or resistance, and a congestion zone that is 7% tall or higher can grind down a major trend. The greater the volume of trading in a support and resistance zone, the stronger it is. High volume in a congestion area shows active involvement by traders, a sign of strong emotional commitment. Low volume shows that traders have little interest in transacting at that level, a sign of weak support or resistance. 1. Whenever the trend you are riding approaches support or resistance, tighten your protective stop. A protective stop is an order to sell below the market when you are long, or to cover shorts above the market when you are short. This stop protects you from getting badly hurt by 19. Support and resistance 79. An adverse market move. A trend reveals its health by how it acts when it hits support or resistance. If it is strong enough to penetrate that zone, it accelerates and your tight stop is not touched. If a trend bounces away from support or resistance, it reveals its weakness. In that case, your tight stop salvages a good chunk of profits. 2. Support and resistance are more important on long-term charts than on short-term charts. Weekly charts are more important than dailies. A good trader keeps an eye on several time frames and defers to the longer one. If the weekly trend is sailing through a clear zone, the fact that the daily trend is hitting resistance is less important. When a weekly trend approaches support or resistance, you should be more inclined to act. 3. Support and resistance levels are useful for placing stop-loss and tech profit orders. The bottom of a congestion area is the bottom line of support. If you buy and place your stop below that level, you give the uptrend plenty of room. More cautious traders buy after an upside breakout, and place a stop in the middle of a congestion area. A true upside breakout should not be followed by a pullback into the range. Just as a rocket is not supposed to sink back to its launching pad. Reverse this procedure in downtrends. Many traders avoid placing stops at round numbers. This superstition began with off-the-cuff advice by Edwards and McGee to avoid placing stops at round numbers because everybody was placing them there. Now, if traders buy copper at 92, they place a stop at 89.75 rather than 90. When they sell a stock short at 76, they place a protective stop at 80.25 rather than. You have to give that trend the benefit of the doubt and not be shaken out easily. It pays to buckle your seatbelt and hang on for as long as the trend continues. When you trade in a trading range, you have to be nimble and pilos out your position at the slightest sign of a reversal. Another difference in trading tactics between trends and trading ranges is the handling of strength and weakness. You have to follow strength during trends, buy in uptrends, and sell short in downtrends. When prices are in a trading range, you have to do the opposite, buy weakness and sell strength. 20. Trend and trading range. 6 or 8. V. Ayutvu. NOV deck, tan February bar, FLPR. Figure 21. Trend and trading range. A pattern of lower bottoms and lower tops defines downtrends. Soybeans declined from November until the middle of January. Tom was lower than bottom 2 and peak 3 lower than peak 1. The break of the downtrend line at 0.5 signaled the end of the downtrend. A broken downtrend can lead to either a trading range or an uptrend. The November-January downtrend has dissolved into a trading range, defined by horizontal lines drawn through the low 4 and highs 3 and 6. When a decline from high 6 stopped at a higher low 7 without reach, ING the bottom of the range, you could draw a preliminary uptrend line. A breakout from the range at 0.8 confirmed the beginning of a new uptrend. At the right edge of the chart, prices are hovering just above there. Uptrend line. It is a buying opportunity because the trend is up. The downside risk of a trade can be limited by placing a stop either below the latest low or below the trend line. Notice that daily trading ranges. The distances from highs to lows are relatively narrow. This is typical of a healthy trend. Trends often end after several wide-range days, a sign of blow-off action. 82. Classical chart analysis. Mass psychology. An uptrend emerges when bulls are stronger than bears in their buying forces. Prices up. If bears manage to push prices down, bulls return in force, break the decline, and force prices to a new high. Downtrends occur when bears are stronger and their selling pushes markets down. When a flurry of buying lifts prices, bears sell short into that rally, stop it, and send prices to new lows. When bulls and bears are equally strong or weak, prices stay in a trading range. When bulls manage to push prices up, bears sell short into that rally, and prices fall. Bargain hunters step in and break the decline. Bears cover. Shorts, their buying fuels a minor rally, and the cycle repeats. A trading range is like a fight between two equally strong gangs. They push one another back and forth on a street comber, but neither can control the turf. A trend is like a fight where a stronger gang chases the weaker gang down the street. Every once in a while, the weaker gang stops and puts up a fight, but then is forced to turn and ran again. Prices in trading ranges go nowhere, just as crowds spend most of their time in aimless milling. Markets spend more time in trading ranges than in trends because aimlessness is more common among people than purposeful action. When a crowd becomes agitated, it surges and creates a trend. Crowds do not stay excited for long. They go back to meandering. Professionals tend to give the benefit of the doubt to trading ranges. The hard right edge. Identifying trends and trading ranges is one of the hardest tasks in technical analysis. It is easy to find them in the middle of a chart, but the closer you get to the right edge, the harder it gets. Trends and trading ranges clearly stand out on old charts. Experts show those charts at seminars and make it seem easy to catch trends. Trouble is, your broker does not allow you to trade in the middle of the chart. He says, you must make your trading decisions at the hard right edge of the chart. The past is fixed and easy to analyze. The future is fluid and uncertain. By the time you identify a trend, a good chunk of it is gone. Nobody rings a bell when a trend dissolves into a trading range. By the time you recognize that change, you will lose some money trying to trade as if the market was still. Trending. 20. Trend and trading range 83. Many chart patterns and indicator signals contradict one another at the right edge of the chart. You have to base your decisions on probabilities in an atmosphere of uncertainty. Most people cannot accept uncertainty. They have a strong emotional need to be right. They hang onto losing positions, waiting for the market to turn and make them whole. Trying to be right in the market is very expensive. Professional traders get out of losing trades fast. When the market deviates from your analysis, you have to cut losses without fuss or emotions. Methods and techniques underscore. There is no single magic method for identifying trends and trading ranges. There are several methods, and it pays to combine them. When they confirm one another, their message is reinforced. When they contradict one another, it is better to pass up a trade. 1. Analyze the pattern of highs and lows. When rallies keep reaching higher levels and declines keep stopping at higher levels, they identify an uptrend. The pattern of lower lows and lower highs identifies a downtrend, and the pattern of irregular highs and lows points to a trend. ING range, figure 21. 2. Draw an uptrend line connecting significant recent lows and a down trend line connecting significant recent highs. See section 21. The slope of the latest trend line identifies the current trend. Figures 21, 20-2, 21-1. A significant high or low on a daily chart is the highest high or the lowest low for at least a week. As you study charts, you become better at identifying those points. Technical analysis is partly a science and partly an art. 3. Plot a 13-day or longer exponential moving average. See section 25. The direction of its slope identifies the trend. If a moving average has not reached a new high or low in a month, then the market is in a trad. ING range. 4. Several market indicators, such as MACD, see section 26, and the directional system, section 27, help identify trends. The directional system is especially good at catching early stages of new trends. 84. Classical chart analysis. 5. Tech Jan Fija, SPR has. Figure 22. Trend lines identify trends. The most important message of a trend line is the direction of its slope. When the slope is up, trade that market from the long side. When the slope is down, trade that market from the short side. The uptrend line connecting bottoms 1 and 2 identifies an uptrend. It tells you to trade heating oil only from the long side. Notice that sometimes prices break their uptrend line but later pull back to it from below. 3. This is a superb shorting opportunity. This happens again at point 7, where prices rise to their old uptrend line after breaking it. When you trade in the direction of the trend line, you are usually trad. ING in the direction of the market tide. At the right edge of the chart, you need to look for a shorting opportunity because the trend is down. Do not sell short immediately because prices are too far below their down trend line and your stop would have to be too wide. It is essential to wait for trades with a good risk-reward ratio. Patience is a virtue for a trader. Trade or wait. When you identify an uptrend and decide to buy, you have to decide whether to buy immediately or wait for a dip. If you buy fast, you get in gear with the trend, but your stops are likely to be farther away and you risk more. If you wait for a dip, you will risk less but will have 4 groups of calm. 20. Trend and trading range 85. Petiters. Longs who want to add to their positions, shorts who want to get out. Even traders who never bought and traders who sold too early but are eager to buy. The waiting area for a pullback is very crowded. Markets are not known for their charity, and a deep pullback may well signal the beginning of a reversal. This reasoning also applies to downtrends. Waiting for pullbacks while a trend is gathering steam is an amateur's game. If the market is in a trading range and you are waiting for a breakout, you have to decide whether to buy in anticipation of a breakout during a breakout or on a pullback after a valid breakout. If you trade multiple positions, you could buy a third in anticipation, a third on a breakout, and a third on a pullback. Whatever method you use, there is one money management rule that will keep you out of the riskiest trades. The distance from the entry point to the level of a protective stop should never be more than 2% of your account equity. See Chapter 10. No matter how attractive a trade is, pass it up if it requires a wider stop. Money management tactics are different in trends and trading ranges. It pays to put on a smaller position in a trend, but use a wider stop. Then you will be less likely to get shaken out by reactions while you keep risk under control. You may put on a bigger position in a trading range, but use a tighter stop. Finding good entry points is extremely important in trading ranges. You have to be very precise because the profit potential is so limited. A trend is more forgiving of a sloppy entry, as long as you trade in the direction of the trend. Old traders chuckle. Do not confuse brains with a bull market when you cannot tell whether the market is in a trend or in a trading range. Remember that professionals give the benefit of the doubt to trading ranges. If you're not sure, stand aside. Professionals love trading ranges because they can slide in and out of positions with little risk of being impaled on a trend. Since they pay low or no commissions and suffer little slippage, it is profitable for them to trade in gently fluctuating markets. Those of us who trade away from the floor are better off trying to catch trends. You can trade less frequently during trends, and your account suffers less from commissions and slippage. Conflicting time frames. Most traders ignore the fact that markets usually are both in a trend and in a trading range at the same time. They pick one time frame, such as daily or 86 classical chart analysis, 94, 93, 94, 93, 92, 91, 91, 89, 81, 88, Eurodollars daily, and TAR 5 PR RAG G July FUG, 95, 94, 94, 94, 93, 93, 93, 92, 92, 92, Figure 23. Conflicting trends in different time frames. The weekly chart of Eurodollars shows a perfect uptrend AB. At the same time, the daily chart shows that a downtrend XY is beginning. Which of them will you follow? Contradictory signals in different time frames in the same market are among the most common and thorny dilemmas in trading. You need to watch markets in more than one time frame and know how to handle their conflicting signals. The triple screen trading system helps you solve this problem. See Section 43. 21. Trend lines 87. Hourly and look for trades on daily charts, with their attention fixed on daily or hourly charts. Trend from other time frames, such as weekly or 10-minute. Trends keep sneaking up on them and wreaking havoc with their plans. Markets exist in several time frames simultaneously. See Section 36. They exist on a 10-minute chart, an hourly chart, a daily chart, a weekly chart, and any other chart. The market may look like a buy on a daily chart, but a sell on a weekly chart, and vice versa. Figure 23. The signals in different time frames of the same market often contradict one another. Which of them will you follow? When you're in doubt about a trend, step back and examine the charts in a time frame that is larger than the one you're trying to trade. This search for a greater perspective is one of the key principles of the triple screen trading system. See Section 43. A losing trader often thinks he would be better off if he had a real-time quote machine on his desk. One of the universal fantasies of losers is that They would be winners if they could get their data faster and focused on a shorter time frame. But they lose money even faster with a quote system. When that happens, some losers say they would be better off trading right on the exchange floor without any delay for data transmission. But more than half of floor traders wash out in their first year. Being in the middle of the action does not do losers any good. The conflicting signals in different time frames of the same market are one of the great puzzles in market analysis. What looks like a trend on a daily chart may show up as a blip on a flat weekly chart. What looks like a flat trading range on a daily chart shows rich uptrends and downtrends on an hourly chart, and so on. When professionals are in doubt, they look at the big picture, but amateurs focus on the short-term charts. 21. Trend lines. Charts reveal the actions of bulls and bears. Bottoms of declines show where bears stopped and bulls regained control of the market. Peaks of rallies show where bulls ran out of steam and bears gained control. A line connecting two nearby bottoms shows the lowest common denominator of bullish power. A line that connects two nearby tops shows the lowest common denominator of the power of bears. Those lines are called trend lines. Traders use them to identify trends. 88. Classical chart analysis. When prices rally, draw an uptrend line across the bottoms. When prices decline, draw a downtrend line across the tops. Projecting those lines into the future helps anticipate buying and selling points. The most important feature of a trend line is its angle. It identifies the dominant market force. When a trend line points up, it shows that bulls are in control. Then it pays to buy with a protective stop below the trend line. When a trend line points down, it shows that bears are in control. Then it pays to sell short and protect your position with a stop above the trend line. Trend lines are among the oldest tools of traders. Modem computerized. Tools for identifying trends include moving averages, the directional system, and MECD, Chapter 4. How to draw a trend line. Most chartists draw a trend line through extreme high and low points, but it is better to draw it through the edges of congestion areas. Figure 21.1. Those edges show where the majority of traders have reverse direction. Technical analysis is poll taking, and poll takers want to track opinions of masses, not of a few extremists. Drawing trend lines through the edges of congestion areas is somewhat subjective. You have to watch out for the temptation to slant your ruler. Panic dumping by bulls at the bottoms and panic covering by bears at the tops create extremes, which appear as long tails on the charts. You want to base your trend lines on the edges of congestion areas and not on tails, because tails show little about the crowd other than its tendency to panic. The extreme points are very important, but not for drawing trend lines. Markets usually recoil from those tails, offering opportunities to short-term traders. Figure 21.1. As Steidelmayer pointed out, a bar that looks like a fin sticking out of a tight chart pattern provides a valuable reference point. For short-term traders, markets constantly fluctuate, seeking an area that generates the highest volume of trading. A tail shows that a certain price has been rejected by the market. It usually leads to a swing in the opposite direction. As soon as you recognize a tail, trade against it. Place your protective stop halfway through the tail. If the market starts chewing its tail, it is time to get out. Victor Sperandeo described another method for drawing trend lines in his book, Trader Vic. His technique helps identify reversals of well-established trends. Figure 21.2. Sperandeo draws an uptrend line from the lowest low of the move to the 21. Trend lines 89, 248, 246, 244, 241, 239, 237, 235, 232, 238, 228. Figure 21.1. Trend lines and tails. Draw trend lines through the edges of congestion areas and leave out the extreme prices. Tails are long bars at the ends of trends they spring out. Side of congestion areas. Markets recoil from tails, offering good trading. Opportunities in the opposite direction. Notice how the angles of uptrends tend to recur month after month. Knowing this can help you draw preliminary trend lines. At the right edge of the chart, prices are touching their uptrend line by as soon as you see a bar that fails to reach a new low. Highest minor low prior to the highest high. That line may not pass through. Prices between those 2 points. When that trend line is broken, it gives the first signal of a trend change. The second signal is given when prices retest the recent high and back away from it. The third signal occurs when prices break through the previous minor low. It confirms that the uptrend has reversed. A mirror image of this method applies to downtrends. Rating trend lines. The single most important feature of a trend line is its slope. When a trend line slants up, bulls are in control, and it pays to look for buying opportunity. 90 classical chart analysis. Figure 21, 2, 1, 2, 3 reversal method. Draw a trend line from the highest high, A, to the highest minor high, B, preceding the lowest low, C, so that it does not pass through prices. Between A and B, the break of this trend line, 1, is the first signal of A. Trend change. A test of a recent low, 2, gives the second signal of A. Trend change. This is a good time to start buying. When prices break through their minor high, 3, they will confirm that the trend has reversed. This method, described by Victor Sperandeo, helps catch major reversals rather than shorter-term swings. Ties. When a trend line slants down, bears are in control, and it pays to look for shorting opportunities. You can rate the importance of any trend line by examining 5 factors: the time frame of the trend line, its length, the number of times prices touch it, its angle and volume. The longer the time frame, the more important the trend line. A trend line on a weekly chart identifies a more important trend than a daily trend line. A trend line on a daily chart identifies a more important trend than an hourly trend line, and so on. The longer the trend line, the more valid it is. A short trend line reflects mass behavior over a short period. A longer trend line reflects mass behavior over a longer time. The longer a trend continues, the greater its inertia. A major bull market may follow its trend line for several years. The more contacts between prices and trend line, the more valid that line. 21. Trend lines. 91. When the trend is up, a return to the trend line shows a rebellion among bears. When the trend is down, a rally to the trend line shows a rebellion by the bulls. When prices pull back to a trend line and then bounce away from it, you know that the dominant market group has beaten the rebels. A preliminary trend line is drawn across only 2 points. 3 points of contact make that line more valid. 4 or 5 points of contact show that the dominant market crowd is firmly in control. The angle between a trend line and the horizontal axis reflects the emotional intensity of the dominant market crowd. A steep trend line shows that the dominant crowd is moving rapidly. A relatively flat trend line shows that the dominant crowd is moving slowly. A shallow trend line is likely to last longer, like a turtle racing against a hare. It pays to measure the angle of every trend line and write it down on your chart. Figure 21.1. This can be done using a computer, a protractor, or a Chinese charting tool. Comparing angles of trend lines shows whether the dominant market crowd is becoming more bullish or bearish. It is uncanny how often trend lines trace the same angle time and again in a given market. It may be because the key players seldom change. Sometimes prices accelerate away from their trend line. Then you can draw a new, steeper trend line. It shows that a trend is speeding up, becoming unsustained. Able, figure 21.3. When you draw a new, steeper trend line, tighten your stop. Place it immediately below the latest trend line and adjust that stop at every new bar. The breaking of a steep trend line is usually followed by a sharp reversal. When the trend is up, volume normally expands when prices rally and shrinks when they decline. This shows that rallies attract traders while declines leave them cold. The opposite occurs in downtrends. Volume expands on declines and shrinks on rallies. A pullback on heavy volume threatens a trend line because it shows that the rebellious crowd is growing. If volume expands when prices move in the direction of a trend line, it confirms that trend line. If volume shrinks when prices pull back to a trend line, it also confirms the trend line. If volume expands when prices return to a trend line, it warns of a potential break. If volume shrinks when prices pull away from a trend line, it warns that the trend line is in danger. Trend line breaks. The breaking of a well-established trend line shows that the dominant market crowd has lost its power. You have to be careful not to anticipate trading signals. Most traders lose money when they jump the gun. 92 Classical Chart Analysis. Figure 21.3. When trend lines accelerate. The stock market rose slowly but steadily from its 1987 bottom. You could buy each time prices touched their shallow uptrend line. 1. The uptrend accelerated in 1988, and at point A, a new uptrend line, 2, had to be drawn. When a new, steeper trend line was broken, it indicated that the bull move was over. The market offered, as it sometimes does, an excellent shorting opportunity at point B when it pulled back to its old uptrend line before crashing. A trend line is not a glass floor under the market. One crack and it is gone. It is more like a fence that bulls or bears can lean on. They can even violate it a bit without toppling it, the way animals shake a fence. A trend line break is valid only if prices close on the other side of a trend line. Some traders insist that a trend line has to be penetrated by 2 or 3 percentage points of price, $8 to $12 in the case of $400 per Oz gold. After a very steep uptrend is broken, prices often rally again, retest their old high, and touch their old uptrend line from below, figures 22, 21 to 3. When that happens, you have a near-perfect shorting opportunity, a combination of a double top, a pullback to an old trend line, and perhaps a bearish divergence from technical indicators. The reverse also applies to down trends. 21. Trend lines 93. Trading rules. 1. Trade in the direction of the slope of a trend line. If it points up, look for buying opportunities and avoid shorting. When the slope is down, trade from the short side and avoid buying. 2. A trend line provides support or resistance. When prices rise, place buy orders at the uptrend line and protective orders below. Reverse the procedure in downtrends. 3. Steep trend lines precede sharp breaks. If a trend line is steeper than 45 degrees, place your stop right at the trend line and adjust it daily. For prices often retest their latest extreme after breaking a steep trend line. A pullback rally to an old high on falling volume and with indicator divergences provides an excellent shorting opportunity. A decline to an old low after a downtrend line is broken provides a low-risk buying opportunity. 5. Draw a channel line parallel to a trend line and use it as a target for profit-taking. Trend line channels. A channel consists of 2 parallel lines that contain prices, figure 21.4. If you draw an uptrend line across the bottoms of reactions, you could draw a channel line parallel to it across the tops of rallies. When you draw a down trend line across the tops of rallies, you can also draw a channel line parallel to it across the bottoms of declines. Channel lines, like trend lines, should be drawn across the edges of congestion areas, leaving out the extreme highs and lows. The presence of a channel line reinforces the validity of the trend line itself. The validity of channel lines depends on how many times they were touched by prices. A channel line marks the area of bull's maximum power in an uptrend and bear's maximum power in a downtrend. The wider the channel, the stronger the trend. It pays to trade in the direction of the channel's slope going long, in the lower quarter or half of a rising channel, and selling short in the upper quarter or half of a falling channel. Profits should be taken at the opposite channel wall. See also section 45. 94 Classical Chart Analysis. 300, 290, 280, 270, 20, 250, 240, 230, 220, 210. Figure 21, 4. Trendline channels and preliminary trend lines. The downtrend line 1, drawn across rally peaks, identifies a bear market. In corn, a channel line 2 is drawn across the lows, parallel to the trend line. The channel line helps track the maximum power of bears in A. Downtrend. The best shorting opportunities are in the upper half of A. Falling channel, while the best buying opportunities are in the lower half of a rising channel. When prices break out above their downtrend line, channels can help. You draw a preliminary uptrend line. First, draw a new channel line 3, 2. Connect the last 2 rally tops. Then draw a line 4 parallel to it, touching the latest bottom. This is the new preliminary uptrend line. At the right edge of the chart, corn is trending higher. It is expensive near its upper channel line. If you want to go long, place an order to buy in the vicinity of a new uptrend line 4. A preliminary trend line. Normally, a trend line touches at least 2 points on a chart. There is a little known technique for drawing a preliminary trend line through only 1 point. Figure 21, 4. When prices break their downtrend and rally above it, you can assume that the downtrend has ended and a new uptrend may begin. Connect the 2 latest peaks. This is the channel line of the new uptrend. Draw a line parallel 22, caps 95, to it through the latest low. This preliminary uptrend line, drawn parallel to A channel line, tells you where to expect the next bottom. It often points to excellent buying opportunities. This procedure tends to work better at bottoms and the tops. More on trend lines. When prices break their uptrend, measure the vertical distance from the trend line to the latest top and project it down from the breaking point. If the crowd can become optimistic enough to swing prices so many dollars above the trend line, then it is likely to become equally pessimistic and swing prices the same distance down from the trend line. Reverse this procedure in down trends. This method gives you the minimum target for a new move, which is often exceeded. Trend lines can also be applied to volume and to indicators. The slope OT. A trend line of volume shows whether more or fewer people are becoming involved in the market. A rising trend line of volume confirms the current price trend. A falling trend line of volume shows that the market crowd is refusing to follow the current price trend. Among technical indicators, the Relative Strength Index, see Section 31, is especially well suited for trend line analysis. It often breaks its trend lines in advance of prices, providing an early warning of a trend change. 22. Caps. A gap is a chart pattern that consists of 2 adjacent bars with a low of. One bar is higher than the high of the other bar. Figure 22, 1. It shows that no trades took place at a certain price, only at higher and lower levels. Webster's dictionary defines gap. 1. A hole or opening, as in a wall or fence, made by breaking or parting, breach. 2. An interruption of continuity. In space or time, hiatus, lacuna. Gaps occur when prices jump in response to a sudden imbalance of buy or sell orders. A scary piece of news often triggers gaps. Gaps on daily charts show reactions to events that took place while the market was closed. Had the news come out during trading hours, a gap might have occurred only on intraday charts and perhaps have led to a wider daily range. For example, a strike at a major copper mine is bullish for copper. If the news comes out in the evening, the shorts become frightened and want to. 96. Classical chart analysis. Cover. They flood the pit with buy orders before the opening bell. Floor. Traders respond by opening copper above the previous day's high. The smart money, incidentally, has probably bought copper before the strike was announced. Smart money tends to put on trades when markets are quiet, but amateurs tend to jump on the news. Gaps show that the trading crowd is spooked, that losers are getting hurt, and dumping their positions. When you know that bulls or bears are hurting, you can figure out what they are likely to do next and trade accordingly. Some gaps are valid, others are phony. Valid gaps occur when the market skips a price level. Phony gaps occur when a financial instrument trades in another market while the market you analyze is closed. For example, daily charts of Chicago currency futures are full of phony gaps. Currencies trade in Tokyo, London, and elsewhere while the Chicago Mercantile Exchange is 22. Gaps 97. Figure 22.1. Gaps. Cover this chart with a sheet of paper and slide it slowly from left to right. A breakaway gap. Sell short and place a stop a few ticks above the gap's upper rim. B. An exhaustion gap, prices pull back into it the next day. The down trend is over. Cover shorts immediately. C. Another exhaustion gap, marked by a lack of new highs after the gap. Several days of churning offer good shorting opportunities with a stop above the high. D. A continuation gap in a downtrend. Go short with a stop a few ticks above the gap's upper rim. Prices hit that stop a few days later now. Method is fail-safe. E. An exhaustion gap closed 2 days after it opened. Cover shorts immediately. F. A common gap in the midst of a congestion area, close the next day. No action recommended. G. A breakaway gap. Go long and place a protective stop a few ticks below the gap's lower rim. H. A continuation gap. Add to longs and place a protective stop a few ticks below the gap's lower rim. The gap at the right edge of this chart could be either a continuation or an exhaustion gap. Relatively quiet. Volume suggests continuation. If you buy, place a protective stop a few ticks below the lower rim of this gap. Closed. When the exchange reopens, its prices gap simply to reflect price changes overseas. All gaps can be divided into 4 major groups: common, breakaway, continuation, and exhaustion. You need to identify them because each tells a different story and calls for different trading tactics. Common gaps. Common gaps are rapidly closed, prices return into the gap within a few days. Common gaps usually occur in quiet, trendless markets. They are seen in futures contracts for late delivery, in thinly traded stocks, and it's sold out. Low volume market bottoms. 98. Classical chart analysis. Common gaps show no follow-through, no new highs after an upside gap or new lows after a downside gap. Volume may slightly increase on the day of a common gap, but the following days show a return to average vol. UME. The lack of new highs or lows and indifferent volume show that neither bulls nor bears have strong feelings about the market. Common gaps are the least useful of all gaps for trading. Common gaps occur more often than other gaps. It takes very little to create them in a dull market. A COMEX floor trader at one of our seminars spoke of how he could push gold up or down $2 an ounce on a quiet day. He was known as a big trader, and if he suddenly began bidding for 20 contracts at a time, other floor traders stepped back, figuring he knew something. Gold would gap up, and the trick for him was to sell before that gap was closed. An ex-dividend gap is a common gap that occurs in the stock market on the day a dividend becomes payable. For example, if the dividend is 50 cents, then each share is worth 50 cents less after that dividend is paid. This is similar to a drop in the price of a cow after it delivers a calf. Once the calf is BOM, the price of the cow falls by the amount of the calf's price because it is no longer included with the cow. Ex-dividend gaps were common in the old days. Today, the average daily range of a dividend-paying stock is greater than the amount of its dividend, and the ex-dividend drop seldom results in a gap. Breakaway gaps. A breakaway gap occurs when prices leap out of a congestion zone on heavy volume and begin a new trend. A breakaway gap can remain open for weeks or months and sometimes years. The longer the range that preceded the gap, the longer the subsequent trend. An upside breakaway gap is usually followed by new highs for several days in a row, and a downside breakaway gap is followed by a series of new lows. There's a sharp increase in volume on the day of the breakaway gap, and for several days after that. Volume on the day of the gap may be twice as High is the average volume for the previous few days. A breakaway gap marks a major change in mass mentality. It reveals a great pressure behind the new trend. The sooner you jump aboard the new trend, the better. Most gaps are common gaps that are quickly closed. Professional traders like to fade them, trade against gaps. You have to be careful because if you do it mechanically, sooner or later a breakaway gap will clobber you. It takes deep pockets to hold a losing position for months, waiting for a gap to close. 22. Gaps 99. Continuation gaps. A continuation gap occurs in the midst of a powerful trend, which continues. To reach new highs or new lows without filling the gap is similar to a breakaway gap, but occurs in the middle of a trend rather than in the beginning. Continuation gaps show a new surge of power among the dominant market crowd. The inflationary bull markets in commodities in the 1970s had many of them. A continuation gap can help you estimate how far a trend is likely to carry. Measure the vertical distance from the beginning of a trend to the gap, and then project it from the gap in the direction of the trend. When the market approaches that target, it is time to begin taking profits. Volume confirms continuation gaps when it jumps at least 50% above the average for the previous few days. If prices do not reach new highs or new lows for several days after a gap, you're probably dealing with a treacherous exhaustion gap. Exhaustion gaps. An exhaustion gap is not followed by new highs during uptrends or new lows. During downtrends, prices churn and then return into the gap and close it. Exhaustion gaps appear at the ends of trends. Prices rise or fall for several weeks or months and then gap in the direction of the trend. At first, an exhaustion gap looks like a continuation gap, a leap in the direction of the trend on heavy volume. If prices fail to reach new highs or new lows for several days after the gap, it is probably an exhaustion gap. An exhaustion gap is confirmed only when prices reverse and close it. This gap is like the last spurt of a tired athlete. He springs away from the pack but cannot sustain the pace. As soon as others close in on him, you know that he will lose the race. Trading rules. 1. Common gaps do not offer good trading opportunities, but if you must trade, fade them. If prices gap up, sell short as soon as the market stops reaching new highs and place a protective stop above the high of the past few days. Cover shorts and take profits at the lower rim of the 2. Classical chart analysis. Gap. If prices gap down, go long as soon as the market stops reaching new lows and place a protective stop below the low of the past few days. Place an order to sell and take profits at the upper rim of the gap. 2. If a market gaps out of a long trading range on a burst of volume and continues to make new highs or lows, you're probably dealing with a breakaway gap. If prices have gapped to the upside, buy and place a protective stop at the lower rim of the gap. A valid breakaway gap almost never gets closed. Reverse the procedure in downtrends. Waiting for a pullback when a new trend has just begun may leave you on the sidelines. 3. Trading a continuation gap is similar to trading a breakaway gap. Buy early and place a protective stop at the lower rim of the gap. Reverse the procedure in downtrends. Tighten your stops when a trend approaches its target as projected by the continuation gap. 4. A valid breakaway or continuation gap must be confirmed by a series of several new highs or lows. Otherwise, you may be dealing with an exhaustion gap. If the market refuses to reach new highs or lows in the direction of the gap, exit your trade and reevaluate the market from the sidelines. 5. Exhaustion gaps offer attractive trading opportunities because they are often followed by violent reversals. When you identify an upside exhaustion gap, sell short and place a protective stop above the latest high. Once prices begin to slide, weak bulls will start bailing out. Stay short as long as prices continue to reach new lows and cover the day. After prices fail to make a new low, reverse the procedure in down trends. Because of high volatility, exhaustion gaps are easier to trade. using options, especially buying puts at the tops. More on gaps. An island reversal is a combination of a continuation gap and a breakaway. Gap in the opposite direction. An island reversal looks like an island. SEPA, rated from the rest of price action by a gulf in which no trading took place. It begins as a continuation gap, followed by a compact trading range with high trading volume. Then prices gap in the opposite direction and leave behind an island of prices. This pattern occurs very seldom, but it marks major reversal areas. Trade against the trend that preceded an island. 23. Chart Patterns 101. It pays to watch for gaps in related markets. If gold shows a breakaway gap but silver and platinum do not, then you may get a chance to position for a catch-up move in a market that has not yet become frenzied. Gaps can serve as support and resistance levels. If greater volume occurred after an upside gap, it indicates very strong support. If greater vol UME occurred before the gap, then support is less strong. Technical indicators help identify types of gaps. The force index, see Section 42, is based on price and volume. If force index shows only a minor change on the day of a gap, it is probably a common gap. When force index reaches a record high or a low level for several weeks, it confirms break away and continuation gaps. Intraday charts show many opening gaps when prices open outside the previous day's range. When there is an imbalance of public buy and sell orders before the opening, floor traders open markets higher or lower. If outsiders want to buy, floor traders sell to them at such a high price that the slightest dip will make them money. If customers want to sell, floor traders will take merchandise off their hands at a price that is low enough to profit from the slightest bounce. Professionals play it cool. They know that crowds seldom stay excited for long, and prices tend to pull back into yesterday's range. They sell above that range or buy below, waiting to unwind their posy tie-ins and take profits when the opening gap is closed. If you trade the S&P 500 futures, remember that their opening gaps are almost always closed. If the S&P 500 futures open higher, they almost always sink during the day and touch their previous day's high. If they open lower, they almost always rally during the day and touch their previous day's low. Savvy day traders tend to sell short higher openings and buy lower openings. This is not a mechanical method. You have to buy or sell only after indicators tell you that the force behind the opening gap has been spent and the market is ready to close the gap. 23. Chart patterns. The patterns you see on your chart or computer screen are the trails left by bulls and bears. A chartist is a hunter who follows subtle signs, visible only to those who know what to look for. Chart patterns can help you decide when a trend is likely to continue or to reverse. There are two main groups of patterns: continuation and reversal. Continuation patterns include flags and pennants. They suggest trading in 102 classical chart analysis, the direction of the current trend. Reversal patterns include head and shoulders, inverse head and shoulders, and double tops and bottoms. They indicate it's time to take profits on existing positions. Some patterns can serve as either continuation or reversal formations. Triangles and rectangles are notorious for doing that double duty. When several chart patterns point in the same direction, their signals are reinforced. For example, if an uptrend line gets broken when a head and shoulders top is being completed, they both confirm that the uptrend is end. ING. When different patterns give conflicting messages, their signals cancel one another, and it is better not to trade. Head and shoulders tops. A healthy uptrend moves up in steps. Most rallies reach higher peaks than the preceding rally, and declines stop at a higher level than the previous decline. When an uptrend fails to reach a higher high or a decline falls below the previous low, it shows that bulls are losing their grip. Head and shoulders tops mark the ends of uptrends. Figure 23.1. The head is a price peak surrounded by two lower peaks or shoulders. A neckline connects the lows of declines from the left shoulder and the head. The neckline does not have to be horizontal. It may be flat, rising, or falling. A downsloping neckline is especially bearish. It shows that bears are becoming stronger. When prices fail to rally above the head, they confirm that a head shoulder's top is developing. The right shoulder may be higher or lower than the left and may be shorter or longer. The decline from the right shoulder breaks the neckline. When that happens, the uptrend is dead. After breaking the neckline, prices sometimes pull back to it on low vol. UME. This feeble rally offers an excellent shorting opportunity with a logical stop just above the neckline. Head and shoulders tops often have typical volume patterns. Volume is often lower on the head than on the left shoulder. It is even lower on the right shoulder. Volume tends to increase when prices break the neckline. When prices pull back to it, volume is very thin. A head and shoulders pattern provides an approximate target for the new downtrend. You can obtain it by measuring the distance from the top of the head to the neckline and projecting this down from the neckline. An uptrend remains health K longest each new Raj carat reaches _Ju. High. Rising volume confirms rallies /Talumfaliz when prices reach the Taya 3H and flashes a warning to tighten stops on long positions. The decline from the head breaks the uptrend line and signals that the uptrend is over. The head, in this case, is an island reversal. See gaps, section 22, a very bearish pattern. Volume shoots up ominously during the decline from the head. The right shoulder, RS, is much smaller than the left, another sign of weakness. Low volume on the right shoulder also points to a good shorting opportunity. The decline from the right shoulder breaks the neckline. This completes the head and shoulders pattern. There is an excellent shorting opportunity when prices pull back to the neckline from below on low volume. The distance from the top of the head to the neckline, A pro. Vita is a target for the decline. B. At the right edge of the chart, hold shorts. Because prices continue to fall on rising volume and have not reached their target, place a protective stop at the top of the past 5 days range. 104 Classical Chart Analysis. Trading rules. Once you identify a head and shoulders top, you need to make 2 trading decisions: what to do about your long position and how to go about shorting. You have 3 choices for managing your longs: sell them outright, tighten your stops, or sell some and hold the rest. Many traders take the 4th choice. They simply freeze and do nothing. Trading is a complex, non-trivial game that demands making decisions in an atmosphere of uncertainty. Your decision depends on how certain you feel about the pattern. It also depends on the size of your account. A large account allows you to buy and sell gradually. Having to trade a single contract in a small account demands precise timing. Is a good school for a beginning trader. You must analyze your charts in more than one time frame. See section 36. If weekly charts are toppy, a head and shoulders pattern on the dailies should prompt you to run for the exit. If weeklies are strong, then it is often better to simply tighten the stops. Technical indicators can also help you decide how urgent it is to sell. Markets often are more volatile at tops, with wide swings between short-term highs and lows. Selling short and placing a stop above the latest high may expose you to more risk than the maximum amount allowed per con. Tracking your account. See Chapter 10. You may have to pass up the trade or buy puts to keep your monetary risk within allowed limits. 1. Sell when you recognize the head or the right shoulder of head and shoulders pattern based on low volume, a break of an uptrend, and a divergence between indicators and prices. 2. The decline from the head establishes a neckline. If you still hold a long position, place a stop below the neckline. 3. The rally to the right shoulder is usually marked by low volume and glaring weakness in technical indicators. It offers the last good opportunity to cash out of the uptrend. Technical indicators often reach higher levels on the right shoulder than on the head, but they never exceed the levels reached during the left shoulder. When you sell short into the right shoulder, place your stop at the top of the head. Make That order, stop and reverse. If stopped out of the short position, reverse and go long. See the Hound of the Baskervilles signal. 23. Chart patterns 105. 4. Once the neckline is broken, a pullback on low volume offers an excellent shorting opportunity with a protective stop slightly above the neckline. The Hound of the Baskervilles. This signal occurs when a reliable chart or indicator pattern does not lead to the action you expect and prices move in the opposite direction. A head shoulders pattern indicates that the uptrend is over. If prices continue to rise, they give the Hound of the Baskervilles signal. This signal is named after the story by Sir Arthur Conan Doyle in which Sherlock Holmes was called to solve a murder at a country estate. He found the essential clue when he realized that the family dog did not bark while the murder was being committed. That meant the dog knew the criminal and the murder was an inside job. The signal was given by the lack of expected action, by the lack of barking. When the market refuses to bark in response to a perfectly good signal, give you the Hound of the Baskervilles signal. This shows that something is fundamentally changing below the surface. Then it is time to gain gear with the new powerful trend. A head and shoulders pattern gives a strong sell signal. If the market refuses to collapse but rallies from the right shoulder, it gives you its Hound of the Baskervilles signal. When pieces rise above the head, it is time to cover shorts, reverse, and go long. An aborted head and shoulders top often leads to a very strong rally. By the upside breakout and place a protective stop slightly below the top of the head. Inverse head and shoulders. Some traders call this pattern a head and shoulders bottom, a mirror image of a head and shoulders top. It looks like a silhouette of a person upside down, the head at the lowest point, surrounded by two shoulders. This turn develops when a downtrend loses its force and gets ready to reverse. Figure 23.2. In a valid downtrend, each new low falls lower than the previous low, and each rally stops at a lower level. A strong rally from the head allows you to 106 classical chart analysis. Figure 23.2. Inverse head and shoulders. While the downtrend is in effect, high volume confirms all declines until the left shoulder, LS. The decline into the head, H, comes on low vol. UMEA, warning to the bears. The rally out of the head breaks above the downtrend line and signals that the downtrend is over. Low volume during the right shoulder, RS, and the upward sloping neckline indicate that a powerful rally is coming. The burst of volume during the neckline break confirms the new uptrend. No pullback ever reached this neckline. The preliminary target, B, is as high above the neckline as the head of the pattern, A, is below it. It is common for rallies out of head and shoulders bottoms to exceed their targets. The best buying opportunity was at the right shoulder with a protective stop a few ticks below the head. At the right edge of the chart, a gap confirms a strong uptrend. Place a protective stop on long positions a few ticks below the gap's lower rim. Draw a neckline. When a decline from the neckline fails to reach the level of the head, it creates the right shoulder. When prices rally from the right shoulder, 23. Chart patterns 107. Above the neckline on increased volume, they complete the head and shoulders bottom and a new uptrend begins. Sometimes a head and shoulders bottom is followed by a pullback to the neckline on low volume, offering an excellent buying opportunity. Measure the distance from the bottom of the head to the neckline and project it upward from the point where the neckline was broken. This gives you a minute. I'm a measurement for a rally, which is frequently exceeded. The tactics for trading inverse head and shoulders is similar to head and shoulders tops. You risk less money trading at bottoms because prices are less volatile and you can use closer stops. Rectangles. A rectangle is a chart pattern that contains price movements between two parallel lines. They're usually horizontal, but can sometimes slant up or down. See lines and flags later in this section. Rectangles and triangles can serve as continuation or reversal patterns. You need 4 points to draw a rectangle. The upper line connects to rally tops and the lower line connects two bottoms, figure 23-3. These lines should be drawn through the edges of congestion areas rather than across the extreme highs and lows, see section 19. The upper line of a rectangle identifies resistance, while the lower line identifies support. The upper line shows where bulls ran out of steam. The lower line shows where bears become exhausted. A rectangle shows that bulls and bears are evenly matched. The key question is whether bulls or bears will eventually win the battle within this pattern. If volume swells when prices approach the upper border of a rectangle, an upside breakout is more likely. If volume increases when prices approach the lower border, a downside breakout is more likely. A valid breakout from a rectangle is usually confirmed by an increase in volume, 1/3 to 1/2 higher than the average of the previous 5 days. If volume is thin, it is likely to be a false breakout. Rectangles tend to be wider in uptrends and narrower in downtrends. The longer a rectangle, the more significant a breakout. Breakouts from rectangles on weekly charts are especially important because they mark important victories for bulls or bears. There are several techniques for projecting how far a breakout is likely to go. Measure the height of a rectangle and project it from the broken wall in 108 classical chart analysis. 92.6b, 92.40, 92.20, 92 to E, 91.80, 91.60, 91.40, 91.20, 9i.e, 90.80. Figure 23-3. Rectangles. The upper border of each rectangle is drawn across two or more highs. The lower border is drawn across two or more lows. A rectangle may serve either as a continuation or reversal pattern. As long as a major trend line is intact, a rectangle is more likely to serve as a continuation pattern. After prices break out of a rectangle, they often return and touch its wall from the outside, B, D, and E. These pullbacks offer excellent entries into low-risk trades in the direction of the breakout, with a protective stop inside the rectangle. The same price levels tend to serve as both support and resistance. Notice how line D turned from support into resistance and back into support. At the right edge of the chart, prices are well above their uptrend line, and it is better to wait for a pullback before buying. Eurodollar. Wrap BP. Hey June. 3L bug. The direction of the breakout. This is the minimum target. The maximum target is obtained by taking the length of the rectangle and projecting it vertically from the broken wall in the direction of a breakout. Tony Plummer writes that a rectangle is a part of a spiral-like development of a trend. He recommends measuring the height of a rectangle, multiplying it by 3. 23. Chart patterns 109. Fibonacci ratios 1.618, 2.618, and 4.236, and projecting those measurements in the direction of the breakout to obtain a price target. Trading rules. Floor traders can profit from trading short-term swings between rectangles walls, but the big money is made by trading in the direction of a breakout. 1. When trading within a rectangle, buy at the lower boundary and sell short at the upper boundary. Oscillators can help you decide when prices are ready to reverse within a rectangle. Stochastic, the relative strength index, and Williams percent are, see Chapter 4. Mark price rever. Sells within rectangles when they hit their reference lines and change direction. If you buy at the lower border of a rectangle, place your protective stop slightly below that rectangle. If you sell short near the upper wall of a rectangle, place a protective stop slightly above that border. You have to be very nimble and take profits at the first sign of a reversal. It is dangerous to hold on for a few extra ticks within a rectangle. 2. To find out whether an upside or a downside breakout is more likely, analyze the market in a longer time frame than the one you are trading. If you want to catch a breakout on a daily chart, identify the weekly trend because a breakout is more likely to go in its direction. See Section 43. 3. Once you buy an upside breakout or sell short a downside breakout, place your protective stop slightly inside the rectangle. There may be a pullback to the rectangle wall on light volume, but prices should not return into a rectangle after a valid breakout. Lines and flags. A line is a kind of rectangle, a lengthy congestion area. In Dow theory, a line is a correction against the primary trend. It is a congestion zone whose height is approximately 3% of current stock market value. When a stock market draws a line, instead of reacting more deeply against its major trend, it shows a particularly strong primary trend. A flag is a rectangle whose boundaries are parallel but slant up or down. 110 classical chart analysis. Breakouts tend to go against the slope of the flag. If a flag slants upward, a downside breakout is more likely. If the flag slants down, an upside breakout is more likely. If you see a downsloping flag in an uptrend, place a buy order above the latest peak of the flag to catch an upside breakout. A rising flag in an uptrend marks distribution, and a downside breakout is more likely. Place an order to sell short below the latest low of that flag. Reverse the procedure in down trends. Triangles. A triangle is a congestion area whose upper and lower boundaries converge. On the right, figure 23.4. It can serve either as a reversal or, more often, as a continuation pattern. Some technicians call triangles coils. The market winds up and the energy of traders becomes compressed, ready to spring. From a triangle, a small triangle whose height is 10 to 15% of the preceding trend is more likely to serve as a continuation pattern. Many uptrends and down trends are punctuated by these triangles, as sentences are punctuated by commas. Large triangles whose height equals a third or more of the preceding trend are more likely to serve as reversal patterns. Finally, some triangles simply fizzle out into listless trading ranges. Triangles can be divided into three major groups, depending on their angles. The upper and lower lines of symmetrical triangles converge at the same angles. If the upper line is inclined 30 degrees to the horizontal, then the lower line is also inclined 30 degrees. Symmetrical triangles reflect a fair balance of power between bulls and bears and are more likely to serve as continuation patterns. An ascending triangle has a relatively flat upper boundary and a rising lower boundary. Its flat upper boundary shows that bulls are maintaining their strength and can lift prices to the same level, while bears are losing their ability to drive prices lower. An ascending triangle is more likely to result in an upside breakout. A descending triangle has a relatively flat lower boundary, while its upper boundary slants down. Its flat lower boundary shows that bears are maintain their strength and continue to drive prices down, while bulls are losing their capacity to lift prices. A descending triangle is more likely to lead to a downside breakout. 23. Chart patterns 111. 28 BM. 27,222. 26,444. 25,667. 24,889. 24,111. 23,333. 22,556. 21,778. 21,808. Each triangle is defined by two converging lines. The upper line connects two or more peaks, and a lower line connects two or more bottoms. A triangle whose lower boundary is rising is called an ascending triangle, marked ASCT on the chart. It tells you to expect an upside break out. A descending triangle, desk T, has a declining upper boundary. It shows that prices are more likely to break down. A symmetrical triangle, SYMMT, shows that the forces of bulls and bears are evenly matched, and the trend is likely to continue. Valid breakouts tend to occur during the first two-thirds of a triangle's length. Sometimes prices pull back to a triangle after a breakout. Those pullbacks offer excellent entry points into trades in the direction of the breakout. Volume tends to shrink as triangles get older. If volume jumps on a rally toward the upper boundary, an upside breakout is more likely. If volume becomes heavier when prices fall toward the lower boundary, a downside breakout is more likely. Valid breakouts are accompanied by a burst of vol. UME, at least 50% above the average for the past 5 days. 112 Classical Chart Analysis. Valid breakouts occur during the first two-thirds of a triangle. It is better not to trade breakouts from the last third of a triangle. If prices stagnate all the way into the apex, they are likely to remain flat. A triangle is like a fight between two tired boxers who keep leaning on each other. An early breakout shows that one of the fighters is stronger. If prices stay within a triangle all the way into the apex, that shows that both boxers are exhausted and no trend is likely to emerge. Charts of related markets often show triangles at the same time. If gold, silver, and platinum all trace triangles and gold breaks out to the upside, then platinum and silver are likely to follow. This approach works well with currencies, especially with closely related ones, such as the German mark and Swiss franc. It also works with stocks in the same group. Compare General Motors to Ford but not to IBM. Triangles provide a minimum target for a move following a breakout. Measure the height of a triangle at its base and project vertically from the point where the triangle was broken. If you are dealing with a small triangle in the midst of a dynamic trend, that minimum measurement is likely to be exceeded. You can also use the Fibonacci projections mentioned earlier. Trading rules. It's better not to trade minor swings within a triangle unless that triangle is very large. As a triangle grows older, the swings become narrower. Profit potential shrinks while slippage and commissions continue to take just as bad a bite from your account as before. 1. If you trade inside a triangle, use oscillators such as stochastic, see Section 30, and Elder Ray, see Section 41. They can help you catch minor swings. 2. In trying to decide whether a triangle on a daily chart is likely to lead to an upside or a downside breakout, look at the weekly chart, see Section 43. If the weekly trend is up, then a triangle on the daily charts is more likely to break out to the upside, and vice versa. 3. When you want to buy an upside breakout, place a buy order slightly above the upper boundary of a triangle. Keep lowering your order as the triangle becomes narrower. If you want to short a downside break. 23. Chart patterns 113. Out. Place a sell order slightly below the lower boundary. Keep raising it as the triangle becomes narrower. Once you are in a trade, place a protective stop slightly inside the triangle. Prices may pull back to the wall, but they should not return deep inside a triangle following a valid breakout. 4. When a breakout from a triangle is followed by a pullback, pay attention. Tie into volume. A pullback on heavy volume threatens to abort the breakout, but a pullback on light volume offers a good opportunity to add to your position. 5. When prices approach the last third of a triangle, cancel your buy or sell orders. Breakouts from the last third of a triangle are very unreliable. Atypical triangles. A pennant is a small triangle whose lines are slanted in the same direction. Pennants that slant against the trend serve as continuation patterns. There is an old saying, the pennant flies at half-mast. A rally is likely to travel as far after the pennant as it did before. A pennant that slants in the direction of the trend indicates exhaustion. A trend is nearing a reversal. A widening triangle occurs when prices set a series of higher highs and lower lows. This pattern shows that the market is becoming hysterically volatile, with bulls and bears pouring in. The fight between bulls and bears becomes too hot for the uptrend to continue. A widening triangle kills an uptrend. A diamond starts out as a widening triangle and ends as a symmetrical triangle. You have to squint very hard to recognize it. Diamonds are prime Examples of Rorschach-type patterns for chartists. If you look long enough, you'll find them, but their trading usefulness is minimal. I used to look for diamonds, and most of them were fake zirconium. Double tops and bottoms. Double tops occur when prices rally to the area of the previous high. Double bottoms occur when prices fall near the previous low. The second top, or bot. 114 classical chart analysis. Tom could be slightly above or below the first. This often confuses beginning analysts. Savvy traders use technical indicators to identify double tops and bottoms. They are often marked by bullish and bearish divergences. Buying at double bottoms and selling short at double tops offer some of the best trading opportunities. 4. Computerized technical analysis. 24. Computers and trading. To be a successful trader, you must understand markets better than your competitors do. You can analyze them more thoroughly using a computer. Many traders who compete with you in the markets already have these machines. Manual charting can help you develop an intuitive physical feel for prices. You could buy some graph paper and plot several stocks or commodities each day. Once you post your charts, write down at what level you will be a buyer or a seller and where you'll place your stops. After you do that for a while, you will probably want to analyze more markets using technical indicators. Then it is time to look for a computer and technical analysis software. Driving or walking. A trader without a computer is like a man traveling on a bicycle. His legs grow strong and he sees a lot of scenery, but his progress is slow. When you travel on business and want to get to the point fast, you get a car. A computer can help you track and analyze more markets in depth. It can take over routine tasks and free up your mind for thinking. A computer. 115. 116 computerized technical analysis allows you to use more indicators and spot more opportunities in the markets. Trading is an information game. A computer helps you process more information. Computerized technical analysis is more objective than classical charting. You can argue about whether a head and shoulders pattern is present, but there is never an argument about an indicator's direction. When an indicator points up, it is clearly up, and when it is down, it is clearly down. Switching from manual charting to computerized analysis is like giving up an abacus for a calculator. It may slow you down for a while as you lean to push the keys, but the eventual increase in speed is worth the effort. 3 steps to computerized analysis. There are 3 steps to becoming a computerized trader. First, you must choose software, then a computer, and finally data for analysis. Different programs require different computers, which is why it pays to choose software first. Software tells a computer how to process data and how to display the results. Each program has a unique list of features and its own look and feel. Draw a list of tasks you want your computer to perform for you and show it to computerized traders. Contact a traders group, such as Club 3000, to see what its members like. Many traders call financial trading seminars incorporated for our opinion on the best packages. Magazines for traders, such as Futures, and technical analysis of stocks and commodities carry many ads for tech. Nickel analysis software. Read those ads and software reviews and send away. For demo diskettes. Once you narrow down your choices to 2 or 3 programs, call the companies whose software you like and ask for names of users in your area. Insist on names of real users, your best source of practical and unbiased advice. Many traders feel isolated and enjoy contact with other traders. They like to show their equipment and tell you about the quality of technical support. Most programs for technical analysis fall into one of 3 groups: tool boxes, black boxes, and gray boxes. Toolboxes are for serious traders. Black boxes are for people who believe in Santa Claus, and gray boxes are in between. When considering a new package, ask yourself which group it belongs to. 24. Computers and trading. 117. Toolboxes. If you want to work with wood or metal, you can go to a hardware store and buy a toolbox with a set of tools. You must learn how to use those tools too. Work smarter and more efficiently. A technical analysis toolbox provides a set of electronic tools for processing market data. A toolbox draws daily and weekly charts, splits the screen into several windows, and plots prices and indicators. A good toolbox includes many popular indicators, such as moving averages, channels, MACD, histogram, stochastic, the relative strength index, and a dozen others. It allows you to fine-tune all indicators. For example, it lets you switch from a 5-day to a 9-day stochastic at the push of a button. A quality package allows you to write your own indicators into the sys thing. You may have a favorite formula that you want to follow, along with ready-made indicators. Avoid programs that limit you to canned indicators. A good toolbox allows you to compare any two markets and analyze their spreads. If you trade options, your toolbox must include an options valuation model. Advanced packages allow you to test the profitability of trading systems. There are good toolboxes at all price levels. At the high end, CompuTrack's list of indicators runs to 2 pages. It allows you to test profitability, and it is highly automated. Most of the charts in this book were drawn using CompuTrack. Financial Trading Seminars Incorporated maintains a list of recommended resources for. This list is updated every few months and offered to traders as a public service. You can receive this timely information by contacting our company at the address that appears in the back of this book. Black boxes. Black box software tells you what to buy and sell and when to buy or sell it, without telling you why. You put data into a black box, lights blink, gears click, and out comes a piece of paper telling you what to do. Thousands of traders pay good money for this. Most black boxes are sold by hustlers to gullible or insecure traders. Black boxes always come with impressive track records showing profitable past performance. Every black box self-destructs because markets keep changing. Even systems with built-in optimization do not work because we 118 computerized technical analysis do not know what kind of optimization will be needed in the future. There is no substitute for mature judgment in trading. The only way to make money from a black box is to sell one. Each black box is guaranteed to fail, even if sold by an honest developer. Complex human activities, such as trading, cannot be automated. Machines can help but not replace humans. Trading with a black box means using a slice of someone else's intelligence, as it existed at some point in the past. Markets change, and experts change their minds, but a black box keeps churning out its buy and sell signals. Trading with a black box is like having sex using a penile implant. You may deceive your partner for a while, but you will never deceive yourself. Gray boxes. Like a black box, a gray box generates trading signals based on a proprietary formula. Unlike a black box, it gives you a general understanding of its formula and allows you to fine-tune its operations to some degree. The closer a gray box is to a toolbox, the better it is. Well-known gray boxes include such programs as Mesa. It is considered the best program for identifying market cycles. Computers. Different software programs run on different machines. This is why it is better to choose your software before you buy a computer. Get the most modem machine so that it will remain useful for years. Traders keep demanding more memory and speed. I never heard anyone complain about having too much of either. Buy a fast modem for collecting data from a database. Get a laser printer if you need to print high-quality charts. Most programs allow you to automate studies and print them out. You push a button and leave the computer alone. When you return, there is a ream of charts with indicators piled in front of the printer. The tedious work is done, and you can go to work making trading decisions. It pays to hire a person who already uses the package to set up your sys thing. I often do that when I start using a new piece of software. It saves a lot of time and energy. Once you know which buttons to push, you can run most programs without knowing much about computers. 24. Computers and Trading 119. Market data. Each trader needs to start with a historical database and update it daily. In the Old days, both had to be created manually. Now historical data for any given. Market costs less than $1 per month, and updates are cheap. It takes less than a minute to update a dozen markets by modem using your regular phone line. There are many reliable databases offering a variety of stock, currency, futures, and options data. Some traders collect their data around the clock. They use satellite dishes, FM receivers, and dedicated phone lines. Real-time data is necessary for day trading, but not for position trading. Position traders enter and exit positions within days or weeks. Day traders enter and exit trades within a few hours, if not minutes. You need to become a competent position trader before you can day trade. You can compare position trading and day trading to playing a video game at level 1 or level 9. You run the same mazes and dodge the same monsters, but the pace of the game is so fast that at level 9 your reactions must be almost automatic. If you stop to think, you're dead. Learn to analyze the markets and trade at level 1. Lean to be a position trader before attempting to day trade. When you buy historical data, it pays to cover 2 bull markets and 2 bear markets. Starting to analyze a new market, I usually review a monthly chart book covering 20 years of trading to see whether the market is historically high or low. I buy 3 to 5 years worth of weekly data and 1 year of daily data. When you begin using a computer, focus on 6 or fewer markets and add more later. For example, you may follow Treasury bonds, Standard & Poor's 500, gold, and Japanese yen or the German mark. Change this list if you want to follow agricultural or industrial markets. Choose a few technical indicators and run them daily on each market. After you lean them well, add new ones. I use a battery of 10 or 12 indicators at any given time, plus 1 new indicator. I'll watch it for several months and compare its signals to others. If it proves useful, I add it to the standard package. 3 major groups of indicators. Indicators can help you identify trends and their turning points. They can provide a deeper insight into the balance of power between bulls and bears. Indicators are more objective than chart patterns. 120 computerized technical analysis. The trouble with indicators is that they often contradict one another. Some of them work best in trending markets, others in flat markets. Some are good at catching turning points, while others are better at following trends. Most beginners look for a single indicator, a silver bullet, to kill the confusion in the markets. Others lump together many indicators and try to average their signals. Either way, a careless beginner with a computer is like a teenager with a sports car, an accident waiting to happen. A serious trader needs to know which indicators work best under different conditions. Before you use any indicator, you must understand what it measures and how it works. Only then can you have confidence in its signals. Professionals divide indicators into 3 groups: trend-following indicators, oscillators, and miscellaneous. Trend-following indicators work best when markets are moving but give bad and dangerous signals when the markets are flat. Oscillators catch turning points in flat markets but give premature and dangerous signals when the markets begin to trend. Miscellaneous indicators provide special insights into mass psychology. The secret of successful trading is to combine several indicators from different groups so that their negative features cancel each other out while their positive features remain undisturbed. This is the aim of the triple screen trading system. See section 43. Trend-following indicators include moving averages, MACD, moving average convergence divergence, MACD histogram, the directional system, on-balance volume, accumulation/distribution, and others. Trend following indicators are coincident or lagging indicators. They turn after trends reverse. Oscillators help identify turning points. They include stochastic, rate of change, smooth rate of change, momentum, the relative strength index, Eldoret, the force index, Williams percent, R, the commodity channel index, and others. Oscillators are leading or coincident indicators and often turn ahead of prices. Miscellaneous indicators provide insights into the intensity of bullish or bearish market opinion. They include the new high, new low index, the put-call ratio, bullish consensus, commitments of traders, the advance/decline index, the traders index, and so on. They can be leading or coincident indicators. 25. Moving averages. Wall Street old-timers claim that moving averages were brought to the fissile markets by anti-aircraft gunners. They used moving averages to sight guns. 25. Moving averages 121 on enemy planes during World War XI and applied this method to prices. The two early experts on moving averages were Richard Donkian and J.M. Hurst, neither apparently a gunner. Donkian was a Merrill Lynch employee who developed trading methods based on moving average crossovers. Hurst was an engineer who applied moving averages to stocks in his now classic book, The Profit Magic of Stock Transaction Timing. A moving average, MA, shows the average value of data in its time when Dow. A 5-day MA shows the average price for the past 5 days. A 20-day MA shows the average price for the past 20 days, and so on. When you connect each day's MA values, you create a moving average line. Simple MA égale PL plus P2 plus PN. N, where P is the price being averaged. N is the number of days in the moving average selected by trader. The value of MA depends on two factors, values that are being averaged and the width of the MA time window. Suppose you want to calculate a 3-day SIM, PLE moving average of a stock. If it closes at 19, 21, and 20 on 3 consecutive days, then a 3-day simple MA of closing prices is 20, 19 plus 21 plus 20 divided by 3. Suppose that on the 4th day the stock closes at 22. It makes its 3-day MA rise to 21. The average of the last 3 days, 21 plus 20 plus 22, divided by 3. There are 3 main types of moving averages: simple, exponential, and weighted. Most traders use simple MAs because they are easy to calculate, and Donkian and Hurst use them in pre-computer days. Simple MAs, however, have a fatal flaw. They change twice in response to each price. Twice as much bark. A simple MA changes twice in response to each piece of data. First, it changes when a new piece of data is added to the moving average. That is good. We want our MA to reflect changes in prices. The bad thing is that MA changes again when an old price is dropped off at the end of the moving average window. When a high price is dropped, a simple MA ticks down. When a low price is dropped, a simple MA rises. Those changes have nothing to do with the current reality of the market. Imagine that a stock hovers between 80 and 90, and its 10-day simple MA stands at 85, but includes 1 day when the stock reached 105. When that high number is dropped at the end of the 10-day window, the MA dives as if 122 computerized technical analysis in a downtrend. That meaningless dive has nothing to do with the current reality of the market. When an old piece of data gets dropped off, a simple moving average jumps. A simple MA is like a guard dog that barks twice, once when someone approaches the house, and once again when someone walks away from it. You do not know when to believe that dog. Traders use simple MAs out of inertia. A modem computerized trader is better off using exponential moving averages. Market psychology. Each price is a snapshot of the current mass consensus of value. See section 12. A single price does not tell you whether the crowd is bullish or bearish, just as a single photo does not tell you whether a person is an optimist or a pessimist. If, on the other hand, someone brings 10 photos of a person to a lab and gets a composite picture, it will reveal that person's typical features. If you update a composite photo each day, you can monitor trends in that person's mood. A moving average is a composite photograph of the market. It combines prices for several days. The market consists of huge crowds and a moving average identifies the direction of mass movement. The most important message of a moving average is the direction of its slope. When it rises, it shows that the crowd is becoming more optimistic, bullish. When it falls, it shows that the crowd is becoming more pessimistic, bearish. When the crowd is more bullish than before, prices rise above a moving average. When the crowd is more bearish than before, prices fall below a moving average. Exponential moving averages. An exponential moving average, EMA, is a better trend following tool than a simple EMA. It gives greater weight to the latest data in response to changes faster than a simple MA. At the same time, an EMA does not jump in response to old data. This guard dog has better ears, and it barks only when someone approaches the house. 25. Moving averages 123. Emavertu dot emalist ux. 2. Where k equals n plus sign. N equals the number of days in the EMA chosen by the trader. TOD equals today's price. Amaist equals the EMA of yesterday. Technical analysis software allows you to select the EMA length and calculate it at a push of a key. To do it by hand, follow these steps. 1. Choose the EMA length, see below. Let us say we want a 10-day EMA. 2. Calculate the coefficient K for that length, see above. For example, if you want a 10-day EMA, K equals 2 divided by 10 plus 1, or 0.18. 3. Calculate a simple MA for the first 10 days at closing prices and divide the sum by 10. 4. On the 11th day, multiply the closing price by K, multiply the previous day's MA by 1K, and add the two. The result is the 10-day EMA. 5. Keep repeating step 4 on each subsequent day to obtain the latest EMA. See worksheet, figure 25.1. An EMA has two major advantages over a simple MA. First, it assigns greater weight to the last trading day. The latest mood of the crowd is more important. In a 10-day EMA, the last closing price is responsible for 18% of EMA value, while in a simple MA, all days are equal. Second, EMA does not drop old data the way a simple MA does. Old data slowly fades away, like a mood of the past lingering in a composite photo. Choosing the length of a moving average. A relatively short EMA is more sensitive to price changes. It allows you to catch new trends sooner. It also changes its direction more often and produces more whipsaws. A whipsaw is a rapid reversal of a trading signal. A relatively long EMA leads to fewer whipsaws but misses turning points by a wider margin. 124 Computerized Technical Analysis. Gold. Day Close 10 EMA. 1,447.3. 2,456.8. 3,451.0. 4,452.5. 5,453.4. 6,455.5. 7,456.0. 8,454.7. 9,453.5. 10,456.5, 453.7, 11,459.5, 454.8, 12,465.2, 456.6, 13,460.8, 457.4, 14,460.8, 458.0. Figure 25.1. 10-day EMA worksheet. Begin by calculating a simple moving average. The first value in column 3 is a simple MA. Then calculate an exponential moving average on each subsequent day, according to the formula provided in the chapter. When computers first became available, traders crunched numbers to find the best moving averages for different markets. They found which MAs worked in the past, but it did not help them trade because markets kept changing. Our brokers do not let us trade the past. It pays to tie EMA length to a cycle if you can find it. A moving average should be half the length of the dominant market cycle. See section 36. If You find a 22-day cycle. Use an 11-day moving average. If the cycle is 34 days long, then use a 17-day moving average. Trouble is, cycles keep chong, ing their length and disappearing. Some traders use software, such as Mesa, to look for valid cycles, but Mesa shows that noise is greater than cycle amplitude most of the time. Finally, traders can fall back on a simple rule of thumb. The longer the 25 moving averages 125 trend you're trying to catch, the longer the moving average you need. You need a bigger fishing rod to catch a bigger fish. A 200-day moving average worked for long-term stock investors who want to ride major trends. Most traders can use an EMA between 10 and 20 days. A moving average should not be shorter than 8 days to avoid defeating its purpose as a trend-following tool. I have been using a 13-day exponential moving average for most of my trading in the past several years. Trading rules. A successful trader does not forecast the future. He monitors the market and manages his trading position. See Section 17. Moving averages help us to trade in the direction of a trend. The single most important message of a moving average is the direction of its slope. It shows the direction of the market's inertia. When an EMA rises, it is best to trade the market from the long side, and when it falls, it pays to trade from the short side. Figure 25-2. 1. When an EMA rises, trade that market from the long side. Buy when prices dip near or slightly below the moving average. Once you are long, place a protective stop below the latest minor low and move the stop to the break-even point as soon as prices close above their EMA. 2. When the EMA falls, trade that market from the short side. Sell short when prices rally toward or slightly above the EMA, and place a protective stop above the latest minor high. Lower that stop to the break even point as soon as prices close below their EMA. 3. When the EMA goes flat and only wiggles a little, it identifies an aim. Less trendless market. Do not trade using a trend-following method. Mechanical systems. The old mechanical trading methods using moving averages usually had 4 steps. 1. Buy when the EMA rises and prices close above it. 2. Sell when prices close below the EMA. 3. Sell short when the EMA declines and prices close below it. 4. Cover shorts when prices close above the EMA. This mechanical method works in trending markets, but leads to whipsaws when markets go flat. Trying to filter out whipsaws with mechanical rules is self-defeating. Phil. 126 Computerized Technical Analysis. 0. 7. 3. A. 7. 3. 0. 7. 3. 0. Figure 25. 13-day exponential moving average. When the EMA rises, it shows that the trend is up and the market should be traded from a long side. The best time to buy is when prices return to their EMA, not when they are high above it. Those trades offer a better risk-reward ratio. When the EMA declines, it shows that the trend is down and the market should be traded from the short side. It is best to sell when prices rally back to their EMA. When the EMA goes flat, as it did in December, it tells you that the market has stopped trending. Stop using a trend fall lowing method, but continue to track this indicator, waiting for it to enter a trend. 470, 456, 443, 430, 416, 403, 390, 376, 363, 3S0. TERs reduce profits as much as losses. An example of a filter is a rule that requires that prices close on the other side of MA not once, but twice, or that they penetrate MA by a certain margin. Mechanical filters reduce losses, but they also diminish the best feature of a moving average, its ability to lock onto a trend early. The favorite approach of Donkian, one of the originators of trading with moving averages, was to use crossovers of 4-, 9-, and 18-day MAs. Trading signals were given when all 3 MAs turned in the same direction. His 26 moving average convergence divergence 127. Method, like other mechanical trading methods, only worked in strongly trending markets. A trader must accept that an EMA, like any other trading tool, has good and bad sides. Moving averages help you identify and follow trends, but they lead to whipsaws in trading ranges. We will look for an answer to this dilemma in Chapter 9 on the triple screen trading system. More on moving averages. Moving averages serve as support and resistance zones. A rising matens to serve as a floor below prices, and a falling MA serves as a ceiling above them. That's why it pays to buy near a rising MA and sell short near a falling MA. Moving averages can be applied to indicators as well as prices. Born traders use a 5-day moving average of volume. When volume falls below its 5-day MA, it shows reduced public interest in the minor trend, which is likely to reverse. When volume overshoots its MA, it shows strong public interest and confirms the price trend. The proper way to plot a simple moving average is to lag it behind prices by half its length. For example, a 10-day simple MA properly belongs in the middle of a 10-day period, and it should be plotted underneath the 5th or 6th day. An exponential moving average is more heavily weighted toward the latest data, and a 10-day EMA should be plotted underneath the 7th or 8th day. Most software packages allow you to lag a moving average. Moving averages can be based not only on closing prices, but also on the mean between the high and the low. MAs of closing prices are used for daily analysis, but day traders prefer to apply MAs to median prices. An exponential moving average assigns greater weight to the latest day of trading, but a weighted moving average, WMA, allows you to assign any weight to any day, depending on what you deem important. WMAs are so complicated that traders are better off using EMAs. 26. Moving average convergence. Divergence, MACD, and MACD histogram. Moving averages identify trends by filtering out daily price ripples. A more advanced indicator was constructed by Gerald Appel, an analyst in Money 128 computerized technical analysis manager in New York. Moving average convergence divergence, or MACD for short, consists not of one, but 3 exponential moving averages. It appears on the charts as 2 lines whose crossovers give trading signals. How to create MACD. The original MACD indicator consists of 2 lines, a solid line called the MACD line and a dashed line called the signal line. The MACD line is made up of 2 exponential moving averages, EMAs. It responds to changes in prices relatively quickly. The signal line is made up of the MACD line smoothed with another EMA. It responds to changes in prices more slowly. Buy and sell signals are given when the fast MACD line crosses above or below the slow signal line. The MACD indicator is included in most programs for technical analysis. Few traders calculate it by hand. A computer does the job faster and more accurately. To create MACD. 1. Calculate a 12-day EMA of closing prices. 2. Calculate a 26-day EMA of closing prices. 3. Subtract the 26-day EMA from the 12-day EMA and plot their differ. It's as a solid line. This is the fast MACD line. 4. Calculate a 9-day EMA of the fast line and plot the result as a dashed line. This is the slow signal line. See the worksheet, figure 26.1. Market psychology. Each price reflects the consensus of value among the mass of market participants at the moment of the trade. A moving average represents an average consensus of value in a selected period, a composite photo of mass consensus. A long moving average tracks long-term consensus, and a short moving average tracks short-term consensus. Crossovers of the MACD and signal lines identify shifts in the balance of power of bulls and bears. The fast MACD line reflects mass consensus over a shorter period. The slow signal line reflects mass consensus over a longer period. When the fast MACD line rises above the slow signal line, it shows 26. Moving average convergence divergence 129. Crude oil. EHI. Close I12 EMA, 26 EMA, signal MACD HLSD. 11:70 horas y 39 minutos a 0 horas y 16 minutos 0 horas i 9 minutos. Mam 20.55 2041 roku 20.47 0.06 0.14 0.08. SSR 2072 20.46 20.49 minus 0.0 3 minus 0.120.09. SNIM ISHEU ASH 0.020.09. MM21 10 1 20 63 MV 0.060.06 bin. MM 21.290.11 minus 0.02. EE MKM 0.1 310.12. MM 21.48 I 20.90 20.720.18 0.0 40.14. 21.2 320.76 0.190 0.70.12. Figure 26 1. MACD and MACD histogram worksheet. To obtain MACD lines and an MACD histogram, take these steps. 1. Calculate the 12-day and 26-day exponential moving averages of closing prices. 2. Subtract the 26-day EMA from the 12-day EMA to obtain the fast MACD line. 3. Calculate a 9-day EMA of the fast MACD line to obtain the slow signal line. Plot both lines to obtain the classic MACD indicator. 4. Subtract the signal line from the MACD line to obtain an MACD histogram. That bulls dominate the market, and it is better to trade from the long side. When the fast line falls below the slow line, it shows that bears dominate the market, and it pays to trade from the short side. Trading rules. Crossovers between the MACD and signal lines identify changing market tides. Trading in the direction of a crossover means going with the flow of the market. This system generates fewer trades and whipsaws than a mechanical system based on a single moving average. 1. When the fast MACD line crosses above the slow signal line, it gives a buy signal. Go long and place a protective stop below the latest minor low. 130 computerized technical analysis. 22.01, 20.80, 19.80, 18.39, 17.18, 0.3838, -0, 1193, minus 0.8221, minus 1.1250, minus 1.6279. Figure 26, 2. MACD lines. When the fast MACD line crosses above the slow signal line, it gives a buy signal. Sell signals are given when the fast line crosses below the slow line. These rules help catch all the major trends and generate fewer whipsaws than crossovers of prices and a sin. GLE moving average. 2. When the fast line crosses below the slow line, it gives a sell signal. Go short and place a protective stop above the latest minor high. Figure 26, 2. More on MACD. Many traders try to optimize MACD by using other moving averages than the standard 12-, 26-, and 9-bar EMAs. 5-34-7 is another popular choice. Some traders try to link MACD to market cycles. The trouble is cycles are not present in the markets most of the time. See section 36. If you use cycles, the first EMA should be 1/4 the length of the dominant cycle, and the second EMA half the cycle length. The third EMA is a smoothing device whose length does not have to be tied to a cycle. Beware of optimize. 26. Moving average convergence divergence 131. ING MACD too often. If you fiddle with MACD long enough, you can make it give you any signal you want using the same data. A quick and dirty way to plot MACD is used by traders who's soft. MACD histogram tracks the difference between these two lines. 132 Computerized technical analysis. The slope of MACD histogram identifies the dominant market group. A rising MACD histogram shows that bulls are becoming stronger. A falling MACD histogram shows that bears are becoming stronger. When the fast MACD line rallies faster than the slow signal line, MACD histogram rises. It shows that bulls are becoming stronger than they have been. It is a good time to trade from alongside. When the fast MACD line drops faster than the slow line, MACD histogram falls. It shows that bears are becoming stronger. It is a good time to trade from the short side. When the slope of MACD histogram moves in the same direction as prices, the trend is safe. When the slope of MACD histogram moves in a direction opposite to that of prices, the health of the trend is questioned. It is best to trade in the direction of the slope of MACD histogram because it shows whether bulls or bears dominate the market. The slope of MACD histogram is more important than its position above or below the center line. The best sell signals are given when MACD histogram is above its center line, but its slope turns down, showing that bulls have become exhausted. The best buy signals occur when MACD histogram is below its center line, but its slope turns up, showing that bears have become exhausted. Trading rules. MACD histogram gives two types of trading signals. One is common and occurs at every price bar. The other is rare and occurs only a few times a year in any market, but it is extremely strong. The common signal is given by the slope of MACD histogram, figure 26:3. When the current bar is higher than the preceding bar, the slope is up. It shows that bulls are in control and it is time to buy. When the current bar is lower than the preceding bar, the slope is down. It shows that bears are in control and it is time to be short. When prices go one way, but MACD histogram moves the other way, it shows that the dominant crowd is losing its enthusiasm and the trend is weaker than it appears. 1. Buy when MACD histogram stops falling and ticks up. Place a protective stop below the latest minor low. 2. Sell short when MACD histogram stops rising and ticks down. Place a protective stop above the latest minor high. MACD histogram ticks up and down on the daily charts, so often that is. 26. Moving average convergence divergence 133. Ikolme kümne üheksas E. 128.50. E kaheksas E. 107.50. Üheksat kümne seitsmes E. 2.4725. 1.3886. 0. 3048. Minus 0.7790. Minus 1.8628. Figure 26. 3. MACD histogram divergences. MACD histogram confirms trends when it reaches new highs or lows, together with prices. The new lows in MACD histogram at points A and F confirm downtrends. New lows in the indicator tell traders that the downtrend is likely to retest or exceed bottoms A and F. New high in C and D in MACD histogram confirm uptrends. They show that the uptrend is likely to retest or exceed peaks C and D. Divergences between MACD histogram and prices identify major turning points. These signals rarely occur, but when they do, they often let you catch major reversals and the beginnings of new trends. TE. Bullish divergence AB flags a major buying opportunity. Prices are at a new low, but the indicator is tracing a higher bottom. It shows that bears are exhausted and bulls are ready to gain the upper hand. The bearish divergence D identifies a major selling opportunity. At the right edge of the chart, there is a bullish divergence FG. The best Time to buy is when MACD histogram ticks up from its second bottom. G. Once you go long, place a protective stop below the price bottom G. Move the stop up as the trend progresses. Not practical to buy and sell every time it turns. The changes of slope of MACD histograms are much more meaningful on the weekly charts, which is why it is included in the triple screen trading system. See section 43. 134 Computerized Technical Analysis. When to expect a new peak or valley. MACD histogram works like headlights on a car. It gives traders a glimpse of the road ahead. New highs and lows in this indicator are usually followed by new high or low prices. A record peak for the past 3 months in daily MACD histogram shows that bulls are very strong and prices are likely to rise even higher. A record new low for MACD histogram for the past 3 months shows that lower prices are likely ahead. When MACD histogram reaches a new high during a rally, the uptrend is healthy and you can expect the next rally to retest or exceed its previous peak. If MACD histogram falls to a new low during a downtrend, it shows that bears are strong and prices are likely to retest or exceed their latest low. The strongest signal in technical analysis. Divergences between MACD histogram and prices occur only a few times a year in any given market, but they give some of the most powerful messages. In technical analysis, these divergences identify major turning points and give extra strength buy or sell signals. They do not occur at every imper, top and bottom, but when you see one, you know that a major reversal is probably a hand. When prices rally to a new high, but MACD histogram traces a lower top, it creates a bearish divergence, figure 26.3. A lower top in MACD histogram shows that bulls are internally weak even though prices are higher. When bulls are running out of steam, bears are ready to grab control. Bearish divergences between MACD histogram and prices identify weak ness at market tops. They give sell signals when most traders feel excited about a breakout to a new high. 3. Sell short when MACD histogram ticks down from its second, lower top while prices are a new high. Place a protective stop above the latest high. As long as prices keep falling to new lows and MACD histogram keeps going lower, it confirms the downtrend. If prices fall to a new low, but MACD histogram traces a more shallow low, it creates a bullish divergence. It shows that prices are falling out of inertia, bears are weaker than they seem, and bulls are ready to gain control. Bullish divergences between 27. The directional system 135. MACD histogram and prices identify strength at market bottoms. They give buy signals when most traders feel fearful about a breakdown to a new low. 4. Buy when MACD histogram ticks up from its second, more shallow bottom while prices are a new low. Place a protective stop below the latest low. If a bullish divergence between MACD histogram and price is aborted, and prices fall to a new low, you will be stopped out. Continue to watch. MACD histogram. If it traces a more shallow third bottom while prices decline to a new low, you are dealing with a triple bullish divergence and especially strong buy signal. Buy again as soon as MACD histogram ticks up from shallow third bottom. The reverse applies to shorting triple bear-ish divergences. More on MACD histogram. MACD histogram works in any time frame, weekly, daily, and intraday. The signals of weekly MACD histogram lead to greater price moves than the daily or intraday indicators. This principle applies to all indicators, signals. In longer time frames, lead to greater price moves. When you use MACD and MACD histogram on the weekly charts, you do not have to wait until Friday to get your signals. A major trend can change in the middle of the week. The market does not watch the calendar. Because of this, weekly studies have to be performed each day. 27. The directional system. The directional system is a trend-following method. It was developed by J. Wells Wilder Jr. in the mid-1970s and modified by several analysts. The directional system identifies trends and shows when a trend is moving fast, enough to make it worth following. It helps traders take chunks of profit out of the middle of important trends. How to construct the directional system. Directional movement is defined as the portion of today's range that is outside of the previous day's range. The directional system checks weather. 136 Computerized technical analysis. Japanese yen. Date. High J low. Close plus DI 13. July 3 asterisk IDX. 7/1 72.2 471.8 771.9 2 3020 MSM 20. 7 halves a 71.83 71.6 371.6 9 29 23 19. Entuanis seitsemästä kymmenestä piste 36 27 kilometri 18. At Masmte una euro sterlina y 31 15 18. July 8th 1, 71.94, 71.78, 71.90, 3023, 1318. 7 diagonal 9 y 72.02, 71.77, 71.79, 3022, 2015-18. 7 décimos y 71.95, 71.87, 71.90, 29, 21, 16, 18. 7/11ths, 72.13, 71.82, 71.8, 530 2018. 7/12 i 71.94 73 M16 44 20. 7/15ths T 72.9 41 72.6 5 72.8 0 1543 22. 7/16ths 1 72.75 72.5 5 72.5 8 millimeters 1638 23. 7/17ths 72.91 72.6 2 72.71 37. 1542 24. Juillet 2018 J73.07 72.29 72.42 32 18 28 24. Juillet 2019 J73.06 72.69 29 16 29 24. July 22nd-1 72.70 72.22 72.36 26 21 223. 7 diagonal 23 y 72.76 72.62 72.69 25 20 11 22. Juillet 2024 J72.96 72.38 72.48 23 22 220. 7 diagonal 25 y 72.42 71.64 71.76 20 30 20 20. Juillet 2026 72.50 J71.96 72.37 19 27 20. 7/29 T 72.34 I 72.08 5 72.2 5 18 26 18 HUMI. Juillet 2030 J72.47 72.18 72.26 19 25 14 BH GJJB. 7/31 T 72.59 J72.31 J72.51 20 23 mm BBUSB. 8/172.59 72.30 72.41 19 22 MNJJM 18. 8 halves ICMM H23 27 17. 8 cinquième H Razage 22 19 16. August 6th 73.57 72.94 asterisk 73.50 28 17 24 17. 8 sevenths 73.29 73.0 7 73.2 1 27 16 26 18. 8 eighths 73 foot 15F 72.8, 473.06, 25, 18, 16, 18. 8 9e 73.18, 72.67, J 72.81, 23, 27, 17. 8 douzièmes de mètre and 22 19 7 16. Figure 27, 1. Directional System Worksheet. Plus DI-3 and DL-3 are based on positive and negative directional movements and the true ranges of the past 13 days. DX is derived from plus DI-3 and DLJ-3, and ADX is made by smoothing DX. See formulas in the chapter. Today's range extends above or below the previous day's range and averages that data over a period of time. These complex calculations, see worksheet, figure 27, 1, are best performed on a computer. The directional system is included in most software programs for technical analysis. 27. The directional system 137. 1. Identify directional movement, DM, by comparing today's high to low range with yesterday's high to low range. Directional movement is the largest part of today's range outside of yesterday's range. There are 4 types of DM, figure 27, 2. DM is always a posy. Type number plus DM, and DM refers simply to movement above or below yesterday's range. 2. Identify the true range, TR, of the market you analyze. It is always a positive number, the largest of 3. A. The distance from today's high to today's low. B. The distance from today's high to yesterday's close. C. The distance from today's low to yesterday's close. 3. Calculate daily directional indicators, più di ND. They allow you to compare different markets by expressing their directional movement as a percentage of each market's true range. Each DI is a positive number. Plus DI equals 0 on a day that has no directional movement up. DI equals 0 on a day that has no directional move. Mint down. Più di uguale. Plus DM. Te è meno di uguale. DM. Te è 4. Calculate smooth directional lines. Plus DIG and DIG. Smooth. Plus DI and DI are created with moving averages. Most software pack ages allow you to pick any period for smoothing, such as a 13-day moving average. You get 2 indicator lines, smooth positive and negative directional lines, plus DIJ3 and DL-G. Both numbers are posy. Type. They're usually plotted in different colors or as a solid and a dashed line. The relationship between positive and negative lines identifies trends. When plus DI13 is on top, it shows that the trend is up, and when DI13 is on top, it shows that the trend is down. The crossovers of plus DFY3 and DI13 give buy and sell signals. 5. Calculate the average directional indicator, ADX. This unique component of directional system shows when a trend is worth follow. Ingenieur. ADX measures the spread between directional lines plus DFY3 and DFY3. It is calculated in 2 steps. 38. Computerized technical analysis. Figure 27, 2. Directional movement. Directional movement is the largest part of today's range that is outside of yesterday's range. A. If today's range extends above yesterday's range, directional movement is positive plus DM. B. If today's range extends below yesterday's range, directional movement is negative DM. C. If today's range is inside of yesterday's range or extends above and below it by equal amounts, there is no directional movement, DM equals 0. If today's range extends both above and below yesterday's range, DM is positive or negative, depending on which part of the outside range is larger. D. On a limit up day, plus DM equals the distance from today's close to yes. Today's high. On a limit down day, DM equals the distance from today's close to yesterday's low. A. Calculate the daily directional indicator DX. Uidul uch, dele uch, 100. plus dj 27. The directional system 139. For example, plus dij 3 equals 34, dij 3, 18. Then, NV 34 18.100 equals 100 is equal to 30.77, rounded off equals 31. 34 plus 1852. B. Calculate the average directional indicator ADX by smoothing. DX with a moving average, such as a 13-day EMA. When a trend proceeds in a healthy manner, the spread between two smooth directional lines increases and ADX rises. ADX declines when a trend reverses or when a market enters a trading range. It pays to use a trend following method when ADX rises and not when ADX declines. Crowd behavior. The directional system tracks changes in mass bullishness and bearishness by measuring the capacity of bulls and bears to move prices outside of the previous day's range. If today's high is above yesterday's high, it shows that the market crowd is becoming more bullish. If today's low is below yesterday's low, it shows that the market crowd is becoming more bearish. The relative position of directional lines identifies trends. When the positive directional line is above the negative directional line, it shows that bullish traders dominate the market. When the negative directional line rises above the positive directional line, it shows that bearish traders are stronger. It pays to trade in the direction of the upper directional line. The average directional indicator ADX rises when the spread between directional lines increases. This shows that market leaders are becoming stronger, losers are getting weaker, and the trend is likely to continue. When the ADX rises, it pays to trade in the direction of the upper directional line. Using a trend-following method, ADX declines when the spread between plus DI caret and DI 13 narrows down. This shows that the dominant market group is losing its strength while the underdogs are gaining. Then the market is in turmoil, and it is better not to use trend-following methods. Trading rules. 1. Trade only from the long side when plus DI 13 is above DI 13. Trade only from a short side when DI 13 is above plus DI 13. The best time to be long is when both plus DI 13 and ADX are above DI 13 and ADX and Cs. This shows that the uptrend is getting stronger. Go long and place a 140 computerized technical analysis. 76.97. Figure 27.3. Signals of the directional system. Directional lines identify trends. When plus DI is on top, the trend is up, and it pays to trade the market from the long side. When DL is on top, it shows that the trend is down, and it pays to trade the market from the short side. The best time to use a trend-following method is when ADX is rising and is above the lower directional line. Those are two signs of dynamic trends. The directional system gives its best signals after ADX spends several weeks below both directional lines. That happens in quiet, dull markets. Once ADX wakes up and rises by 4 steps, for example, from 10 to 14, it gives a strong signal to trade in the direction of the upper directional line. It often flashes this signal at the beginning of major market moves. On this chart, ADX rallied from 9 to 13 in September just prior to a dynamic rally in the Japanese yen. Since the plus DI was on top, when the signal occurred, it signaled to go long. Protective stop below the latest minor low. The best time to be short is when DIJ3 and ADX are above plus DI 13 and ADX rises. This shows that bears are becoming stronger. Go short and place a protective stop above the latest minor high. 2. When ADX declines, it shows that the market is becoming less direct. 141.27. The directional system. Tidal, there are usually many whipsaws, just as there are turbulences in the water during the change of tide. When ADX points down, it is better not to use a trend-following method. 3. When ADX falls below both directional lines, it identifies a flat, sleepy market. Do not use a trend-following system, but start getting ready because major trends emerge from such lulls. For the single best signal of the directional system comes after ADX falls below both directional lines. The longer it stays there, the stronger the base of the next move. When ADX rallies from below both directional cues, it shows that the market is waking up from a lull. When ADX rises by 4 steps, i.e. from 9 to 13, from its lowest point below both directional lines, it rings a bell on a new trend. It shows that a new bull market or bear market is being bombed. Figure 27.3. Buy if plus still 3 is on top and place a stop below the latest minor low. Sell short if DI13 is on top and place a stop above the latest minor high. For example, if ADX rises from 8 to 12 while both lines are above 12 and plus DIN is on top, it indicates that a new uptrend is beginning. If ADX rises from 9 to 13 while both lines are above 13 and DI13 is on top, it shows that a new downtrend is starting. The directional system is unique in telling you when a major new trend is likely to begin. It rings a bell once or twice a year in any signals when a new baby bull or baby bear is being bombed. Monetary risk, usually low at that time, due to low volatility while the trend is still young. 5. When ADX rallies above both directional lines, it identifies an overheated market. When ADX turns down from above both directional lines, it shows that the major trend has stumbled. It is a good time to take profits. If you trade multiple contracts, you definitely want to take partial profits. Market indicators give hard signals and soft signals. For example, a viola, tie-in of a price low, or a change in direction of a moving average are hard sig. IT's a down of ADX is a soft signal. Once you see ADX down, you ought to be very, very careful about adding to positions. You should start laking profits, reducing positions, and looking to get out of your position, rather than adding to it. 142. Computerized technical analysis. 28. Momentum, rate of change, and smooth rate of change. When greed or fear grips a mass of traders, the crowd surges. Oscillators measure the speed of that surge and track its momentum. Technical indicators are divided into 3 main groups. Trend following. Indicators help identify trends. Oscillators help find turning points. Miscellaneous indicators, such as the new high-new low index, track general changes in mass psychology. Oscillators identify the emotional extremes of market crowds. They allow place overbought and oversold lines so that they cut across only the highest peaks and the lowest valleys of an oscillator for the past 6 months. Readjust these lines once every 3 months. 28. Momentum 143. When an oscillator rises or falls beyond its reference line, it helps a trader to pick a top or a bottom. Oscillators work spectacularly well in trading ranges, but they give premature and dangerous trading signals when new trend erupts from a range. When a strong trend begins, oscillators start acting like a dog that pulls its owner off his path. An oscillator can stay overbought for weeks at a time when a new, strong uptrend begins, giving premature sell signals. It can stay oversold for weeks in a steep downtrend, giving premature buy signals. Knowing when to use oscillators and when to rely on trend-following indicators is a hallmark of a mature analyst. See section 43. Types of divergences. Oscillators, as well as other indicators, give their best trading signals when they diverge from prices. Bullish divergences occur when prices fall to a new low while an oscillator refuses to decline to a new low. They show that bears are losing power, prices are falling out of inertia, and bulls are ready to seize control. Bullish divergences often mark the ends of downtrends. Bearish divergences occur in uptrends. They identify market tops. They emerge when prices rally to a new high while an oscillator refuses to rise to a new peak. A bearish divergence shows that bulls are running out of steam. prices are rising out of inertia, and bears are ready to take control. There are three classes of bullish and bearish divergences. Figure 28, 1. Class A divergences identify important turning points, the best trading opportunities. Class B divergences are less strong, and Class C divergences are least important. Valid divergences are clearly visible. They seem to jump from the charts. If you need a ruler to tell whether there is a divergence, assume there is none. Class of bearish divergences occur when prices reach a new high, but an oscillator reaches a lower high than it did on a previous rally. Class A bearish divergences usually lead to sharp breaks. Class of bullish divergences occur when prices reach a new low, but an oscillator traces a higher bottom than during its previous decline. They often precede sharp rallies. Class B bearish divergences occur when prices make a double top, but an oscillator traces a lower second top. Class B bullish divergences occur when prices make a double bottom, but an oscillator traces a higher second bottom. Class C bearish divergences occur when prices rise to a new high, but an indicator stops at the same level it reached during the previous rally. It shows 144 computerized technical analysis. Figure 28, 1. Types of divergences. Divergences between prices and indicators give some of the most powerful signals in technical analysis. Divergences are defined by the differences in height or depth of prices and indicators. Class of bearish divergence: prices reach a new peak while an indicator reaches a lower peak. This is the strongest sell signal. Class of bullish divergence: prices fall to a new low while an indicator stops at a more shallow low than before. This is the strongest buy signal. Class B bearish divergence: prices trace a double top while an indicator reaches a lower peak. This is the second strongest sell signal. Class B bullish divergence: prices trace a double bottom while an indicator traces a higher second bottom. This is the second strongest buy signal. Class C bearish divergence: prices reach a new peak while an indicator traces a double top. This is the weakest bearish divergence. Class C bullish divergence: prices fall to a new low while an indicator makes a double bottom. This is the weakest bullish divergence. 28. Momentum 145. That bulls are becoming neither stronger nor weaker. Class C bullish divergences occur when prices fall to a new low, but the indicator traces a double bottom. Class A divergences almost always identify good trades. Class A and C divergences more often lead to whipsaws. It is best to ignore them unless they are strongly confirmed by other indicators. Triple bullish or bearish divergences consist of 3 price bottoms and 3 oscillator bottoms, or 3 price tops and 3 oscillator tops. They are even stronger than regular divergences. In order for a triple divergence to occur, a regular bullish or bearish divergence first has to abort. That's another good reason to practice tight money management. If you lose only a little on a whipsaw, you will not suffer, and you'll have both the money and psychological strength to re-enter a trade. Momentum and rate of change. Momentum and rate of change measure trend acceleration, its GAM, or loss of speed. These leading indicators show when a trend speeds up, slows down, or maintains its rate of progress. They usually reach a peak before the trend reaches its high and reach a bottom before prices hit their low. As long as oscillators keep reaching new highs, it is safe to hold long positions. As long as they keep reaching new lows, it is safe to hold short positions. When an oscillator reaches a new high, it shows that an uptrend is gaining speed and is likely to continue. When an oscillator traces a lower peak, it shows that an uptrend has stopped accelerating like a rocket that has run out of fuel. When it flies only because of inertia, you have to get ready for a reversal. The same reasoning applies to oscillator lows M. Downtrends. Momentum and rate of change: compare today's closing price to a price A. Selected period of time ago. Momentum subtracts a past price from today's price. Rate of change divides today's price by a past price. Aod. M égale ptoden ho égale ptoden. Where M, momentum. ROC equals rate of change. PLNA equals today's closing price. Todd_N equals closing price in days ago, chosen by trader. 146 Computerized technical analysis. For example, a 7-day momentum of closing prices equals today's closing price minus the closing price 7 days ago. Momentum is positive if today's price is higher, negative if today's price is lower, and at 0 if today's price equals the price of 7 days ago. The slope of the line connecting momentum values for each day shows whether momentum is rising or falling. The 7-day rate of change, ROC, divides the latest price by the closing price 7 days ago. If they are equal, ROC equals 1. If today's price is higher, then ROC is greater than 1. And if today's price is lower, then ROC is less than 1. The slope of the line that connects values for each day shows whether rate of change is rising or falling. See worksheet, figure 28-2. A trader must choose the width of the time window for momentum or ROC. As a rule of thumb, it pays to keep oscillator windows fairly narrow. Use wide windows for trend-following indicators whose goal it is to catch trends. Use narrow windows for oscillators to detect short-term changes in the markets. Momentum and ROC share a flaw with simple moving averages. They jump twice in response to each piece of data. They react to each new price. And they jump again when that piece of data leaves the oscillator's window. Smooth rate of change takes care of this problem. Crowd psychology. Each price reflects the consensus of value of all market participants at the moment of transaction. Momentum and ROC compare today's price, today's consensus of value, to a previous price, an earlier consensus of value. They measure changes in mass optimism or pessimism. To find out whether a child is growing fast enough, you can measure his height each month and compare it with his height 6 months ago. Then you find out whether your child is growing normally, growing so slowly that you should take him to a doctor, or growing fast enough to think about applying for a basketball scholarship. Momentum and ROC tell you whether a trend is accelerating, slowing down, or moving at the same speed. When momentum or ROC rises to a new peak, it shows that the optimism of the market crowd is growing and prices are likely to rally higher. When momentum or ROC falls to a new low, it shows that the pessimism of the market crowd is increasing and lower prices are likely ahead. When prices rise, but momentum or ROC falls, it warns you that a top is near. It is time to think of taking profits on long positions or tightening stops. If prices reach a new high, but momentum or ROC reaches a lower top. 28. Momentum 147. Crude oil. Close. 20.51. 20.45. 20.09. 20.20. 20.31. 20.01. 20.00. 20.13. 20.10. 19.91. 20.17. 20.21. 20.00. 20.10. 20.09. 20.46. 20.53. 20.65. 20.70. 20.55. 20.72. 21.03. 21.10. 21.29. 21.09. 21.48. 21.23. 21.37. 21.81. ROC, Seitse Uxkolumteistema. 96.64 I 20.95. 100.50. 99.80. 103.11. 102.38. 100.14. 100.93. 101.65. 102.37. Figure 28-2. Momentum, rate of change, and smooth rate of change worksheet. Momentum, MTM, 7. is today's closing price minus the closing price 7. A carat rate of change, ROC, 7, is today's closing price divided by the closing price 7 days ago. You can use closing prices for the day in these formulas or median prices, high plus low divided by 2. This also applies to most indica tours described in this book. It is okay to use time windows that are wider or narrower than 7 days. To create a smooth rate of change, SROC 13/21, calculate a 13-day exponential moving average of closing prices and apply a 21-day rate of change to it. 148 computerized technical analysis. That bearish divergence gives a strong sell signal. The reverse holds true in downtrends. There are times when momentum and ROC act not as leading, but as coincident indicators. Think what happens to a rocket when it hits an overhead obstacle. Its speed and momentum stop rising and fall together as the rocket crashes. This happens in the markets when the crowd gets hit by a major piece of bad news, and this overhead obstacle sends ROC and prices down. Together, trading rules. Leading indicators are like brake lights on a car ahead of you on a highway. When they light up, you do not know whether the other driver is tapping his brakes or slamming them. You have to be extra careful putting on trades. Using leading indicators, figure 28, 3, 1. When the trend is up, by whenever ROC declines below its center line and ticks up, it shows that the uptrend has slowed down like a train that slows down to pick up passengers. When the trend is down, sell. Short whenever ROC rallies above its center line and ticks down. 2. If you hold a long position and prices begin to slide, see whether ROC has reached a record peak before this pullback. A new peak in ROC shows a high level of bullish energy, which is likely to lift the market to its previous high or higher. Then it is relatively safe to hold long positions. On the other hand, a series of declining peaks in ROC is a sign of weakness. It is better to sell immediately. Reverse this approach in downtrends. 3. A break in a trend line of momentum or ROC often precedes a break of a price trend line by a day or two. When you see a leading indicator break a trend line, prepare for a break in the price trend. Smooth rate of change. This oscillator, developed by Fred G. Schutzman, avoids the major flaw of ROC. It responds to each piece of data only once rather than twice. Smooth rate of change, SROC, compares the values of an exponential moving average, EMA, instead of prices at 2 points in time. It gives fewer trading signals, and the quality of these signals is better. 28. Momentum 149. Change ROC 7. When momentum or ROC rises, it shows that a rally is accelerating. When it falls, it shows that a decline is accelerating. Peaks and bottoms of these indicators show when a trend has reached its maximum speed. Once momentum or ROC turns, it is time to begin a countdown to a reversal. These indicators give their best signals when they diverge from prices, as marked by arrows on the chart. Momentum and ROC can be analyzed using classical charting methods, which often give leading trading signals. Notice how ROC and momentum have sliced through their resistance in August several days prior to a price breakout. At the right edge of the chart, a bearish diver. Gents shows that the uptrend has run out of steam. It is time to take pro. It's on long positions and go short with a protective stop a few ticks above the September top. 150 computerized technical analysis. To create SROC, you must first calculate an exponential moving average of closing prices. See section 25. The next step is to apply rate of change to the EMA. SROC is not very sensitive to the length of its EMA or ROC parts. You can calculate a 13-day EMA of closing prices and then apply a 21-day rate of change to it. See worksheet, figure 28.2. Some traders calculate the rate of change of prices first and then smooth it with a moving average. Their method produces a much jumpier indicator, which is less useful than SROC. Crowd behavior. An exponential moving average reflects the average consensus of value of all market participants during the period of its window. It is like a composite photograph that reflects major features of the market crowd rather than its fleeting moods. SROC compares each reading of an EMA to a past reading from your selected period of time. It compares the average mass consensus today to the average consensus in the past. SROC tracks major shifts in the bullishness and bearishness of the market crowd. Trading rules. Changes in the direction of SROC often identify important market turns. Upturns of SROC mark significant bottoms, and its downturns mark impair. Tant up, figure 28 à 4. Divergences between SROC and prices give ESP slightly strong buy and sell signals. 1. Buy when SROC turns up from below its centerline. 2. Sell when SROC stops rising and turns down. Sell short when SROC turns down from above its centerline.